Right now, as markets get ready to give back some of yesterday's big gains, and we are getting some of the grim data we have been bracing for. Lots to get to this morning. Retail sales for the month of March suffered a record drop, plunging 8.7%. Also, manufacturing in the New York area fell by its biggest margin ever to a historic low, far worse than anything seen during the Great Recession. And of course, more banks opening up their books, and the news is very bad. This morning, we heard from a number of banks, including Bank of America, which saw a stunning 48.5% drop in profits last quarter. One thing consistent with all these banks, they are putting aside billions of dollars for anticipated credit losses. Let's get the latest now from Emily McCormick. Good morning, Emily. What's the latest on the banks?
Well, just looking at the market reaction that we're seeing to these big bank earnings, it is not looking good, Alexis. We have each of Bank of America, Goldman Sachs, and Citigroup trading lower in the pre-market session after delivering results that showed very steep declines in profitability over last year. And as you mentioned, much of this is due to their high provisions for loan losses cutting into their bottom line. So taking a look at each of these, Bank of America's provisions for loan losses totaled $4.76 billion for the quarter. That was the most since 2010 and was driven by a $3.6 billion reserve build. Now, it's important to note that for all of these banks, we knew we were going to be seeing high loan losses and provisions for these because of a new accounting rule called CECL that is forcing these banks to build up their reserves for potential losses even before their borrowers start defaulting because of these expectations for a downturn. So we did see Bank of America delivering on that expectation. Now, looking at net income, that was at $4 billion. That was down from $7.3 billion in the first quarter of last year. So just about halving. CEO Brian Moynihan still delivered an upbeat message in his earnings statement. He said, quote, despite our increasing our loan loss reserves, we earned $4 billion this quarter, maintained a significant buffer against our most stringent capital requirement, and ended the quarter with more liquidity than we began. Turning to Goldman Sachs, we saw their provision for loan losses at $937 million. So this was lower than its peers, but reflects its smaller book of loans versus some other major financial institutions. We still saw net income attributable to common shareholders just about cut in half as well. That was at $1.21 billion for the quarter, down from $2.18 billion in the same quarter last year. Goldman Sachs CEO David Solomon said our quarterly profitability was inevitably affected by the economic dislocation, of course, due to COVID-19. The bright spot here for Goldman Sachs that I do want to highlight is that trading results for the banks actually topped expectations. That was due to increased volatility in the markets. At the end of the first quarter, we saw fixed income trading revenue rising 33% over last year to the highest level in 5 years. It was $2.97 billion. Also saw a jump of 22% for equity sales and trading. So that was a bright spot there for Goldman. And then finally, I also want to highlight Citigroup, which also saw a net income decrease of 46% to $2.5 billion for the first quarter. Their provision for loan losses was one of the highest at $7 billion, just topped so far by JP Morgan's, the announcement that they had yesterday. So still above many of its peers. And again, we are seeing this trend, high provisions for credit losses, anticipating that downturn and cutting into profitability for these big banks.
All right, let's move over to retail sales. Now, we knew they were going to be bad, but they are the worst on record, Emily, down 8.7% in the month of March. Break it down for us. Which areas, which categories saw the worst, and were there any bright spots in this retail sales report?
Well, the biggest declines that we saw were by the stores that have had to close the most due to the widespread social distancing measures that have been implemented because of the coronavirus pandemic. So we saw these declines led by clothing and accessory stores. Sales slumped 50.5% for the month of March. We also saw home furnishing stores. Those sales were down 26.8%, and food services and drinking places saw declines of 26.5%. So again, these are, of course, some of the most hard hit by social distancing standards. At the same time, the biggest gainer here were unsurprisingly grocery stores as consumers stock up on essentials. Those sales were up nearly 27% for the month. But overall, again, retail sales as a whole were down 8.7% in March, the most on record. Alexis?
All right, Emily, thanks for that. I want to stick with retail now and bring in Oliver Chen, Senior Research Analyst at Cowen. Good morning, Oliver, and thanks for being with us. You just heard Emily break down that retail sales number. As bad as that is, is the worst still yet to come for us?
Yeah, Alexis, thanks for having me. So what we're really watching here is continued store closings. We think stores won't open till late May, June. That's a big problem because these store closures are really impacting liquidity, and the mall is an issue. Liquidity at department stores is a huge risk factor because it could put a lot of them at risk of bankruptcies if these closures continue. But as Emily mentioned, there's a lot of bifurcation. So we like Walmart, Target, Costco. Target's at a good multiple and valuation in our opinion. At the same time, we're very cautious on the mall. What's really happening is this hierarchy of needs and needing food, needing stock up, and people not as interested in apparel and others in discretionary categories. So there's a certain degree of bifurcation of what's happening now in the marketplace.
Oliver, Brian here. Good to talk with you again. JCPenney shares getting smashed in the pre-market, down 16%. Yeah. On a report from Reuters that they're exploring bankruptcy. I just got off the phone with the JCPenney spokeswoman, and she told me bankruptcy is an option. It's among a myriad of options. A bankruptcy filing is not a foregone conclusion. In your view, is it a foregone conclusion for JCPenney? And what would it look like? Do they survive this?
Yeah, Brian, the main issue here is the road ahead, the nature of recovery, as well as consumers, and is it U, V, or L-shaped? That being said, survival is a big question. What's happening now with the banks is renegotiation of covenants. Covenants may be tripped in 2Q across the sector. Macy's and others and JCPenney, they do have about $1 billion of liquidity, but the burn rate in terms of the monthly expenses are around $300 million. So it's really not surprising that all these topics are on the table. And the scenario analysis is that if a company like JCPenney's does go bankrupt, does that actually give them some more breathing room to renegotiate different expenditures?
Oliver, does JCPenney, do they emerge with half of the number of stores that they have open? Right now, they're, I believe, at 850 stores. But if they were to file a bankruptcy filing, do they reopen later this year with 400 stores?
That's entirely possible. There's about 1,200 malls in the U.S., and anywhere from 30 to 50% are very weak. But the reorganization, depending on how they file the bankruptcy, it could really differ in terms of store closures or not. But minimization of expenses, as well as rethinking labor, as well as rethinking rent expense, will all be critical. But more store closures are likely across the sector, as well as bankruptcies. And what we see thematically is getting bigger. As you know, Macy's was already struggling across product, across digital. And as you know, Amazon and others have spent billions on digital and supply chain. And that is really unaffordable if you're struggling for survival.
Oliver, you mentioned Macy's. We know they furloughed nearly all of their 130,000 workers. How long can a Macy's last? How many months can Macy's operate like this before having to shut its doors? And do you see merger activity in this space? I'd have to think we're going to, just to see some of these retailers survive to see another day.
Yeah, Alexis, based on our analysis, we think about 4 more months. They can withstand about 4 more months. What's critical is the back half. So thinking about the second half, you make all your money in the holiday period. About 34% of your profits come in fourth quarter. So that's something we're watching, and it's very unclear how quickly consumers come back. We're thinking numbers could be down 30% this year. And the company also needs to allocate working capital towards inventory purchases towards the back half. So what's also critical is they need to raise about $500 million. That being said, Macy's has some valuable real estate. They also benefit from some credit card revenues as well. And they have some non-cash depreciation charges, which will benefit cash flow. So these are all things we're monitoring. And furloughing workers and reducing expenses has been very proactive because the company wants to make it through to the other side. And it's not in everybody's best interest for Macy's to go bankrupt, because if that happens, a lot of other things happen, such as co-tenancy clauses and malls falling into deeper spirals that were already weak.
Oliver, do you see Macy's being a candidate for merger activity? Or if you were to pick 2 players in the retail space to get together because of this pandemic, who might that be?
Well, as we look across the space, we have an intense focus on grocery, rethinking retail in terms of grocery and others. We've always thought Canada Goose is a great brand. So as we think about what's happening throughout the industry, luxury brands have durability and longevity, and that could be an attractive assets. And there's global players who have thought about M&A and have M&A as part of their strategy. Global players such as LVMH, Caring Group, as well as Viet Corp, rethinking. And brands have really good long-term equity and customers. So rethinking that as well. As we think about the landscape at large, think about Amazon, Target, Walmart, Kohl's. Kohl's already has a relationship with Amazon, and rethinking food and grocery and the combination of retail. The big getting bigger is a theme as well, and the big also taking market share as there are bankruptcies and others issues as well.
A very tough road ahead for retailers. Oliver Chen, Senior Research Analyst at Cowen, thanks for being with us this morning.
Sure.
All right, let's get a check of overseas markets now with Oscar Williams-Groot, who is standing by for us live in London. I see stocks depressed there as they are here for us in the U.S. Oliver?
That's right, Alexis. We've had a pretty tough morning here. Markets opened just slightly lower here in Europe, but they've been drifting throughout the session, and now most major indices are down around 3%. The major thing weighing on investor sentiment continues to be this warning from the IMF yesterday that the world could be facing the steepest and worst recession since the 1930s. That's not a warning you shrug off lightly, but we're also seeing some more localized issues that are hitting stock prices here. Jupiter Asset Management, they're London listed. They said they saw net outflows of £2.3 billion in the first quarter alone. That sent shockwaves through the asset management sector this morning. We've also had insurers falling quite steeply here in London after the FCA, the regulator here, wrote to CEOs saying they absolutely mustn't delay any payouts to businesses that might be covered due to the COVID-19 pandemic. That is raising concerns about cash management at these insurers. Overall, then, it's a pretty bleak day.
Oscar, I understand that we're getting a little bit of better news from European car makers. Are they starting to ramp back up again?
That's right. We're seeing quite a few manufacturers announce reopening of plants that have been shut for weeks now across Europe. Hyundai are reopening a plant in the Czech Republic. We've got Renault starting production in Portugal. They're also looking at bringing back production in their Romania factory. Volvo, they're reopening their main plant in Sweden. And also Audi have said that they are looking at restarting an engine plant in Hungary. Now, this is good news, but it's also perhaps it's necessary news. I mean, Volkswagen CEO said recently that these factory shutdowns are costing just Volkswagen alone €2 billion per week. For the 2 weeks that the factories were closed at the end of March, industry bodies estimate as well that we've lost 1.5 million cars that would have otherwise been produced. So really, these factories need to come online very soon to these companies to keep surviving. So it's good news to see some of these jobs and factories come back online.
Yeah, it is certainly encouraging. Oscar Williams-Groot in London, thank you. And stay with us, much more Yahoo Finance live straight ahead, including President Trump now cutting funding to the World Health Organization. What are the implications? We'll take a look at it after this. Wall Street is set up for a big sell-off here at the open. We have futures lower across the board. Dow futures down more than 500 points. NASDAQ futures off nearly 200 points. The U.S. now has the most coronavirus infections and deaths of any country. At the same time, President Trump made good on his threat to cut funding to the World Health Organization. His decision was met with shock and indignation around the world. Here's a tweet from Microsoft co-founder Bill Gates. Halting funding for the World Health Organization during a world health crisis is as dangerous as it sounds. Their work is slowing the spread of COVID-19, and if that work is stopped, no other organization can replace them. The world needs WHO now more than ever. We are joined now by our Angelina Kemlani for the latest on the virus itself. Anjali, what are the implications now that funding has been cut to the WHO?
Right. Well, we know that Trump is in fact saying that he's reviewing, right, what's going on with the WHO and what the U.S.'s role will be. We know we've heard the outcry from not just leaders like Bill Gates, but also European and Chinese officials saying that they will in fact push Trump to, rescind that threat. So with the U.S. really making up about a quarter, right, of the funding for WHO, it seems like it is a large portion that they will be doing without during this crisis. We know that there is, in fact, a lot of effort being put on and focus being put on the response, especially we saw just now United Health, which is out with its earnings today, talking about sending an executive over to lead the COVID-19 vaccine response. So there are a lot of people involved in this and a lot of U.S. officials as well, or people from the U.S. Involved in this response. It's going to be really interesting to see how this all pans out.
Anjali, what is the U.S. doing to help increase testing? We keep hearing how critical this is. If we want to start to even reopen the economy on a rolling basis, we need the testing. Where do things stand?
Right. So Dr. Birx has been talking about how there has been a shortage of use, even though there is capacity. And then you've heard from the lab individuals themselves saying that they are running into shortages of supplies. And that has been a problem since the beginning. So we're looking at now how that is going to be resolved really at the federal government level. One of the things that they have taken a step in doing is providing additional payment or increasing the payment amount. That was one of the reasons seen as not having widespread testing, is because the cost versus actual test being processed was too low, and so that trade-off was causing a shortage of testing. We've also seen reports of a slowdown in testing, and we know that that is really critical to understanding where in fact the U.S. can open up. So it remains to be seen how that does in fact affect, but we do know that Dr. Birx and others are looking at where the supply can in fact come from right now.
All right, Anjali Kemlani, thank you. Now, this morning we heard from New Jersey Governor Phil Murphy. During an interview this morning, he said he expects lockdown rules for New Jersey to be in place until June at the earliest. We are joined now by New Jersey's Health Commissioner, Judith Persikilli. Good to see you here, Judith. Thanks so much for making time for us. I guess the first question is, what's the state of things right now in New Jersey? Do you believe that you've hit a peak, and are you seeing evidence that the curve is flattening in your state?
Thanks so much for having me on this morning. Well, let me just level set where we are. As we sit here today, we have a total of 68,824 positive cases in the state, and we've experienced, unfortunately, 2,805 deaths. We had our first positive case on March 4th. So 6 weeks later, you can see the trajectory of COVID-19 in our state. Right now, 8,270 individuals in our hospitals are either COVID-19 positive or are persons under investigation. And of them, almost 1,980 are in critical care beds. We have about 18,000 licensed beds in the state and 2,000 licensed critical care beds. And in preparation for what we anticipate is the surge that we believe we're experiencing in North Jersey right now, we actually increased our critical care capacity by 100% from 2,000 to 4,000 beds. And we've increased our bed spaces. And what I mean by that is we've not only increased every available space within the hospital that can safely house a patient, but we also put up 3 field hospital and 3 hospitals that have closed within the last 5 years, we've opened them up. So we've increased our capacity significantly to be able to handle the surge, which is predicted by several, we look at 3 different models, by the several different models, to be occurring right now in the north and extending through the second week in May. So things are pretty busy. I believe all of the patients are getting the care that they require. We have a pretty significant check on ventilator inventory. If the worst case occurs, and those statistics, by the way, change every day depending on the inputs, but if the worst case occurs, we might see upwards to 3,800 to 4,000 critical care patients requiring ventilators. At that point, we will be using alternatives to the traditional ventilators, meaning anesthesia machines and BiPAP machines. We expect the total cases at worst case to go as high as about 16,000. And that's good news from a couple of days ago where we felt the models were predicting 39,000, which would have put such a strain on our healthcare system. We still believe we would have the bed spaces to take care of patients, but the standard of care would really be in crisis mode.
That's definitely good news to hear. And I know we've heard Governor Murphy talk about that, Judy. This is Angeli here. So I'm curious, we know that one of the issues has been information and looking at public health officials like yourself. You've enjoyed a pretty prominent role in the state's response, but that hasn't necessarily been true elsewhere in other states. So what are your thoughts on whether or not we're getting the right information, in a national scope, and whether or not we have enough information from public health officials about reopening and about how to proceed from here?
Well, let's talk about reopening. You know that our governor, along with the governors, I think, of 5 states now, will be planning the reopening together. And that's a good thing because we are so close to Pennsylvania, Delaware, and New York. And then, we have a lot in common with Connecticut and Massachusetts. And the reopening is a process, and it needs to be thoughtfully accomplished. It needs to be well thought out, and I know that we will have a public health official, someone with great experience in public health, and an economist, and someone with a larger worldview than just New Jersey, as our representatives, along with our chief of staff. And I have to say my role in all of this really follows the directive of our governor. He is very aware that this is a public health emergency. On February 3rd, he declared it a public health emergency, one of the first time that's ever been declared in our state. And he relies pretty significantly on what is going on in our hospitals, the predictive modeling, what we need for supplies. He knows exactly number one, how many ventilators we have. He just is very aware that this is a public health emergency, and the public health experts in the state, our state epidemiologists, are the ones that are running forward in helping us respond.
We'd love to get, well, just before we go to break, what testing looks like in the state right now. We spoke to the CEO of a company called Vault, which has a saliva test that you can do at home. We understand that's being administered in Middlesex. Where does testing stand right now in the state of New Jersey?
Currently we're testing symptomatic people only, and we've performed over 128,000 tests. We're getting a positivity rate of 44.8%. We are also in discussions with Rutgers University, who have just been approved by the FDA for saliva tests, and about how that plays into the reopening of the state, how much testing we have to do, and then how much contact tracing, so that when we do reopen, we have a pretty good handle on the extent of the disease in the state and how we can prevent further spread while we selectively and carefully open up the state, and at the same time prepare for any increases in the disease that may come in the fall or in the winter.
New Jersey's Health Commissioner Judith Persicilli, thank you so much for giving us a picture of what's happening in your state, and best of luck to you and your team.
Thank you so much.
And stay with us. The opening bell coming up next on Yahoo Finance. The opening bell coming up in just about a couple of minutes here on Yahoo Finance. More grim news this morning. Retail sales plunge by a record amount in the month of March. Bank earnings continuing to look dismal with Bank of America and Goldman Sachs out with their numbers. Let's head over to Jared Blickery, who's looking at the charts right now. And Jared, we have stock futures sharply lower here.
Yes, we do in the U.S. We can see over to the left on this world index map here, the Dow is off of over 2%, as is the S&P 500, 2.5%. NASDAQ outperforming on a relative basis, but still off just less than 2%. Ugly action in Europe as well. We can see the CAC 40 in Paris down 3%, as is the DAX. And in London, we were talking to Oscar Williams Group there. The FTSE is off about 2.5%. And just looking quickly at a chart of the S&P 500 over the last 2 days, here's approximately the open last night. You can see we've just been selling off ever since. And interestingly, yesterday, the NASDAQ managed to close above its 200-day moving average as well as its 50-day. So that was a positive sign, but just kind of rejecting those levels right now.
Give us a quick look at some of the retailers getting hit hard this morning.
Yeah, we can go to one of our heat maps for that. And we were talking about JCPenney possibly exploring a bankruptcy option. We can see in the lower right, that was off 2% yesterday, but look at this, 24% off in the pre-market. And if you look at a year-to-date chart, 71% down. That's one of the retailers that's hardest hit right now.
All right, Jared, thanks so much. And now we're going to pause for the opening bell. A new day of trading on Wall Street. And we are off to the races, folks. Looks like it's going to be red arrows across the board here to start this trading morning. I want to welcome Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Of course, we've got Brian Sozzi with us and Jared Blickery as well. Victoria, good to see you, and thanks for being with us. What do you make of the market action today and the numbers we're seeing? Retail sales plunging, bank earnings bad. We knew these numbers were going to be bad, Victoria. Is the market finally starting to bake all of this in?
Yeah, I think they've been baking in the uncertainty for a while because we just didn't know how things were going to play out. We knew numbers were going to be bad, as you mentioned, but we didn't know how bad. And now we're starting to see a little bit of this. But what we have to be prepared for is that the April numbers are probably going to be even worse than the March numbers, right? The shutdowns didn't really start until about the middle of March. So going in and looking at the April numbers, I think we're going to see things grow even more. Obviously, retail sales were going to take a big hit. The service numbers took a big hit. Food stores were actually up about 26-27%, which helped compensate a little bit for the numbers, but still a huge negative number. The one thing I think we have to look at is the control number. The control number is what actually feeds into our GDP estimations. That number was positive because you take out autos, which were down over 25%. You take out gasoline, you take out food services. So again, the numbers we're getting now, I don't think we can take them and extrapolate them onto the coming quarter, onto how things are going to be going forward, but definitely poor numbers for now.
Victoria, the retail sales numbers were shocking. To see sales at department stores and clothing accessory stores down 50% is just mind-blowing. But consumers are starting to get stimulus checks, and there are potentially more checks beyond that that lawmakers are touching on. Does that help lessen the blow? Do these stimulus checks matter at all, or does it just plug a dam for the U.S. economy?
I don't think it's going to matter when it comes to the retail, at least not all retail. If you look at companies like an Amazon or Walmart or Target, maybe companies that have that really strong online presence. We have talked many times over the past year about how Walmart and Target were really building up their e-commerce. They're going to benefit from that at this point in time. So maybe some of those stimulus checks coming in or relief checks coming in will help with online sales. I think the majority of retail is going to continue to suffer until we see the economy come back. And then there's going to be a lag. People are not going to automatically go out and start buying when they had to do without paychecks for a little bit of time. I would expect that we're going to see savings start to build a little bit.
You know, Victoria, even with the loss we're seeing here in the early going, the S&P is up about 28% from its low on March 23rd. What's going on here? Is there a disconnect between how investors are behaving and what the real economy is showing us, or have we actually hit peak pessimism right now in the stock market?
Well, I think people were waiting to see the peak cases and COVID-19 hit. And although we may not have seen it in every city, New York was obviously the city that most people were watching. And if you're hitting peak cases in New York, I think that gives a little bit of optimism to individuals, to investors to say, okay, maybe the worst has passed. That doesn't mean that the worst numbers have come out. Like I said, April numbers will be worse than March, but perhaps you're starting to see the light at the end of the tunnel, starting to see how the economy might begin to start opening up at some point over the next month. So you have a little bit of upside potential there in the markets, but I don't think it's going to be that V-shaped recovery. I've said before, I think we're looking more at a W, where we're going to have some more volatility, some ups and downs before we see a strong trend higher.
Victoria, are you still, or do you like big cap tech? I'm surprised by some of the rallies I've seen in Amazon hovering near 52-week high, Netflix certainly, because to me, that is a market repositioning itself for growth. And I don't know where that growth is coming right now.
Sure. I mean, Jared mentioned a minute ago, the NASDAQ trading above its 200-day moving average. You're seeing a lot of those cyclical growth names. Those are actually names that we've been picking up a little bit, adding to our positions over the last month. Names like an Apple, an Amazon, even a Microsoft. But these are only because these are companies that are going to benefit as the economy starts to get back to work here. As people go back to work, corporations are going to be looking for new technology solutions. Working from home, I mean, as many of you are doing, as many of us are doing, this opens up the door, I think, for new technology solutions for corporations. That's why you see a lot of these tech companies rallying right now. I'm not sure how long a span that has, but at least in the near term, I think those are good plays.
All right, Jared, I want to get over to you and bank earnings right now and how those big banks are responding. Citigroup and Goldman each saying profits tumbled 46% last quarter. Bank of America profits off 45%. And each of these banks, both today and yesterday, saying that they have set aside billions for anticipated credit losses. How is the market reacting to all of this?
Well, you can see on our earnings heat map here, not very well, with the exception of United Health, of course, not a bank, most of these in the red. Bank of America, for instance, down 5.5%, a lot of exposure here. We can see it's still up 24% from the lows, but you look at a year-to-date chart, for instance, it's down still 36%. Banks have been hit really one of the hardest, besides travel and leisure and hospitality, and that just has to do with the interest rate situation. You know, the Federal Reserve is throwing everything at the wall, but you do have these historically low rates, and net interest margin is just really compressed. The one bright spot that we've seen in some of these bank earnings is in trading, and that just has to do with the nearly unprecedented volatility that we've seen. That's not going to go on forever.
All right, Jared, thanks a lot. We also want to thank Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, for being with us. Thanks, guys. And stay with us. We're going to hear from Rick Newman and President Trump and how his response continues to flip-flop during this pandemic. We'll be right back. We are taking a look at oil today. Crude now in the teens. Last I checked, just below $20 a barrel. Let's check in with Jared Blickery for more on this. And Jared, I know that Aramco, Saudi Aramco, is offering its struggling oil refiners sort of a sweet deal when it comes to crude. What are they offering?
Yes, they're offering credit terms, basically extending them to 90 days for firms and these are refineries in Asia and Europe, in order to increase its market share there. But you see the incredibly depressed price of crude on your screen, just below $20 a barrel, probably heading a little bit lower. Let's take a look at Saudi Aramco itself, because their share price is extremely depressed. It's now trading at 30.7 reals. It IPO'd at 32, and it had been as high as nearly 40 if you go all the way back to its IPO, and we can see that on a one-year chart, which will include the IPO late last year. It's just kind of a dire situation for them because there's so much supply in the world. They can't get enough of this. There's ships floating around the seas, which are just about at capacity, and demand destruction is about 20 million barrels per day, and the cuts amount to just about 10 million. And so that math just doesn't add up. And until the market corrects, and it will eventually correct, we're probably going to see these depressed prices. In addition, with Saudi Aramco, they have to pay a $75 billion dividend, and that is under pressure as well.
All right, Jared Blickery, thanks so much for that. And do stay with us. Coming up next, President Trump announces an economic council, the folks who are going to help him decide when to reopen the country. We have details right after this. Welcome back to Yahoo Finance Live. Disney news this morning on retail sales and bank earnings. That is affecting trading, where we see all three major indexes off about 2%. It looks like President Trump is backing down after saying that he has complete authority over when to open the country again. It seems as though New York State Governor Andrew Cuomo, along with some other governors, are uniting in their coronavirus response. For more on this, let's head over to Rick Newman and his bow tie. Good morning, Rick. How are you?
Great.
All right. So what is President Trump doing? How is he sort of stepping back what he said just a day ago?
Well, when President Trump declared that he's the one who has total authority to reopen the economy, everybody went, huh? Does he really? And it turns out he doesn't. He does not have that authority. It rests with governors. So Trump, bowing to the inevitable, has basically indicated, okay, I'm gonna let the governors take the lead here. Of course, the governors have been taking the lead all along. And I think we should just recognize a pattern with Trump's daily coronavirus briefings. I mean, this is basically a series of publicity stunts, and Trump. This fits with what we know about how Trump operates. He will sometimes throw these outlandish ideas out there, and then see what the response is over the next 24 hours. And a lot of times he just doesn't do the things that he says he's going to do. So the other piece of news we got yesterday was he wants to stop U.S. funding for the World Health Organization. There's a lot of blowback to that. So I think it's quite possible that even though Trump said he wants to do that, we may find that he says, well, we're gonna investigate and see what's going on, but meanwhile the payments will continue. I don't know that for a fact, but that would fit the pattern. So I mean, we just need to get used to the pattern of bluster here.
Now, he also yesterday announced this economic council. He read out during a press conference at the White House about 200 names of corporate chiefs and other notable figures who he say are going to work collectively to reopen the economy. And perhaps the biggest news is the names that weren't on that list, right? Including AT&T's chief. What can you tell us about that?
Who knows how he came up with this list? And there's also some indication that some people whose names he did mention had no idea that they were going to be part of this list. I go back to what I said a moment ago. Like, consider this all to be a publicity stunt first, and if any substance comes of it, maybe that's a bonus down the road. But he spent 10 minutes just reading this list of names, and it's big names. It's the CEOs of Apple and Walmart and the energy companies and some pals of Trump like Sheldon Adelson, the casino magnate. And you have to wonder, with like 200 people on all these various councils, what are they actually going to be able to get done? Presumably, they won't be traveling to the White House as they have done before. They'll be meeting virtually. In general, it's a good thing that Trump would solicit input on how to get the economy restarted from the people running the biggest company. I mean, in here, that can't be bad. But Trump has had so many councils like this. I think we should just discount its effectiveness because there still is no plan from the White House for how to reopen the economy. We've got councils upon councils upon councils now. There's also this additional task force supposedly led by Jared Kushner to study how to restart the economy. We got news from the Washington Post this morning that the CDC and the Federal Emergency Management Agency are developing a plan, but it's not public yet. So the thing to look for is, when is there actually an actionable plan from the Trump administration that shows a way out of this mess?
All right, Rick Newman, thanks so much for the update, and stay with us. Much more to come right after this. Welcome back to Yahoo Finance Live. How are financial advisors navigating themselves and their clients through this pandemic? Joining us now to discuss that is Clara Shih. She is CEO of Hearsay Systems. She also sits on the board of Starbucks. And Clara, it's great to have you with us. Thanks for being here. A little bit on your company quickly for folks who don't know. It is the leading advisor cloud company. It's used by, I think, over 150,000 advisors and agents to deliver personalized relationships, you say, at scale with AI-assisted automation. What are you hearing from some of your largest clients right now? What are some of their biggest challenges during this pandemic?
Yes, so we're seeing unprecedented usage by advisors for our mobile phone service, for our compliant texting, for social media, and essentially people want to talk, right? They want to hear from their advisor. It's economic, it's personal, it's kids, parents in nursing homes, portfolios, retirement plans. People just want to talk. And so we're seeing advisors proactively reaching out, and also at clients calling advisors at unprecedented numbers, right? Almost advisors can't keep up with the phone volume. And so that's why they're having to go to texting and to social media to be able to address all of that demand.
Clara, how do you think financial services will change moving out of this situation?
Well, I think a lot of people are saying that the crisis is accelerating digital trends that were already in the making, and I very much believe that's true. People aren't going to stop wanting to text after this is over, both clients and advisors. But I also think that this experience is underscoring the importance of having a human advisor. Right? Someone to call, someone who is proactively watching things for you, someone who isn't a bot, and someone who cares.
I mentioned at the top, Clara, that you also sit on the Starbucks board. You have for a few years now. Can you share with us, to the extent that you can, any meetings you've been having with C-suite executives at Starbucks and with the board, and sort of what's the feeling at the company right now?
Well, I think whether it's Starbucks or whether it's any of the Fortune 500 financial services firms that Hearsay serves, I see leaders across the board around the world really trying to do the right thing, right? First, taking care of their people, making sure that they're safe from a physical and mental health perspective, but also, to the extent they can, taking care of them economically. And then number two, when you take care of your people, then they can help take care of your customers. And that's exactly what we're seeing across the board.
What leaders are sticking out to you as leading especially well in this environment?
Well, I think crises are a true test of leadership, and it's when true leadership is forged. Some of the people that I really admire, I love what's happening at American Family Insurance, Jack Salzwaddle there, and the decisions to give money back to their insurance policyholders. Jamie Dimon, what's happening at JP Morgan Chase. And then also companies outside of the financial services industry who are getting very creative and repurposing their factories and manufacturing plants to make PPE, to make hand sanitizer, and really do their part in this crisis.
All right, Clara Shih, CEO of Hearsay. Thanks for being with us this morning. Best of luck to you.
Thank you.
All right, one of our trending tickers today, JCPenney. We know that the retailer was struggling well before this pandemic, and now, Brian Sozzi, there are reports that it is looking at perhaps filing for bankruptcy. I know you got to talk to a spokesperson earlier this morning. What are they saying about that?
Yeah, not a good morning for my mom's favorite department store, even after all these years, Alexis. A JCPenney spokeswoman told me this morning that regarding the bankruptcy report from Reuters that hit late last night, she tells Yahoo Finance that bankruptcy is an option, but it is among a myriad of options the company is looking at. A bankruptcy filing is not a foregone conclusion. But make no mistake about it, Alexis, this is a company that has been in talks with creditors and lenders for about a year. They have a lot of debt. They have over $100 million in debt coming due in June, and none of their stores are open. Not a good situation. Now, we talked to Oliver Chen just a little while ago, and just talking to Oliver, veteran retail analyst, I don't believe you're going to see JCPenney reopen with 75% less stores. I think this restructuring and any bankruptcy filing would be focused on trying to reduce debt and trying to reduce other fixed costs.
Yeah, for sure. You'd have to think that their retail footprint is going to have to get smaller. And also, you brought up Oliver Chen, retail analyst over at Cowen, was with us earlier in the hour, and he was talking about the big getting bigger in this situation. He did talk about Macy's and how they've had to furlough nearly all of their employees, but he didn't see a scenario where Macy's goes away because of this. And if anything, it may have to join forces with another large retailer and be even bigger, right, Brian?
Yeah, it's interesting that he said that. And it's also interesting to think, well, who steps up and buys Macy's? Now, they own some phenomenal real estate, don't get me wrong, especially in New York City with their Herald Square location. But if you're a Walmart, do you really want to take on Macy's debt and their assets and restructure stores at a time where you're serving their community in new ways and you have your own initiatives? Why do you want that headache? And if you're JCPenney, you're nowhere near as strong as a Macy's. So I think the fallout and the news flows from retailers are going to be pretty shocking over the next couple of weeks.
Yeah, Oliver also mentioned that he thinks, according to his analysis, that Macy's probably has about 4 months before it has to take some drastic measures because of this pandemic. All right, let's get a check of the markets now. Depressed morning on Wall Street. Jared Blickery, what are you looking at?
Hi there, Alexis. Sorry about that. My keyboard froze. I've been looking at some of these earnings along with the rest of the world, and banks are really depressed right now. Just pulling up the Wi-Fi Interactive, we can see that some of the other underperforming sectors are energy, and that has to do with crude being down into the teens. These are the lowest prices that we've seen since 2002. And so we're seeing the broader indices off today, maybe 2 to 2.5% overall. So not really in line with the huge volatility that we saw in weeks prior, but still really not the best technical situation given the elevated levels that we're coming off here. We can see a lot of red on the screen, Microsoft down 2% along with Apple. And then some of the staples are the ones getting love like Walmart and Procter & Gamble, but that's a defensive situation. And then also noticeably United Health is up about 3.5%. Taking a look at the NASDAQ as well, we can see lots of red there. Some of the standouts, Tesla, which has just had an absolutely incredible run. It's up 144% over the last 2 years, but over the last 5 days, you can see that it's up about 34.5%, Alexis.
Yeah, you mentioned United Health. It's actually the leader in the Dow right now. Only 3 Dow stocks that I can see in the green. They are United Health, Procter & Gamble, and Walmart. Let's stick with retail for a moment. We heard that March retail sales sank the most on record, 8.7%. Many are saying that's just the tip of the iceberg. How are some of the larger retail stocks faring today?
Some of the larger ones are doing a little bit better than the rest. I mean, you take a look at Amazon, a very defensive play. That's down only 1.5%. We can see still close to record highs. It's up 12% or thereabouts over the last 5 days. And then Target, also another outperformer. But then you get into some of the department stores that we were just talking about, like JCPenney in the lower right, down 25%. Possibly exploring bankruptcy, and then Bed Bath & Beyond, that's down 13%. American Eagle Outfitters down 10%. It just goes on from there. A lot of these guys probably not going to reemerge anything other than a shadow of them former selves. You know, they talk about these recessions kind of bring out the cockroaches, and unfortunately, there's never just one, Alexis.
It's really, really hard to find a place to hide at the moment. Jared Blickery, thanks so much. And once again, to recap for you, retail sales plunging 8.7% in the month of March. The big banks, including Bank of America, Citi, and Goldman Sachs, each of them saying that quarterly profits sank more than 40% in the last quarter. Each of them also setting aside dollars for anticipated credit losses. We have got the Dow Industrials off more than 500 points after yesterday's rally. The NASDAQ down 185, the S&P off 73. Do stay with us. Much more Yahoo Finance Live straight ahead after this short break.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi, and you're seeing the market under considerable pressure so far on this trading session as the market digests some pretty stunning retail sales declines. I want to get right to Inez Ferre, who's keeping a close eye on the markets. Inez?
And Brian, if we just take a look at the Dow right now, it's down more than 500 points. The NASDAQ is down as well as the S&P. The major indexes are down about 2% right now. And I'm just showing you the Dow components. You can see a sea of red as energy is leading to the downside, financials as well. I'll get to the energy sector in a moment. I just want to show you United Health Group, because United Health Group has reported its quarterly results with adjusted earnings coming in at $3.72 a share. Total revenue rose 6.8% to just over $64 billion. The company has maintained its full year earnings outlook. And I just want to show you a year to date of United Health Group. That's year to date is held up pretty well, just only down 4%. And separately, the company also announced that Andrew Whitty, the president of United Health, also CEO of Optum, he will be taking a leave of absence in order to help lead the World Health Organization in its efforts to develop a vaccine for COVID-19, the development of that vaccine. Taking a look at the energy sector, as I just mentioned, leading to the downside, these energy names really getting hit, Apache, Occidental. And if we just take a look at oil right now, that's getting hit with Brent oil is particularly down more than 4% right now over concerns of really the collapse in demand of oil. The International Energy Agency, the IEA, today forecast a 29 million barrel per day decline in oil demand in April. Those are levels that haven't been seen in 25 years, with the IEA saying that no output cut could fully offset demand in oil. WTI holding up right now. It's up just 0.1%. OPEC Plus recently came out with an agreement to cut production by about 9.7 million barrels a day, Brian. But the IEA is saying that production cut is not enough.
All right, thanks so much, Inez. I want to welcome in Representative Tim Ryan of Ohio. Representative, thanks for taking a few minutes this morning. You have put forward a bold plan called the Emergency Money for the People Act. Walk us through some of the details of that, and what have you heard from your constituents to warrant a plan like this?
Well, Congressman Ro Khanna from California and I have been pushing this now for probably 4 or 5 weeks, even before we did the original CARES Act. I just believe, and so does he, that a direct cash infusion to the American people is the best way to do this. So our plan says that every citizen can get up to $2,000 per person. That includes people that may be dependents if they're 16, 17, 18 years old, college students, if you make less than $260,000 a year as a couple. And this is, to me, the best way to do this. We get into these bureaucratic programs. Sometimes they never work out quite the way we want them to. And I just believe that these direct cash payments to people who are really suffering on the ground out here, it's going to be very, very helpful. There's a lot of anxiety in the country today that's obviously around the coronavirus, but more for most people, it's around the economic anxiety.
Congressman Jessica Smith here. In your plan, you say that these payments could go out via PayPal, Venmo,
Right.
those types of methods. Can you explain a little bit about how exactly that would work?
Well, again, it'd be direct, not a check, obviously. We also do prepaid debit cards. And the idea is we've got to get to reality here where most people live, and they use PayPal, they use prepaid debit cards. And I think that's an advantage that our bill has to get that money down on the ground. I mean, you look at these retail workers, just one example of somebody who's mostly women working, checking us out at our grocery stores. And they may have kids at home. Their child care costs have gone up, but they're also working more. So they need almost double the child care costs than they normally had. So this is a normal human being here in America making things go for us that's underwater. And we need to step in immediately and help them out. And if they do prepaid debit cards, we can get them to them, or PayPal, or however it happens. We want to make sure that everybody's eligible to get this money.
And Representative, what are you hearing in your economy right now? Obviously, Ohio has a big manufacturing base, auto plants, plants that supply the airline industry. Any sense in when these businesses might reopen?
No, I don't think any of us do. I think we're starting to get a better feel for it. A lot of it's going to have to be around the testing issue and making sure we have enough tests so that we can begin to unravel this thing. But it's probably going to be to the end of May and into June, possibly, as a slow unravel. We've got some great opportunities here. We've got General Motors is doing a battery plant in our area. Lordstown Motors has a new electric truck vehicle at the old General Motors Lordstown facility just outside of Youngstown, Ohio. So we have opportunities that are out there. And so we're anxious to get going. But at the same time, public health has got to come first. We're hoping it's in the next few weeks, but we've got to let the epidemiologists and infectious disease people drive this, not a bunch of politicians who are in an election year.
Yeah, well said. Congressman Alexis Christoforous here. I can understand getting checks to these individuals is tantamount, but what about this country's small businesses? We know that loan program has launched, but a lot of the small businesses are saying they still can't access that money. What more are you all at Capitol Hill trying to do to get that money to small businesses?
Well, that's the emergency bill that's being negotiated right now between the House and the Senate. I think everybody's in agreement that particular program, the Paycheck Protection Program, did not have enough money in it. So we're, I think, joined with Republicans to say we got to get that money out the door and down to small businesses. They are suffering like we've never seen before. Really healthy companies that aren't doing well, and the mom and pops, the local restaurants and bars. So we've got to get more money in that. And the holdup is Democrats also want to get money to the local governments and the state governments, who are also going to see huge declines next month with the revenue that goes into their general revenue fund, the taxes that go into their general revenue fund. So it can't just be the small businesses, which we all agree they need the money. It's got to be the local governments as well, and these hospitals too. So it's got to be a broader package. But we've got to double down on this, and we've got to help these small businesses. I floated the idea a few weeks back about almost like war bonds, that we could utilize that money to help small businesses as a cash injection for them. So there's ways to do this. We're not getting the presidential leadership that we need on some of these issues. That's the reality of the situation. So we're all trying to figure this out without, the top dog helping us make this happen.
Congressman, what did you make of the president's decision to cut funding for the World Health Organization? And do you think any of the concerns that he has are legitimate?
This is one of the most irresponsible decisions in the history of the presidency, in the middle of a global pandemic, to defund the World Health Organization. Just in the previous segment, you were talking about, I think it was a CEO of a major health company going to the World Health Organization to help us get a vaccine for this. And so contrast that with the president of the United States defunding that very organization. And he's doing it just to reduce or try to deflect blame from his own incompetency, his own negligence, and looking the other way while the whole world was saying this is a potentially disastrous event that's happening. And he was calling it a hoax. And he defunded all of those entities that were there really to help us predict this stuff. And one of the programs was actually called Predict, to help us find these infectious diseases and contain them as quickly as we can. So I think this is the height of irresponsibility. I think the emperor has no clothes. I will just tell you, just in the conversations I'm having here in Ohio, everyone is seeing the president for what he is. He's not taking any responsibility. He's encouraging fights between governors, bidding up products that are essential. Healthcare workers, I don't know if you'll be able to find a healthcare worker that'll vote for President Trump again. Our first responders, after he put us in this position, and then he wants to blame the World Health Organization, blame Andrew Cuomo. Look, I played a lot of sports growing up. No coach worth their salt would ever try to blame somebody else. You get better, you improve, you take responsibility as a leader, and that's your job. And he is negligent to the nth degree.
Congressman, we're also hearing that these federal stimulus checks that are supposed to be making their way to folks may be delayed because President Trump is asking that his signature be put on each one of those. Can you give us a status update on that?
I've not heard. All I've heard is what I've read. But the fact that this president would delay payments to needy Americans so that he could get his name on the check. I mean, are you freaking kidding me? Really? This is happening in America? A president's more worried about his political standing, his ego getting stroked, as opposed to getting this money. I mean, if he gets the calls that we get every single day, people are scared, and he's going to make them wait another couple days because he wants the Trump name, the Trump brand on the stimulus checks. I mean, that's the kind of irresponsible leadership that he's giving us right now. And I just think that the average person where I grew up, where we come from in Ohio, is just appalled by something so obnoxious is trying to get your name on the check for your own political gain.
All right, let's leave it there. Representative Tim Ryan, Ohio, good to talk with you. Appreciate you taking some time, and please do stay safe out there.
Thanks. Be safe. Yes, sir.
And Alexis, I believe you have a new Electionomics podcast coming up.
I do. Rick Newman and I sat down yesterday to talk with the founder and president of Forward Strategies, Maddie Duppler. She's also the senior fellow for fiscal policy at the National Taxpayers Union. And we talked about what fiscal policy is doing, just sort of bouncing off of what the congressman was talking about. How is fiscal policy playing into this pandemic and trying to help both Americans, individuals, and small businesses? So that is dropping this morning. You can check it out at Apple Podcasts or wherever you get your podcasts. Brian.
I will indeed do just that. Do stick around. We'll have much more on the markets. We'll also talk to the CEO of our advertising giant WPP, Mark Reed. Welcome back to Yahoo Finance Live. You're seeing the markets under a good bit of pressure today following some much worse than expected retail sales data. But to discuss more on the markets, I want to bring in Megan Horniman, Director of Portfolio Strategy at Verdance Capital Advisors. Megan, good to talk with you this morning. Why I like your experience, for many years, you have focused on investing themes. So when you see retail sales data out today, much worse than expected, the market reacting accordingly, what type of investing themes do you tell clients are good choices?
So right now, our clients have a much more longer term time horizon. We're trying to look past the current pandemic and the current lockdown of the economy and take more of an 18 to 24 month view. So we're looking for some of those sectors or investing styles that may rally out of this once we come out of this lockdown. There is value, we think, in things like financials. I know some of the earnings have been challenging in this quarter, and that was expected. But as we come out of this crisis, we do think that financials offer some opportunity. There is the opportunity for things like energy to potentially rebound as well once it can find a bottom and move higher from these levels.
Again, Alexis, Christoforous here. I want to talk to you about the bank earnings that are starting to come into the market both yesterday and today. They are dismal. We expected that, but we're also seeing eye-popping amounts of money that these banks are setting aside for possible credit losses. And even before the depths of this virus, consumer credit rose at the fastest pace in 7 months in February. What is your outlook for consumer credit and for the banks?
So I think it's, these numbers are going to be eye-popping from earnings and not just from banks, from a lot of other companies. I think setting aside the reserves is definitely, I think, a good thing for them. And I think that that should not be taken as such a negative thing for the earnings. And when it comes to the consumer, we have to remember that coming into this crisis, the consumer balance sheet was the healthiest that we've ever seen. I mean, if you looked at the savings rate, it was well above the past 20-year average. If you looked at the household debt service ratio, very, very manageable. You actually had that ratio at record lows. So once we can get past this, and again, this is very difficult and very challenging for many people at this time, we just need to get, once we get the economy reopened and we get some idea of what that reopening will look like, we think that we can weather this from the consumer side going forward.
Megan, you mentioned that you invest with a look towards 12 to 18 months. Then let's say 18 months out, what does the U.S. economy look like? Are we back below double-digit unemployment? Is an economy that looks like the 2019 economy? How do you think about it?
I think it's going to take some time to get back to what we saw in 2019. I mean, we had the lowest unemployment rate since the 1960s. I think there will be some time as we work this out, and this depending on the speed at which we come and the degree that the economy reopens. I think it'll take some time to get back to that 3.5% level. But the one thing that we have to remember is that the U.S. government is putting more money towards this crisis than any crisis before, and that includes the 2008 and 2009 crisis. So there is a significant amount of support being given right now at such a rapid pace. Remember, in 2007, 2008, and 2009, it took a significant amount of time to get these programs out rolling in the economy. This is happening so quick and so fast that it is really there to help bridge that gap. So once that gap has been bridged and we get beyond this, there's a significant amount of support still there to help get the economy back moving again.
All right, let's leave it there. Megan Horniman, Director of Portfolio Strategy at Verdance Capital Advisors. Good to talk with you this morning.
Thank you very much.
All right, I want to get right to Inez Ferre, who's closely watching the airline stocks this morning. Inez?
That's right, Brian. And these airline stocks have moved around quite a bit this morning. But if we just take a look at some of these airlines, these are the airlines, some of these that you're seeing on the screen right now that have taken part in the Treasury Department's agreement for payroll grants. So this is part of the $50 billion that was set aside for the airline industry stimulus package, about $25 billion of it for payroll assistance, and 10 airlines, according to the Treasury Department, have applied for this help. So let's get to it. American was approved for $5.8 billion, and the aid will come in two forms: a grant of $4.1 billion and also a low interest rate loan of $1.7 billion. And then just taking a look at Love Southwest, Southwest is expected to receive $3.2 billion, more than $2 billion of that being in the payroll support aid and close to $1 billion in the form of a low interest rate loan. One very important key also that it cannot buy shares back. It can't partake in a buyback share program or dividends until September 30th of next year. And then just taking a look at Delta. Delta also has received aid, $5.4 billion. Remember that the Treasury also said that it would take equity in airlines receiving aid. Well, Delta says that it will give the government warrants to acquire around 1% of Delta stock over the next 5 years at $23.39 a share. That was a closing price on Friday, Brian.
All right, thanks so much, Inez. And do stick around. We'll have much more on the markets, and we'll talk exclusively with WPP CEO Mark Reed. Welcome back to Yahoo Finance Live. I want to get right to WPP CEO Mark Reed. Mark, good to talk with you this morning. Obviously, you guys are the world's largest advertising agency, and WPP had some big wins coming into the year. Intel, Hasbro, Discover, but you did come out with a business update in March. Business has taken a hit, but how are things looking like in April? I imagine a lot of big companies are they planning to come back on the other side of this, and how are they planning to do so?
Yeah, I mean, what's been amazing to me is, we sent 100,000 people to work from home 4 or 5 weeks ago, but our people are busier than they've ever been. And I mean, we're doing a lot of work now helping clients, replan their communications, think really about what they're talking about doing. We've done some research that shows that 84% of Americans want to hear what companies are doing and will judge companies based on what their actions are. I think companies are looking to advertise. Now, clearly there are some sectors of the economy that are really badly hit, airlines, travel companies. But other parts of the economy are doing well, and I think those companies want to talk to consumers about the steps that they're taking during this crisis.
Mark, I'd imagine that companies are trying to be very thoughtful about their messaging during this sensitive and scary time for all of us. But I'm wondering if you're hearing from some clients that may be fearful about placing ads in certain publications or on broadcasts because those ads are going to be placed next to really bad news about the pandemic and deaths and so on. Are you hearing that from your clients?
Well, look, there's a lot in your question. I mean, the same research we did showed that only 8% of Americans think that companies should not advertise at the current time. So people clearly want to hear from our clients. At the same time, I think people are concerned about placing content next to news around coronavirus. I have to say, I think consumers are smart enough to work out what is news and what is advertising. And I think it's important that as advertisers, we do support news media now more than ever. Quality editorial content or independent news and journalism is really important. So I think we're saying to clients that to continue to support news media and not to be too concerned about the context in which it's around. I think consumers can judge for themselves and understand. Now, the tonality, as you say, of the conversation is important. People don't want to hear, too much humor, as you can imagine at the moment. So we're really spending a lot of time advising clients on how to get the message right, how to use this time to communicate. You can't be seen to take advantage of the situation, but I'd say a large number of our clients and companies, as you know, are doing a lot in this crisis to help people, and I think they should be talking about what they're doing to their customers.
Mark, you noted in your release in March, late March, that you're reviewing your costs. Have you completed that review, and what actions might you be looking to take?
Well, look, no company is immune from the financial consequences of what's going on. And we've really been looking at our internal costs, freezing salaries, freezing new hires. I think like other companies, we can't rule out further measures, and we're working our way through that process as we get through. I have to say, we have a business in China, 7% of our revenue comes from China, and they are to some extent coming out the other side of this. And even, in Italy, Germany, Austria, we're starting to see some, I wouldn't say green shoots, but some some measures to sort of unfreeze the situation. So I think we're being, cognizant, and my job as the leader of the company is really to protect as many jobs as we can as we go through this situation, and that's what's important to me.
Hi, Mark, it's Heidi Chung. Thanks for joining us. So very interesting and tough times that we are in, and obviously advertising is not immune to that, but is legacy media truly having a moment right now? Does regular television as well as radio matter more now than ever?
Yeah, I think, Heidi, we're seeing viewership increase by 20 to 30% on traditional television. I think we saw in 08, 09, shift away from newspapers, and that spend never came back. And I think we're really going to have to see what happens as we go through, how long this situation lasts. The reality is that consumers are spending more time on all media. I'd say in many ways TikTok is the big winning platform from this situation, given sort of my experience of how my friends and colleagues seem to be using media. So, but the traditional media has a lot of viewers, but I think that clients are sort of shifting budgets towards digital media. And I would expect, there's questions about the upfront market in the US, how that would exist, it's being postponed to the situation. Will it come back in the same way? So I think, in the media market, like in every other part of our economy, things will be very, very different as we come out of this situation.
All right, we'll leave it there. Mark Reed, the CEO of WPP. Please do stay safe. Thanks for taking a few minutes today.
Thanks very much, Brian. Thank you.
From advertising to retail sales data, let's get back to Heidi Chung, who is here with the breakdown of the pretty dreadful retail sales data out this morning. Heidi?
Hey, Brian. Yeah, some really good insights from the CEO of WPP. But yeah, we've been talking a lot about the consumer because it's such a crucial part of the economy, making up roughly 70%. But coronavirus hitting consumer activity pretty hard in March. That's as quarantine measures are keeping a lot of consumers in their homes, and widespread layoffs are putting people out of jobs. But data from the U.S. Commerce Department this morning showing that headline retail sales plunged to a record 8.7% during March, which was worse than the 8% decline that was expected by economists. And core retail sales, which excludes the volatile auto and gas components, fell 3.1%, but it was a little better than expectations for a 5.2% decline. Now, those numbers compared to retail sales drop of 0.4% in February, and core retail sales sank 0.2% in the month prior. Now, breaking down the consumer activity by category here, clothing sales saw the biggest sales decline of 50.5%. Furniture store sales fell 26.8%. Spending at restaurants and bars plunged 26.5%. Department stores saw sales dip 23.9%. Sporting goods stores plunged 23.3%. Auto and auto parts sales decreased 25.6%. Gas spending falling 17.2%. But on the flip side here, couple of bright spots. Consumer spending at grocery stores rose a whopping 26.9%. Of course, that's because a lot of people are choosing to cook their meals inside their own homes. A lot of dining rooms and restaurants remain closed, so that seems to be the only and main option these days. And online sales increasing 3.1%. Now, the numbers are really bleak here, Brian, but the worst is not yet to come, and that's according to a lot of economists on Wall Street. Of course, this period in March only captured the last 2 weeks, which was when the COVID-19 outbreak really started to gain some steam. But take a good look at the numbers that we get in April and May, because those numbers are projected to be quite worse.
Yeah, I was just going to ask you, Heidi. I mean, we spoke to Oliver Chen, an analyst over at Cowen, in the last hour, and he was saying that this is just the beginning, right? That it doesn't paint the full picture. So, what are we expecting from the month of April when it comes to retail sales?
Well, I think one thing that we need to keep in mind here, Alexis, is that a lot of the quarantine measures that are being implemented by cities and states are coming in sort of a trickle effect. So a lot of states such as Florida as well as North Carolina, they started implementing those orders later on. So we're going to really start to see the brunt of that take place in April. That being said, a lot of stores are projected to stay closed for the entire month of April. So March numbers are this bleak, only with about capturing 2 weeks worth of closures. So the number there, Alexis, way, way worse. It's probably going to break yet another record.
All right, Heidi Chung, thanks so much. Before we go to a quick break, I want to tell you not to miss our interview with Stacey Abrams. She's a possible vice presidential choice for Democratic frontrunner Joe Biden. She's also founder and executive director for Southern Economic Advancement Project. She joins Yahoo Finance today at 12:15 to discuss the Trump administration's response to the COVID-19 pandemic, as well as the 2020 presidential race. Do stick around. Welcome back to Yahoo Finance Live. Some breaking news crossing the wires from the CDC. The globe has now passed more than 2 million coronavirus cases worldwide, more than 2 million. That 2 million mark now passed according to the CDC. I want to get right to Inez Ferreira, who's keeping a close eye on bank earnings right now. Inez?
And Brian, the banks this morning under pressure after they have reported their quarterly results. Take a look at Goldman Sachs. We're looking at Goldman Sachs down about almost 1% right now. Its first quarter profit fell 46%. Earnings per share came in at $3.11. Revenue increased 10% year over year. Now, the firm's trading division topped expectations because trading increased because, of course, of market volatility. And Goldman put aside some $937 million for loan losses in the quarter. It has a smaller book of loans compared to other banks, but just taking a look at year to date on how this stock has done, down 23% year to date. And then if we just take a look at Citi down 46% year to date. Today's action right now, you can see it's down about 5%. Citigroup's earnings came in at $1.05 per share. Its revenue was up 12% from the previous year. It added a reserve for loan losses of $4.9 billion, just like so many other banks have. And Bank of America also setting aside $3.6 billion for its loan loss reserve. Its quarterly results came in with earnings per share at 40 cents. Profit was down 48% compared to a year ago. So, Brian, these banks setting aside money for these reserves in case of defaults. Also, they've been, of course, hit by low interest rates as well.
Yeah, real sloppy quarters from the banks. But again, I guess no surprise there. Inez Ferreira, thank you. And all week long, we've been highlighting the trends in big food, and we've been talking to a lot of the biggest names in the packaged food industry. We're seeing some really, really strong gains right now as people buy to stock up their shelves because they're all working and living from home. One of the biggest names in the spice industry is McCormick. I want to get right to Lawrence Kurzius, McCormick Chairman and CEO. Lawrence, full and fair disclosure, I consume way too much Frank's Red Hot sauce. I just wanted to swab the deck of that one. But what other top products are you seeing consumers navigate to in this type of environment?
Well, Brian, first of all, thank you for having me. And it's not possible to consume way too much Frank's Red Hot sauce. So I'll put that challenge out to you. I'd like to start off, though, just saying thank you to all of those who are working in essential industries to keep us safe and to give my sympathy to all the people in the world who have been impacted by COVID-19. We as a company are seeing all stages of it, from our business in China, which is in the stages of recovery, to Europe and the U.S., which are right in the thick of it. Well, a lot of our products are really on fire right now. No pun intended about Frank's there, Brian, but I almost don't know where to begin. Consumers are staying home. Their kids are at home. People have to cook. They can't, dining out is not an option. And pretty much across the board, our products for at-home cooking are doing well. And really, they're not the kind of products that, people stock up on. It's unlike, toilet paper or something like that. No one goes out and buys a, 12-pack of vanilla extract. What they're buying is for real cooking and real consumption.
Lawrence, I know retail demand from consumers is through the roof, but I know you also service quick service restaurants, regular food service places, which are largely have been reduced to takeout or delivery at this point. How's demand coming from those places?
That's really true, and that's a great point. About a little over 20% of our business relates to food at home. Either through our food service customers or through what many people don't know is that we supply a lot of the sauces and coatings and seasonings for the quick service restaurant industry also. Those customers are really hurting, and the business along with them. It may surprise your listeners that the U.S. experiences right in their face. It's actually even tougher in Europe, where many of the drive-up and takeout options aren't available either. And so that part of the business is really going to be hurting until those restaurants are allowed to reopen.
Hi, Lawrence. It's Heidi Chung here. So can you give us a bit of an update on what production looks like? I know that you have some factories overseas. Are there any disruptions as of now? What's the update there?
Yeah. So, first, I'll kind of split that into two pieces. We have a global supply chain that's, just by the nature of the business that we're in, all aspects of flavor, that where we source over 14,000 raw materials from over 85 countries in the world. And so keeping, that functioning smoothly has been a near heroic task. And we haven't had any interruptions to speak of due to any kind of shortage of raw material or supply. We're very advantaged in that way because we have so many people actually on the ground in those countries to work with local suppliers and local authorities and local transportation to keep the supply chain working. We've got 118 different facilities worldwide, including 49 manufacturing facilities. And all of them are able to operate normally right now, but we have had some intermittent shutdowns. Our first priority as a company is to ensure the health and safety of our employees and also the quality and integrity of our products so consumers and customers know, they're getting products that are made properly, that are not going to put them at risk. And so we've responded not just to positive tests, but to any symptoms as well. So we've had an escalation process in place where people, if they have even got symptoms, where we go through a track and trace process, quarantines, and if necessary, a temporary suspension of operations. And we've shut some plants down temporarily for deep cleaning that have really turned out to be false alarms, where the person ended up coming back without a positive test.
Lawrence, real quickly before we let you go, last stat I saw from McCormick, sales were up 90% for the McCormick brand for the weekend in March 22nd. Has that strength continued into April?
Yeah, the strength has really continued from there. Again, we're not so much of a stock up kind of item. It's real consumption. I mean, parents are looking for things to do with their kids, and so things like baking, sugar cookies and things like that. Our food colorings for making crafts like slime have all been on fire. So we are still experiencing, I would say, kind of mid and upper double-digit growth. E-commerce is even stronger than that.
All right, let's leave it there. Lawrence Kurzius, Chairman and CEO of McCormick, and I will add this too, no disrespect to Old Bay seasoning. I certainly use a lot of that stuff too.
Thanks very much. It's great to be on. Thank you for having me.
All right, we'll talk to you soon. And do stick around. We'll talk with the CEO of Discover about how that credit card company is helping small businesses amidst the coronavirus pandemic. Welcome back to Yahoo Finance Live. I want to get right to Discover CEO Roger Hochschild. Roger, thanks for taking some time this morning. We do appreciate it. So we've seen a lot of big banks come out this week, and the quarter's not so good, but they have highlighted a lot of their efforts for small businesses. What is Discover doing in that regard?
So because we own our own network, a lot of what we do is on the payment side. And so we're looking to support our small business merchants every way we can. A big part is helping them facilitate pinless transactions. No one wants to touch a keypad anymore. So having the chip tap and go technology, waiving signatures, changing the rules around card not present, those are all some of the things we're trying to do as a payment network to help small businesses in this incredibly challenging time.
Roger, Alexis here. What are you doing for individuals, especially those who are carrying debt like student loans or auto payments? Are you being able to extend any assistance to them?
So we're not in the auto loan business, but we're extending assistance across all of our lending products. So whether it's the credit card, personal loans, student loans, we have options in terms of deferring your payments for multiple months. For our CD products, we eliminated the early withdrawal penalties in case people need emergency access to their cash. So, luckily we're coming into this with very strong capital, very strong funding. And so we can make the right long-term decisions and support our customers.
Roger, have you made any changes to how you think about risk management and your risk management practices? Look, we're headed for double-digit unemployment if we aren't there already. Job losses continue. Does that change what type of risks you take in your business?
Oh, it definitely does. So our biggest business is consumer lending. And so we're carefully watching the risk for new accounts that we originate across every product, as well as how we look at the portfolio. So we've cut back on line increases, balance transfer offers, those type of programs, but we continue to book credit cards and book new accounts. I think it's important to be a provider of credit for those who do need it in this environment. We just want to maintain and be even more disciplined in our underwriting.
Roger, we know nobody wants to touch cash right now. You touched on it in your previous answer, those screens. I mean, even when I go to the store, there are still some merchants that are asking me to sign using one of those touch pads, and I actually have declined to do that. So how is the payments industry going to change long-term when we come out the other side of this pandemic?
So I do think it'll continue the push towards digital adoption. And there are some advantages we have, again, being a card issuer, but also having our own network. I think you'll continue to see the growth of digital wallets. So whether it's Android Pay, whether it's Apple Pay, and just an acceleration of the move away from, signatures required or even touching PIN pads.
Roger, have you seen in your business a pickup in credit in reserves and charge-offs? And then secondarily, a lot of consumers are getting their stimulus checks soon. Do you expect that to be to stop perhaps some of those increases in charge-offs?
So we're going to announce our earnings next week. So I'm limited in what I can say in terms of what we're seeing. But, clearly we are getting a lot of demand from customers calling us, asking for the ability to extend their payments. I think there's a tremendous amount of uncertainty out there, though, in terms of how much of an impact all the government stimulus will have to offset the stress that consumers are feeling right now.
All right, let's leave it there. Discover CEO Roger Hochschild, please do come back on earnings day. It's coming up, right?
Yep, it'll be next week.
All right, we'll talk to you soon. Please do stay safe out there.
You too. Thanks a lot.
Thanks. I want to get right to our Dan Roberts, who's closely following the launch of Peacock. Dan, I almost forgot about this.
Exactly right, Brian. I think a lot of people almost forgot. Besides, we just saw the launch of Quibi. I mean, the streaming services are coming out rapid fire. Now, what's interesting about Peacock today, it's really just a soft launch. It's launching today for existing Comcast Xfinity customers. So this was always the plan. This hasn't been moved up, although a number of critics out there, or you could say supporters, onlookers in the industry, think that Peacock should move up the full launch date. As of now, NBC is still saying it plans its full launch for July. Now, of course, that was initially pegged to the Olympics. That was going to be the big get for Peacock. No Olympics now. The Olympics are in a year. Now, Peacock will still have sports when sports come back, like the NFL, because NBC has rights there. But for now, no sports. So I think there's a pretty good argument for Peacock's launch to be moved up. But today, it's just existing Comcast, Xfinity, and Flex customers who can get it. And I think there is a lot to offer. Now, the problem is, are there going to be people who sign up for Comcast now to get Peacock? I highly doubt that. This is a time when more people are cutting the cord than, I guess, retying the cord. But it's a nice give for existing Comcast customers. There's a big library of shows on here. Now, of course, the big thing everyone wants to know about is The Office. The Office isn't going to be on this thing until January 2021. But there are a lot of well-known NBC shows. You know, there's Parenthood. There's old shows like Coach. There's 30 Rock. There's Parks and Rec. Friday Night Lights, the terrific high school football show. So there is a lot on the platform, and I think that this soft launch for Comcast customers gives NBC a chance to test the waters and see how people react to it.
What about Friends, Jan? I didn't hear you talk about Friends. What's going on there? Because we know Netflix doesn't have the Friends sitcom anymore.
That's right. Yes. Friends is going to be on this thing. And look, NBC spent a lot of money to get back its own show. And by the way, I'm not necessarily so bullish that, you know, just because Friends was a big show on Netflix, there are going to be people who sign up for Peacock just to watch Friends. But yes, Friends is on this thing, going to be on this thing at July launch. I think overall, you know, there has to be more than one or two shows to get people to sign up for this. I mean, yes, there's a contrarian argument because Hulu, Amazon Prime, Netflix, each of those things kind of made their name on one huge must-watch show. You know, for Hulu, it was Handmaid's Tale. For Amazon Prime, it had Transparent, and now it has Marvelous Mrs. Maisel. But in NBC's case, I think people forget, and I'm a skeptic too about Peacock, but people forget just how strong the kind of NBC IP library is. I mentioned the shows. There's a lot of movies too, E.T. and some other Spielberg movies. There's going to be a lot of movies at launch. And then eventually there will be Peacock originals, although, man, because of coronavirus, they cannot film that stuff right now. So it's going to be a longer time before it has original shows.
Dan, I'm already lost. How much does Peacock cost?
So the ad-supported version is about $6, which puts it comparable to Hulu. Now, an interesting wrinkle with that is that there are some NBC shows that are on Peacock at launch that will also still be on Hulu for a while, like Parks and Rec, because Hulu has a deal to have those shows till 2024. So for a while, they'll be in two places, which I think is not great for Peacock. It kind of hurts Peacock. But again, I think the biggest thing that hurts Peacock right now is the lack of sports and the delay of the Olympics. Now, right now, the Comcast Xfinity people can get a premium version for free. But eventually, when it launches to everyone, you can pay about $6 for ad-supported, or you can pay, I think, $9.99 for no ads. And again, I think it's a time when people might be willing to add a new streaming service. The problem is, if NBC waits until July, coronavirus quarantine might be over by then. So I think if NBC's smart, hurry up, put it out sooner.
Yeah, I better hurry up and cancel my Quibi subscription and try out Peacock. Dan Roberts, appreciate you hopping on the stream. And do stick around. We'll dive into the state of the video game industry straight ahead. Welcome back to Yahoo Finance Live. You're seeing the markets being blasted today. The Dow is down over 600 points. Had a pretty bad retail sales report, and bank earnings continue, and they haven't looked too well either. But from banks and dreadful markets to Dan Halley in video games. And Dan, by all indications, the video game industry, along with streaming, is having a moment right now as people stay at home, play video games, and download a bunch of stuff.
Yeah, the game industry is doing pretty well, actually. I mean, if you look at things like the new Call of Duty that came out from Activision Blizzard, they had 50 million people on there already. That's only about a month old. So we're seeing a lot of people stay at home, play games, and just try to socially distance while still interacting with people. So the game industry is having a big moment right now.
And Dan, what are you seeing in terms of video game deals?
So Sony right now has a new initiative. It's called Play at Home. Basically, what they're trying to do is encourage people to not go out, stay inside. I'm okay with that. Play video games, also okay with that. And what you're getting is the Uncharted Nathan Drake collection. And basically what that is the entire Uncharted game. Think of it as an action movie that you can play. Absolutely amazing collection of games. They're giving it to you for free, as well as a gorgeous game called Journey, which has won tons of awards for its kind of interactive storytelling that it offers, the art style. It's a beautiful kind of narrative, and I think that's going to be something that catches a lot of people off guard if they haven't played it already. But these are two big titles that Sony is offering for free, and then they're also earmarking $10 million for independent game developers to ensure that they're able to continue working during this time, because a lot of companies are holding off on revealing their games right now.
Hey, Dan, in addition to not being able to find paper towel and toilet paper at the store, you can't find the Nintendo Switch. You could argue not as important as those other two items, but still. Any chance this is going to get restocked anytime soon?
Yeah, so right now Nintendo is kind of really busting their butts to get out more Switches. It's been an issue for some time, actually. Prior to the U.S. being locked down, they said that in Japan, they weren't going to be able to stock up on a special edition of the Switch for a game called Animal Crossing. That's one of the bigger games that's come out since the lockdown, was the Animal Crossing version of the Switch. Now in the US, you can't find Switches anywhere. I've tried. Every time they get restocked, they sell out. And a lot of that has to do with the fact that the Switch is a low-cost console, does have great titles. You can take it with you, portable, or, I mean, we're not really being portable right now, but also connected to a television. And they have those titles like Animal Crossing, like Mario, like Pokemon. So I think that's why we're starting to see that really just take off. For the console generation, Sony is the leader. Microsoft distant third with their Xbox One X and Xbox One. Sony far and away the leader. And then we've got the Switch kind of creeping up and doing really well in sales. It's one of the best-selling consoles that Nintendo has had in quite a while.
Dan, in terms of brick and mortar, you've got GameStop, which we know was struggling ahead of this pandemic. We've got Best Buy, places people are going to go online, presumably, for their gaming needs right now. But we heard today that Best Buy is furloughing. Brian Sozzi, is it something like over 50,000 workers?
51,000 workers, retail workers, will be furloughed at Best Buy. It's a stunning number, especially towards a lot of the peak buying that happens in the spring.
Yeah, I mean, Dan, aren't they able to capitalize on any of the gaming sales right now?
They can, but this is the same issue that GameStop is running into, right? Or GameStop ran into before they were deemed non-essential, like they were trying to say they were, is people can get these games online, and that's the easiest way to do it. And unfortunately, that means stores like GameStop, like Best Buy, aren't going to be able to capitalize on those kinds of sales and the people that want to go out and buy them. You download them online, you don't have to leave, you can get them right away.
All right, Dan Halley, thanks so much. Always good to talk with you. Enjoy your video gaming today.
Will do.
All right, much more ahead on Yahoo Finance Live today. Let's just recap the markets here. The Dow is down more than 600 points. Retail sales data, not that good. Pretty stunning declines across that retail sales report. Bank earnings also continue to be disappointing to a lot of people on Wall Street. One quick trending ticker I want to highlight, Procter & Gamble. They came out last night, raised their dividend. Also will report this Friday. They moved up that earnings release, likely to be a somewhat decent quarter because of that stock up trade. But do stick around. We'll have much more on Yahoo Finance Live straight ahead.
And welcome to Yahoo Finance on this Wednesday, April 15th. What would have been tax day, but remember the IRS has extended the tax filing deadline. Markets right now selling off. The S&P 500 down more than 70 points. Dow off more than 600 points. NASDAQ off 130 plus points. I'm Adam Shapiro. The entire Yahoo Finance team is here to help you get through today's trading session. Major headlines moving these markets. Retail sales, they plunged 8.7%. Grocery store sales, they were up, obviously, as people stocked up 26.9%. Clothing stores down 50%. Furniture stores down 26%. Sales at restaurants and bars down almost 27%. Department stores off almost 24%. It was a bloodbath out there. The Empire Manufacturing Survey, it slumped 57 points, record low, negative 78.2. Its worst prior reading before this was the index at 34.3 during the financial crisis. The MBA mortgage applications, they were up. The Mortgage Bankers Association said 7.3%, a surge of refinancing activity as the interest rate for a 30-year fixed mortgage fell to about 3.45%. The National Association of Home Builders, the confidence index, it plunged 42 points to just 30 in April, the lowest reading since June of 2012. Remember, 50 or above is a positive reading. The last negative reading was 2014. Current sales conditions, they dropped to 36, sales expectations to 36. Buyer traffic decreased 43 points down to just 13. 2 p.m., we get the Fed Beige Book, and all of this being driven, obviously, by coronavirus. Cases worldwide, more than 2 million, with 128,000 plus souls dead. In the USA, it's 615,406 confirmed cases, with more than 26,000 of our countrymen who have left us. To break all of this down and what's happening in Washington to respond to the crisis, Jessica Smith joins us with the latest. A lot of attention, not only on potential bankruptcies, the airline bailout, but funding the PPP, right, Jess?
Yeah, that is one of the big issues that we're watching. Lawmakers are trying to come to an agreement here to put more money towards that small business lending program. The Senate will be in a quick session tomorrow, so they're hoping for some sort of a breakthrough before then, but it doesn't look likely at this point. But this is very fluid. It could change. We're also getting a lot of headlines out of the White House that really have people talking. First is President Trump's decision to halt funding for the World Health Organization, pending a review of how the WHO has handled the coronavirus outbreak. The U.S. contributes between $400 and $500 million annually to the World Health Organization, but President Trump says he is now stopping that. This decision has sparked backlash from around the world. We've heard from Bill Gates, who says this is dangerous. What German foreign minister said that this isn't time to place blame. And then we've heard from lawmakers, of course, who say this is a bad decision. We had Congressman Tim Ryan on our air in the last hour saying that this is one of the most irresponsible decisions in the history of the presidency. So that's something we're going to watch. Another thing that President Trump announced is his task force with people focused on reopening the economy. He listed dozens and dozens of people who will be involved in this, including JP Morgan's Jamie Dimon, Apple's Tim Cook, Amazon's Jeff Bezos, a lot of names on that list. And he is talking to some industry groups today. He has 4 different conference calls with some of these leaders scheduled. Right now, they are closed to the press, but that could always change, and we'll keep you updated on what we hear from that. And finally, the Treasury Department has ordered those $1,200 stimulus checks to have President Trump's name on them. The Washington Post first reported this news and said the IRS officials are worried this could cause delays in getting those checks out. Now, the Treasury Department says that this is not going to cause delays, and checks were always scheduled to go out next week. But some people are skeptical about that. We've talked to Democratic lawmakers who say this is a horrible decision. We talked to Senator Gary Peters earlier today, and he says it's outrageous. People are saying that, President Trump wants to have his name on this check, so he's putting political standing above getting this money to people quickly. So we'll be watching to see if there's any more fallout from that. I don't think that story is going away anytime soon. Adam.
Jess, thank you very much. Turning our attention to earnings, the banks reporting today, Goldman Sachs and Bank of America, they were up. Brian Chung has the latest on how they performed in the last quarter. Brian?
Well, the second day of bank earnings, and we had 3 major banks reporting before the bell today. That was Bank of America, Citigroup, and also Goldman Sachs. And all of them reporting very similar declines on their bottom line, on net income. So first you have Bank of America, 45% year-over-year decline in earnings to $4 billion. They did actually have the most net income of the four major large U.S. banks. You did have Citigroup with a 46% year-over-year decline in earnings to $2.5 billion, and Goldman Sachs with a 46% decline to $1.2 billion. The one silver lining for all these banks, despite the terrible economic conditions obviously inflicted by the COVID-19 crisis, was trading through fixed income. So all these banks were able to trade positively on volatility to make some pretty nice earnings in their investment banking division. So you had Bank of America with fixed income revenue up 13% year over year. Analysts at KBW said that exceeded expectations. Then you had Citigroup that had revenue up 39% year over year. And then Goldman Sachs with $2.97 billion in fixed income trading revenues. That's the best in 5 years. But one thing that everyone's paying attention to are the loan loss provisions at those large banks, obviously with all the concern around companies around the United States possibly getting into close to default territory. There's concern that maybe a lot of those companies won't be able to pay their loans back. So you had Bank of America increasing their provisions up to $4.7 billion, Citigroup up to $7 billion, and Goldman Sachs with expected credit losses up to $937 million. For those wondering why Goldman is so much smaller than Bank of America and Citigroup, that's because they're not as consumer-facing as those other banks. But regardless, about 45% year-over-year declines on the bottom line for all of the nation's largest banks. Adam?
Hey, Brian, it's Julia. I was a little surprised when I was going through Goldman Sachs' results that the investment bank, it looks like the investment banking revenue for the quarter actually did quite well, second highest quarterly performance, up 6% from Q4 and up 25% from Q1 of 2019. What do you think's going on when it comes to why was Goldman such a standout for the iBanking when you're seeing the others kind of struggle in this area?
Yeah, well, for a lot of the investment banks, the story here is really, did you manage to play it well through the volatility? Volatility is not always a good thing. And one reminder is that in December 2018, when we saw that pretty sharp market sell-off, albeit for completely different reasons at the time, all the investment banks pretty much did a terrible job. You remember, Julia, how terrible Goldman's results were for that fourth quarter of 2018. But it seemed like with the liquidity that the Federal Reserve at least has been providing through the month of March, some banks that were kind of keen on being able to play the market were able to actually make a pretty good bounce. So we have to keep in mind that I highlighted the fixed income numbers, but there are a number of other investment banking divisions that can provide lots of revenue as well. When you talk about equity, it seems like on the underwriting side of things, probably not as much opportunity with not a lot of market availability for companies obviously wanting to go public, for example. But it seemed like for the companies that were at least able to anticipate how the Federal Reserve may have been able to respond, probably a good opportunity to make some money there.
All right, Brian, thank you. Want to turn our attention to what's going to happen in this economy, and is there opportunity for investors? To help us answer these questions, Peter Truer, the Academy Securities Head of Macro Strategy, is joining us now. And Peter, I just want to ask you, I know that you are taking risk right now. You're buying the dip, but this is a consumption-based economy, and those retail sales numbers we got this morning, I mean, clothing stores down 50%, department stores down almost 24%. Why is now the time to buy?
I started buying a couple of weeks ago, so I pared some risk back yesterday. I'm putting back on. I think we've got to be a little bit nimble here. But I think the whole conversation really has to shift from the war against the virus to how are we going to reopen? I understand that we've got to be careful in how we reopen. And, 2 weeks ago, anytime anyone talked about reopening, they were really, poo-pooed. Now I think there's at least a dialogue, and these numbers are so bad, I think it's got to wake up politicians and say, hey, we've got to be careful, but at the same time, we can't let the economy get completely trashed.
Hey, Peter, it's Julie here. I'm sure you also saw, though, that Harvard paper report that was out late yesterday that said we could see at least some level of social distancing going through 2022 even. So even if we do reopen, it seems like there is going to be a paradigm shift in how we operate, right? And how many people are allowed to be in public together. So if that's the case, what does that look like from an economic perspective and from a market perspective?
So I think a couple things with that. I think that's a great point. I do not think all the service sector jobs are going to come back. I think we're going to see a little bit of a social distancing. I think we're going to see a regular kind of commute from home or work from home type of philosophy going forward. So some of the service jobs will not come back. We've got to get those that can come back starting. And then really my next theory is that we really have to work on supply chain repatriation and a big infrastructure spending. I think one lesson we've all learned is whether China is a good actor or a bad actor, having so much of your supply chain depend on China, especially for medicine, is not a good idea. So I think we're going to see a real push in the second quarter, third quarter from politicians to bring supply chains back and to build out infrastructure spending. And that's what's going to make up for the lost jobs in the service sector.
I am curious how you feel about the financial sector. I'm looking at the XLF right now. That ETF is down about 4.4% today. Where do you think we go with so much of a backstop from the Federal Reserve when we look at the bank earnings we're already getting?
I think you're actually supposed to be buying XLF. So that's probably one of my favorite sectors right now. It's done very well off the lows. I think it will go back to. One, I think people underestimate how much trading profit can be made. Two, I think the bank balance sheets are going to be fine. My suspicion is that the banks took this opportunity to take a lot more write-downs than are necessary. And if we get any sort of recovery coming into at the end of Q2, start of Q3, I think look for good bank earnings, and they will make money once the refis start kicking in. There's a lot of opportunities for banks. Yield curves are actually somewhat steeper. Credit spreads are slightly wider. I think the punishment on the financial sector as a whole has been too much.
Peter, it's Julia LaRoche. I want to talk about the central bank side of things. You have the Fed stepping into the credit markets, buying up investment grade. I just wonder, because I think a lot of people are kind of scratching their heads at this, is the Fed picking winners and losers here? And what are kind of the pros and cons of these moves we've seen lately?
That's a great question. So I view the Fed as taking two types of activities. One is liquidity providing and one is risk taking. And when I look at markets like the repo market, there were a lot of people who wanted to put on risk but did not have the money to. So there the Fed put in liquidity. I think when we looked at what was going on in the credit markets, the CLO markets, there was no one willing to take risk. So the Fed tried to backstop that. I liked their view that they should buy AAA, CLO, and mortgage products. I also liked when they were buying investment grade 1 to 5 year corporate. That's a very, very safe part of the corporate credit market. There are almost no defaults ever from an investment grade company within 5 years. I'm a little bit nervous that they've started extending into some of the fallen angels and that they're buying some of the ETFs. I would have liked to see them kind of support that anchor really at the front end with money markets, commercial paper, 1 to 5 year. I'm a little bit nervous as they go beyond that. It's going to be something that gets hard to dig out of.
Julie?
I'll chime in because I think we're having a little bit of trouble with Akiko's audio. Peter, I wanted to turn to oil for a second. We had the International Energy Agency this morning saying that basically we've seen almost a decade's worth of oil demand erased because of coronavirus. We just got the weekly inventories numbers out here in the US, and we saw a build of 19.2 million barrels last week because people aren't driving and we're not seeing the demand for oil. So when you look at sort of buying the dip, does that apply to something like oil as well? Because the demand destruction there has been so profound.
Yeah, I think you've got to be very careful because it's still a very high beta sector. But again, we really have to focus on reopening the economy. As you said, no one's flying, no one's driving. As weather warms up, no one's heating their homes. Basically, there's no manufacturing going on. So everything that would be demand of oil has dropped off, and that's what we've got to fix. I mean, OPEC can cut more, OPEC Plus can cut more. It's not going to really help anything until we get this demand side back. That's got to be the focus, is how do we start rebuilding this? It sounds like it's everyone's trying to figure out how to get their auto insurance cut because no one's driving. They've got to fix that.
Peter Chur, thank you so much for joining us here. Peter Chur is with the Academy Securities, Head of Macro Strategy. Always good to see you. One of the things Peter was just talking about was getting things back on track. And one of the ways to do that is opening the economy. But we keep hearing from all the experts that you can't do that without proper testing. Joining us now to discuss testing is Dr. Michael Joyner from the Mayo Clinic. He's a professor of anesthesiology. It's not just testing, sir. Doctor, there's also the issue of treatment and blood plasma transfusions. Let's start at the beginning, though, with testing, because you have a serological blood testing program at Mayo. What is it? How does it work? And how quickly could it be expanded nationwide? How quickly does the test take? Doctor, do we have you? I think you have to unmute yourself.
There we go.
There you
What
go.
the test does is simply, Adam, take a blood sample from people and do a look back test to see if they have antibodies to COVID-19. And that helps us understand if they were infected with COVID-19. This is important not only for the people who we know had symptoms, but because we believe there are a lot of minimally symptomatic or asymptomatic carriers. And as you have this sort of look back testing, you can do a lot of things with it. One, you can have some understanding of how many people in the population or in a given area were infected. And then two, who is safe to go back to work without any restrictions. This can also be used in conjunction with the nasal swab testing as we move forward to start looking at outbreaks and outbreak control and tracking, which is a critical element of traditional public health when you're attempting to suppress infectious disease. So this sort of thing is really, really important. And the testing is key, and also generating a denominator so we understand something about the ecosystem and natural history of the disease is also a key. The Mayo test has been come online, I think, for about a week, and they're ramping up capacity as we speak, and additional tests are coming on board. And again, capacity's going higher and higher. There are some limitations potentially with the reagents and other things, but my colleagues in lab medicine are excellent at getting those logistical hurdles overcome and worked out.
So Adam mentioned that you were also working on the treatment side, and you're one of the folks who's looking at this idea that you can use plasma from people who have had the disease already in order to treat folks who are struggling with it now, which almost sounds like a sort of vaccine approach in a way, right? Introducing part of the virus into the body. How widespread, though, can that kind of a treatment be? Because you need the people, right, to have had it already. And you need, I don't know how far plasma goes, right, from one person.
So this is called passive immunity. It was a very, very common technique before antibiotics and vaccination, which essentially means before 1950 or before World War II. It was effective to treat diphtheria. It was effective to treat the measles, mumps, even polio, or prevent polio. And it was effective also in the 1918 Spanish flu epidemic, and more recently in the SARS outbreak. So basically what you do is take advantage of the fact that patients who have recovered have a whole lot of anti-COVID-19 antibodies in their plasma. You harvest that plasma and give that plasma to patients who are currently affected, or you give it to people who are at high risk of infection to prevent them from getting infected. This happens regularly when hepatitis A outbreaks are suppressed with gamma globulin, a concentrated form of antibodies that are obtained from humans. So this is an old strategy. It can be done. What's unique here is that we need to scale up quickly. It's come together through a consortium of just sort of interested parties who've raised their hands. The FDA is facilitating, and the national blood banking community is getting up to speed. You're always going to be a little bit behind the 8 ball because you have to wait until you have recovered patients. So I think you can scale up because you have so many asymptomatic patients. The donor pool is potentially vast. Each person can probably give about 2 to 6 units, which gives you a potentially huge supply if it can be distributed and used intelligently. And we have to, remain hopeful, but also have some scientific skepticism and do the sorts of registry and case control studies and randomized clinical trials to prove it works and to demonstrate what the best use case is. And that's what we're currently doing.
Doctor, we had a chance to speak with Miami Mayor Francis Suarez last week, who actually did donate his plasma as well. And the day we spoke to him, he had already spoken to another patient who had used his plasma, and that said that person was starting to stabilize as a result of that. I'm curious, though. He made it sound like there was some rigorous testing to make sure that he was the proper donor. How difficult is it to find that match, and how rigorous is that process to get to actually donating?
So this is very similar to a regular blood donation, and especially a plasma donation. So people have to first be eligible to donate blood under regular circumstances. But remember, in the United States, about 15 million blood transfusions are given a year. So there's a lot of infrastructure. But this is about plasma, which is a specialized product. So you have to have had currently a test positive case of COVID-19 which is a challenge because the testing has been so limited. Then you have to have recovered and be symptom-free for somewhere between 14 and 28 days before you can donate. The American Association of Blood Banks, AABB.org, has a site locator with a lot of information about where people who have recovered from COVID-19 can go to donate. Now, one of the important things somebody asked earlier about the serologic testing, eventually we're going to be able to do look-back testing, and all the people who say, I had the worst case of flu in my life in March, was it COVID? We'll be able to test those individuals, and hopefully they can join the donor pool. The other important thing to remember here is that if you look at these sorts of outbreaks of infectious disease, there's typically a peak, a valley, and a second peak, and even a third peak. So one of the things we have to think about, and people were talking about reopening the economy, is have the tools we need in addition to testing, social distancing, and outbreak tracking and tracing. We're going to need to have products like this as sort of the smoke jumpers who can come in and help put out the brush fires. This product will probably be replaced in September, perhaps by a concentrated form of the product, and then we can wait for the vaccine and biotech cavalry to arrive.
I am curious, you talk about the biotech cavalry, but the cavalry right now are the doctors and nurses on the front lines. I don't know if you are on a daily basis going into hospital, but how are you doing? How are your colleagues who are there every day doing?
Right. We've been very fortunate here in the flyover zone in Minnesota, where we have a lot of inherent social distancing. People aren't on the subway and so forth and lived in mostly detached homes. We don't have a whole lot of concentrated poverty. And we have a lot of social cohesion here and a lot of people who reflexively follow the rules. We shut down early in the state of Minnesota, so we have one of the slowest doubling times in the country. And while things have been shut down, which has caused concerns that we heard about earlier, the hospitals are not full, the ICUs are not full, and people are managing. So we've been very fortunate here, and it has not been a high-stress situation. And many people like myself, I'm an anesthesiologist when I'm not doing research, really have not been busy in our normal day jobs. However, I visit on a daily basis with Professor Lisanne Perofsky at Einstein, who works at Montefiore Medical Center in the Bronx. And she certainly tells us some very interesting stories about a completely full hospital, ICUs really jumping up out of everywhere, all over the hospitals, ventilated patients everywhere. And the sorts of stress that group is under is really quite remarkable. Really, in many ways, equal to high intensity combat.
Yeah. We appreciate your being with us, Dr. Michael Joyner, the Mayo Clinic's professor of anesthesiology. All the best to you.
Thank you.
Give everybody a little bit of optimism and hope. Want to show you something from Apple. They've just announced something. It seems like from an era that was so long ago, but here it comes. A new $399 iPhone SE. As you take a look at those images, Dan Halley is going to have more on this phone a little bit later for you. And also a little bit later for you, this you cannot miss. We have an interview with Stacey Abrams. Might she be Joe Biden's vice presidential pick? The former representative from the state of Georgia, the state assembly there, and also the gubernatorial candidate who almost won that election a few years back. Stacey Abrams coming up in the noon hour right here on Yahoo Finance. We've got you covered here at Yahoo Finance as we watch this market sell off. S&P 500 down more than 80 points, as is the Dow. It's off more than 670 points. NASDAQ is off more than 163 points. We are all dependent not only on the doctors and nurses who care for us when we're ill, the grocery store and clerks who keep us fed, but the truckers who move the goods we so desperately need, especially food. We are so dependent upon them right now, and we want to take a look at what's happening in that industry. Joining us to discuss this is Aaron Taratzis, the Convoy Director of Economic Research. Convoy links truckers with producers who want to get something shipped somewhere. It's good to have you here, Aaron. One of the things I wanted to ask you first and foremost as we look at this, agriculture. It represents, you say, about 10% of truck freight demand. What are you seeing there? Because there are concerns about the supply chain being shipped.
That's right. If you look at what is happening with agricultural output, it was pretty steady in March. We saw consumers, increase their consumption and buy a lot of groceries, but that really started to pull back in early April. So capacity utilization for food manufacturers was around 80% in March. I think it's going to start dipping down in April once we get that data.
So Aaron, hey, it's Julie here. So
Hey, Julie.
does that mean there is a concern? I mean, we've all seen the reporting about shortages of certain items on shelves. From your perspective and the getting that stuff from where it's made to where it's sold, do you think we're going to see further bottlenecks, and should people be worried? I mean, the authorities keep saying don't stockpile things, but
Yeah.
is that right?
I think some of the kind of the visual cues that we're seeing, the empty shelves in stores, a lot of that has to do with shifting consumer patterns. If you look at shopping behavior, consumer shopping has become a lot lumpier. People are making fewer, bigger trips. That means that the shelves look emptier for any given level of consumption. That means trucks, are finding these irregular patterns to have to try to restock shelves. I think the whole trucking industry right now is trying to figure out the new patterns to restock stores. The food is in warehouses, is coming off of out of farms, but again, the stores look emptier than they really are.
Aaron, the supplies may be there, but what we're seeing also is that there is a breakdown in the supply chain when you've got a breakdown in the workforce, whether it is stores closing down because somebody has tested positive, Amazon reporting the deaths of some workers. And so, my question is all of this going to lead to increased automation on the back end of this? Because what we're learning is that even if you've got the best system in place, it just takes one case to really break things down.
I think that's been one of the big lessons throughout the supply chain world from this crisis is how fragile and how vulnerable we were to human processes. I think obviously so much of a lot of supply chain work can be done remotely, but there are things that require in-person presence. A lot of those things are always going to be there, but these things run more smoothly when they are automated. We found out with our kind of the matching of the trucks and shippers, because that doesn't require human intervention, it continues to run smoothly throughout these disruptions.
Aaron, I want to ask you about the industrial production number that came out today. For March, we saw a drop of 5.4%. That is the biggest drop going back to 1946. And in your reaction note, you actually said March came in like a lion, like there was strong demand in the beginning of the month and then went out like a lamb, so to speak, because we saw a big drop. Yeah. What then does that tell us about where we are now? I mean, one would imagine that we're still near standstill in a lot of various areas.
You're right. March almost felt like two different months in one for a lot of the industrial sector. We saw the surge during the first half of the month. And then once we had the kind of a nationwide emergency declaration and the stay-at-home orders begin to increase mid-month, a lot of things really began to shut down. And, we saw that in truck rates and truck tenders. There was a big surge early in the month, a collapse later in the month. Right now, when we look at truck demand, obviously there is a big portion that comes from those durable goods manufacturers that are, for the most part, offline. You think auto industry, that's, about industrial and auto sector is about a third of truckload demand. That's running at 50% capacity right now. Meanwhile, you look at, again, food and grocery, that's a little bit below. It's, in the 70 to 75% capacity, depending on exactly how you're looking at it. But so a little bit of a dip there, but still, humming along.
So, Aaron, to wrap this up, data does not lie, but it's dependent, at least the answer you hope to get, on the question you ask. So I'm curious, what is the data telling you? Because you see before the rest of us, truckers and producers and where things are lining up. What are you seeing about the ability to get this economy going again and how quickly?
Yeah, I mean, if you look at truck rates had been declining even going into this crisis. They were, feeling the effects of a soft industrial year last year. Right now, they've kind of given up about 3 or 4 months of gains. So we are seeing soft truck rates. There's a real question in my mind, how does this begin to turn around? There's so many unknowns around truck supply. In past recessions, we saw people who were unemployed in other fields enter trucking because that was a good option for them. I'm skeptical that that's going to happen this time around.
Aaron Taratzis is the Convoy Director of Economic Research. We are fans of Convoy, and not because we remember the Convoy song from the 1970s. We appreciate the data and the insight you offer us. All the best to you and your team. We have more Yahoo Finance for you coming up right after this. Welcome back to Yahoo Finance. As we watch this market sell off, we got just horrific retail sales numbers for the month of March this morning. But before the COVID-19 crisis, we were watching JCPenney because they had a huge amount of debt to refinance over the next 2 years. And then the crisis hit. Brian Sozzi is joining us now because there are these rumors that they're exploring one option, which is the B word, bankruptcy. Right, Brian?
Yeah, you never want to hear that when you're a dying, struggling department store there, Adam. But I did talk to a JCPenney spokeswoman this morning telling me that bankruptcy filing is not imminent. It is among a myriad of options JCPenney is considering. It's been considering options regarding store closures and debt restructuring for about a year, has hired advisors to help them do this. But again, nothing imminent, but the market can care less. JCPenney's stock is getting absolutely hammered today in the session, as it should be.
Hey, Brian, it's Julia. I went through JCPenney's annual report and $3.72 billion in debt, cash equivalents of only $386 million. As you know, sales in 2019 dropped 8%. And they talk about, look, we're highly levered. This is a big issue when it comes to the debt. And my question for you is, can they even invest in their business at this point? because at some point you have to innovate, because clearly we've seen department stores just get decimated even before the COVID-19 pandemic. So do you think it's too late, and where should they be innovating?
Julia, this is what investment looks like at JCPenney right now, a big fat zero. They have furloughed all their employees, and it was April. JCPenney's CEO, Jill Soltau, was supposed to step up to investors with the key investor day and chart out a 3-year turnaround plan. And they did launch a test store earlier this year, testing some new ideas, new store layouts, but all of that, you can just absolutely toss that in the trash bin right now. Right now, this is a company fighting for survival. Any chances of reinventing the company completely off the tables, also unclear. How they will emerge from a bankruptcy. I think it's people you talk to on the street, they're focused on debt restructuring, but does that include hundreds of store closures? This is a company that operates 850 stores that are now essentially closed. They need cash coming into the business. They just don't have that.
Let's talk about another, well, at least big box retailer, and that's Best Buy. They announced they're going to furlough 51,000 people. But in the past couple of years, they've kind of turned their business around. Do they have the wherewithal to get through the crisis?
Yeah, Best Buy's, you could lump Best Buy in with Walmart and Target and Costco, and even to a lesser extent, Adam, BJ's Wholesale. These are one of these retailers that have strong balance sheets, and they're selling stuff people need right now. In addition to that announcement today that Best Buy came up with where they're furloughing 51,000 workers, look at their sales. Quarter-to-date sales through March 20th grew 4%. A lot of these stores are now doing curbside delivery. Now, the flip side of that is that sales have fallen off since March 20th because they have closed 40 stores in the Northeast, and a lot of other stores are now essentially drive up and pick up things on the curb. But this is a company that will have a chance at surviving, very much so, and probably thriving coming out of this, because it could lead to a lot of other retailers, a lot of mom and pops, a lot of independents completely not even reopening.
All right, Brian Sozzi, good to see you, buddy. Wanted to let you know we're watching the sell-off on Wall Street. Not much of a change, although the Dow is now off more than 580 points. We have more Yahoo Finance for you right after this. Welcome back to Yahoo Finance. We're watching this market sell-off for you and want to let you know that some of the big names in social media tech, Alphabet is trading down, Facebook is trading down, Twitter is trading down, and a lot of it has to do with the obliteration of ad dollars that would have been buying ads on those platforms, but it has essentially evaporated. For instance, Facebook advertising is selling now at record low prices, and it's declined 35 to 50%. To help us understand what is happening in the ad space and how people can then use ad dollars to target appropriately potential customers. Joining us is Lisa Utschneider, the Integral Ad Science CEO. It's good to have you here. And you know firsthand about, the revenue pictures. You used to be at Yahoo a few years back. Give us an understanding of what people can do to better target ads, because those ad dollars are so important right now.
Hi, Adam. Thanks for having me. Great to be here. So, yes, we're definitely seeing across the digital ecosystem decline in April, back half of March, and now in April. We're seeing many marketers hit the pause button on their marketing campaigns. But what's interesting is it's vertical by vertical. There are some verticals where we are seeing uptick from a volume perspective. So verticals like pharmaceuticals, CPG, e-commerce, where marketers are seeing the opportunity to connect with consumers and the consumers who are consuming their brands. But then there are other verticals where we're absolutely seeing softness. So think of verticals like retail or automotive, food and beverage. And the other thing that we're seeing is that many marketers who are pushing the pause button, they're regrouping internally, they're retweaking their messaging and coming out even stronger as more empathetic brands, making sure that they're connecting with consumers in a more empathetic way.
Hey, Lisa, it's Julie here. So that's more from a brand perspective. I'm also curious in terms of where the advertising is happening. As Adam just mentioned, Facebook and Google, even those sort of fortress advertising giants, right, have seen a hit. So as you look across that landscape, who has been the most and least vulnerable? Or is it that everybody's getting hit, but the bigger you are, the less of a problem it's going to be?
Well, since we're all home and we've all been home for the past few weeks, we are seeing a shift in how consumers are spending their time, how they're consuming the news. More and more consumers are consuming their news online, digitally, via social media. So we are seeing greater engagements from a social media perspective. The other thing that we're seeing is an uptick in connected TV. So as more users are at home, they're streaming more content online. So I would say from a CTV perspective, streaming perspective, social media platform, the volumes are there. And again, in a number of verticals, marketers are hitting the pause button right now and seeing how Q2 unfolds. But many of the marketers and agencies that we've been speaking with, they are regrouping and want to see what it looks like back half of Q2 and into Q3.
Lisa, I want to get back to what you said about what brands are doing and how they're packaging themselves as these empathetic companies. Because I'm watching these ads, whether it's Facebook or Walmart. I mean, they are all, to be honest, starting to kind of look the same, which is the image of we are here for you in this time. And I'm wondering how effective that is. How sticky is that kind of messaging beyond this stay-at-home period?
Well, one thing, we actually are rolling out some research. We've really made a concerted effort over the last month or so to invest more in research so we can better educate all of our partners in the digital ecosystem. And one piece of research that we're rolling out early next week, what it talks about is consumers' perception of content. Everyone's now online, they're reading through content related to COVID. We're seeing an uptick and more users want to learn about the virus, but also about consumers' perception of brands adjacent to this type of content. And what we're seeing is that consumers, they're 44% more likely to agree and be and engage with brands that are adjacent to content related to COVID that's more positive. So think about the hero stories. Think about the stories about healthcare workers, the exceptional work that they're doing, or people who are volunteering in their community. That's an area where consumers are saying, okay, I'll lean in and I'll engage with those brands that are adjacent to that type of content.
So help us understand how, for instance, our customers, our consumers here at Yahoo Finance, we know that people are hungry for reliable information. We had a story yesterday on Johnson & Johnson and their vaccine acceleration that's trending well over 300,000 in less than 24 hours. How does that turn into, if I'm a consumer on this platform, the kind of advertising I might see going forward?
Well, again, what we're seeing is many of the marketers, some are hitting the pause button completely, some are reworking their messaging, coming out with a more empathetic message. And then there are other brands like Coke did publicly a couple of weeks ago where they said, we're going to hit the pause button on our advertising and focus on philanthropic efforts. So I definitely think we'll see more and more marketers coming back out with more empathetic messages, and then also companies who are doubling down in philanthropy.
Lisa Utschneider is the Integral Ad Science CEO. Good to have you back here at Yahoo, even though you left a few years ago. Thank you for helping us understand what is happening in this space. When we come back on Yahoo Finance, want you to know that we have got a major interview coming up in the 12 o'clock hour. Stacey Abrams, the former gubernatorial candidate in Georgia, the woman who very well could be Joe Biden's vice presidential pick. She's going to be right here. It's an exclusive you don't want to miss. Welcome back to Yahoo Finance. We want to bring in a frequent guest of the program, Rutgers University professor, former chief economist at the U.S. Department of Labor, and chair of the National Academy of Social Insurance, which is, by the way, a partner of the Funding Our Future campaign, a group we feature each week only on Yahoo Finance, who advocate for a secure retirement for all Americans. Bill Rogers. Good to see you, Bill. And want to get right into the issues that we are watching as this economic meltdown is not only devastating, paychecks, but it's devastating the future for a lot of people. Is there anything that people who are dependent on these stimulus checks, which are going out right now, can do to protect their future? I'm at a loss here.
Well, yeah, I mean, it is tough, or it's odd, right, to having a conversation about the future when you're getting these, the various data reports that came off this morning that just reiterate the importance of we just got to save today. But yes, there are. And, at the Academy, we've been around for over 30 years. And, and our mission is around educating policymakers and increasingly, I've been calling it our Main Street initiative and educating folks out on Main Street about the importance of social insurance. That, first, I think people have to understand, why is it that, that unemployment insurance checks that are coming out, that would have been coming out without the third phase, we're so little. Well, one was, we had governors in states that were using the trust funds, the unemployment insurance trust funds, to pay for car taxes. We've been debating for over decades on how to help contingent workers or 1099 workers when they lose their jobs. And so I think going forward, particularly with the fourth tranche of recovery or rescue money, I think people have to begin first being engaged, politically engaged. And it doesn't necessarily mean I'm being Democrat or Republican, but you need to be communicating with your members and say, this is how I'm hurting. And for another example, the president wanted to cut the payroll tax. That would be very, very detrimental to Social Security and making things much worse in the future. So the first point is I think people have just got to be politically engaged. That's what I tell my kids, my young adults. You've got to be politically engaged.
Hey, Bill, it's Julie here. I'm curious how that message has been received. And I don't mean necessarily by constituents, but by policymakers and lawmakers right now, because obviously much of the focus is on the current state of affairs and dealing with this pandemic. Coming out of it, I wonder if there's going to be more willingness or less to sort of reconsider the social insurance programs that are out there.
Yeah, well, it's a great question, and in my sense and how my on it is, and I talk about it is, another 70s reference. There was the old Fram oil filter commercial where the mechanic was talking to his client, and he basically said, you really need to, just spend those few dollars on your air filter. Otherwise, you're going to pay me now or you're going to pay me later. And we have another opportunity to be able to make those payments now. That just as we talk about a physical infrastructure, bridges and roads, we have a social insurance infrastructure that needs to be fixed. And unlike past recessions, such as the Great Recession or the 1981-82 recession, right, this downturn has gone up the income scale. It's moved out from central cities into suburban areas, and so the reality of that when people have difficult times, it is not because people are lazy. We have a society, an economy, a globalized society, right, where there are new risks that have emerged, such as this coronavirus. But the other piece of it too is we have also not invested in our social insurance infrastructure. And so what's happened now is, many of the viruses today is showing that many American families, all hardworking families up and down the income scale, right, that the effects of the virus are and the risk associated with the virus are such that it's virtually impossible for each individuals and small communities and even states to handle. And so we're going to have to get back to a pooling of resources. And this is not communism. This is not socialism. This is about doing the right thing and investing in Americans.
Bill Rogers from Rutgers University is a professor there with an incredible background. You should see his resume, not only the U.S. Department of Labor, but a guest on this program frequently who we appreciate. All the best to you. Stay healthy. And more Yahoo Finance after this. We're watching these markets sell off. Inez Ferre covers the New York Stock Exchange for us. Inez, what more can you tell us?
Yeah, right now, Adam, we're looking at the Dow that's down more than 600 points. But I want to show you what's happening with some of the airlines, because some of them are in the red. The airlines which have come up with an agreement with the Treasury Department for payroll grants. That's part of that stimulus package. And this money is really to keep their payrolls in place at least through September 30th. So they can't furlough, they can't fire employees because they have this grant money now. So just let's take a look at some of these airlines and how they're moving. Year to date, you can see how much they've lost. American down about 60% year to date. Today, it's slightly under pressure, down more than 2%. American was approved for $5.8 billion. That aid is going to come in two forms. First, a grant for $4.1 billion, and also a low interest rate loan of $1.7 billion. Let's take a look at Southwest. Love is down more than 5%. Southwest expects to receive $3.2 billion, more than $2 billion of that in payroll support, and close to $1 billion in the form of a low interest rate loan. And very important also, Southwest cannot buy back shares until September 30th of next year. That was one of the requirements. And then just taking a look at Delta, that's under pressure. Delta came up with a deal of $5.4 billion. And remember that the Treasury had said that the Treasury Department said it would take some equity in some of the airlines receiving aid. Well, Delta says it will give the government warrants to acquire around 1% of Delta stock at the closing price on Friday over 5 years. Delta today down more than 4%, Adam.
Inez Ferre, thank you. Thank you for being here for this first hour. But in the next hour, we've got Tracy Abrams coming up, possible vice presidential candidate for Joe Biden. More Yahoo Finance right after this.
You're watching Yahoo Finance Live. I'm Julie Hyman, and we have a sell-off underway in stocks. We've got the S&P 500 trading lower by 2.8%, the Dow off 2.6%, and the NASDAQ down by 2% in today's session. Also, crude oil prices are taking a hit of 3%, and they're trading below $20 a barrel. Had a lot of economic data to digest today. Let me just hit some of it for you. For the month of March, retail sales fell by 8.7%. Also for the month of March, we saw the biggest drop in industrial production since 1946. That was a decline of 5.4%. We also got some April numbers, and those were equally, if not more dismal. Empire State Manufacturing, New York State Manufacturing, showing a reading of negative 78.2 in April. That's an index. And then home builder confidence saw its biggest 1 month drop ever in April as well. So obviously economic data pretty dire out there. This as we also got some more earnings from the banks, Bank of America, Goldman Sachs, Citigroup, all of them reporting steep drops in profit of nearly 50% for all three of them. So a lot to digest in today's session. This as on the coronavirus cases side, Johns Hopkins now reporting more than 2 million cases globally. A lot to get through over the next hour. Joining me to help are Adam Shapiro and Rick Newman. And I also now want to bring in Rob Almeida to talk about what's going on markets-wise. He is the MFS Investment Management Global Investment Strategist. He is joining us from Boston. Rob, it's good to see you. I hope you're well. And so we're getting all of that economic data. We're getting these earnings reports as well that are showing companies really struggling with this and figuring out how they're even going to offer forecasts right now. With all of that said, is this a time to reassess whether you want to get into the market or take a different kind of a look at your portfolio?
Sure, Julie. Well, good to see you all. And this might be too simple of a response, but I think you know when the bear market is over, when people stop asking that question. Bear markets get everyone. And I'm not sure if investors have experienced enough pain given the severity of what's happening. I think when we entered 2020, the risk from our perspective was profit fragility, given how they have been sourced this business cycle. And so I think the virus has exposed that fragility and made it, unfortunately, just materially worse.
Rob, hey, it's Adam Shapiro, and I'm curious because so much has changed, not only for people who manage money, but for investors. And one of the things you point out is that today companies are prioritizing liquidity, and you said at the expense of current and future margins, dividends, and stock repurchases. Do you see ever go back to the way it was before the economic shutdown, or is this the new normal going forward?
No, I think it's the new normal for recessionary times, and then we'll go back to that. But I think between now and then, what you see is larger than expected profit losses. I think you see below average recovery rates in earnings, and I think the market is expecting, unfortunately, something a bit greater than that.
Rob, hey, Rick Newman here. Could you give us some sense of what timing the market is factoring in? I mean, this is one of the great unknowns right now is when will we have the virus reasonably under control and when can some economic activity resume? How do you interpret the markets answering that question right now?
No, it looks like Rob's shot might be a bit frozen for us, so we'll check back in with him in a bit to see if we can get him back once hopefully it's working again. Yeah, I think Rob is still a little choppy here. So I want to move on for just a minute. Maybe we can get back to Rob if we get our tech stuff fixed there. But I want to bring in a political element to all of this because as we debate when is safe to reopen across the United States. There's been a debate between President Trump and the individual governors of various states, and also a discussion about legally who has authority to reopen. We are joined now by Mark Tushnet. He is a professor at Harvard Law School who specializes in constitutional law. Professor, if you can unmute your mic, we can discuss who perhaps is correct in this situation. First of all, there is some precedent for this kind of situation, not necessarily closing and reopening of economy, but certainly the federal government coming in and imposing strictures or making rules above the protest of individual states, correct?
Yes, there can be circumstances. The president would have to rely on some statutes that would authorize him to essentially directly order businesses to operate in their normal fashion, overriding local prohibitions on it. The statutes that are most obvious ones deal with things like defense production and similar national security things. There may be others. it'd probably be a stretch to find statutory authority to direct that convention centers or sports arenas, and of course, business, restaurants and bars, authority to open them. But maybe there is somewhere some statutory authority to do that. The president's walked back his claims, of course.
He has walked back those claims, but there is a role for the federal government. It's not an apples to apples comparison, but in the 50s, we had President Eisenhower actually federalize the National Guard in order to help integrate the schools in Arkansas. So at this point in time, what is the proper relationship with federal government and state government in the terms of this discussion?
From a constitutional point of view, probably the most straightforward thing is for the federal government to take a role in encouraging, counseling, advising governors about what the national interest, how they can serve the national interest. Mandatory things are more extreme and are likely to face both political and legal pushback to the point where by the time the legal questions are resolved, the forced mandatory things from the federal government probably wouldn't be required anyway.
Hey, Mark, Rick Newman. I'm wondering if businesses would potentially face any legal liability if they opened too soon and somebody got sick, whether it would be customers or workers. I mean, could they be sued for putting people in harm's way unnecessarily?
An academic's answer to that kind of question, if you ask the question, could they be sued? The answer is always going to be yes, whatever it is, under any circumstances. The chances of succeeding if they reopen, of a lawsuit succeeding if a business reopens pursuant to a directive of some sort from the national government, chances of prevailing are probably pretty slim, not zero. But if I were operating a business, I would be cautious about reopening unless there were some sort of statement from state authorities that the legal situation is back to where it was before the closures.
I'm curious, how would you grade the president and how he has dealt with the governors? We keep seeing the governors, in some respects, praise the president, but there's a concern that they're essentially just kissing his backside to get the necessary devices and medical supplies they need. And, they're cowing down to kind of King George. How would you grade all of this?
So the president's most extensive claims of authority are clearly overstated, if not qualified, if they weren't qualified. When he says, or I think Vice President said, I can get you a brief on that, that's really what happens. These are not people who are making careful legal claims. They're operating in a sort of general environment of what sorts of things do they think they should be able to do. And I wouldn't grade a student for making that kind of claim. What I would grade would be the brief, which we haven't yet seen.
And so ultimately, even though as we've been talking about, the president has backed off to some extent, do you think that we will see more of a showdown? And do you think that that ends up going to court?
I think that it's unlikely that there'll be any kind of showdown or even a court case because two things. First of all, the president can accomplish, I think, maybe all, but certainly nearly all that he wants politically to accomplish by asserting, by encouraging and counseling governors about what he thinks they should do. And then secondly, it takes time for litigation to occur. And by the time anything would happen, lots of changes will have occurred in the domain of what we're calling reopening the economy.
Right, makes sense. There is an urgency level here, certainly. Professor Mark Toshnet of Harvard Law School joining us from Washington, D.C. Thank you very much, sir. Appreciate it.
You're welcome.
I just want to bring you some news just coming out from our parent company, Verizon. They have now extended some discounts to more frontline workers. It had been available to doctors. Now, more discounts for nurses on the front lines and teachers as well. In addition to military and first responders who are already eligible for this, they can benefit from up to $40 off when they combine Verizon Unlimited Wireless and Fios internet plans. Also, Verizon's making a $45 million donation to relief efforts. Well, coming up next, we are going to be speaking to Stacey Abrams, a former gubernatorial candidate in Georgia, about what she's doing now, how concerned she is about the South's exposure, both economically and healthcare-wise, to coronavirus, and her chance of being perhaps a vice presidential pick for Joe Biden. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. As the cases of coronavirus globally top 2 million, we learned late yesterday that President Trump was going to be halting funding, whether temporarily or permanently, we don't yet know, to the World Health Organization. The WHO in response has said it is trying to look for alternative sources of funding to plug the gap. Rick Newman, the president said he wasn't happy with how the WHO has handled this pandemic, in particular, its sort of credulity in believing China's numbers. Is there precedent with this kind of situation?
My understanding of this is there is a little bit of legitimacy to the idea that the World Health Organization may have gone easy on China early in the crisis. But on the other hand, the WHO said at the end of January that this was a worldwide emergency. I mean, they were telling everybody, we all need to be paying attention to this. And that was 6 weeks before President Trump actually declared a national emergency here in the United States. And we know that during those 6 weeks, Trump many times said things like, don't worry about the virus. It's only a couple of cases here in the United States. We have it under control and so forth. So My guess with regard to the funding for U.S. funding for the WHO is that I think that funding is going to remain there. I don't think Trump is actually going to stop that funding. And I think that's because, we sort of are seeing how Trump operates here. The MO is during every coronavirus briefing, there's some narrative, some new theme, some new villain or scapegoat. And then Trump gauges the public response to that. And if the public response is poor, he changes his plan. So just as he backed down from telling the governors what to do, because there's been really broad condemnation of the idea of pulling funding for the WHO in the middle of the worst pandemic in decades, I think Trump is not going to do that.
Rick, I'm taking the politics out of this. Who actually listens to the World Health Organization? We're in the developed world, but in less affluent societies, they play a crucial role. And they just issued the 6 points to reopen economies. Disease transmission has to be under control. Health systems have to be able to detect, test, isolate, and treat every case and trace every contact. Okay, maybe in the United States, that is an aspiration we could achieve one day. But in parts of Africa, in parts of South America, really?
Right. Let's keep in mind that WHO is part of the United Nations. The United Nations in general is not a muscular governing body. It has no governmental authority, but it's a clearinghouse for information. It's a place where different nations can share information. So I think here in the United States, agencies such as the FDA and the CDC, they coordinate with the WHO to figure out what is going on around the world. What do we need to be doing to prepare here? And there, apparently there was some coordination like that at the beginning of this pandemic. If you go back to January, just not enough. There's probably plenty of blame to go around here, but it just does not seem like the right time to, threaten closing the one worldwide organization that's monitoring this pandemic.
Rick, speaking of timing, there was an unexpected announcement today from Apple. They announced a new iPhone, a $399 iPhone SE. Our Dan Howley is covering that announcement for us. This was a surprise, right, Dan? And where does this phone fit into the lineup? Why? Why did they make this announcement today?
It was a surprise, and it wasn't. We've been expecting a new SE for some time, but we didn't know when we were actually going to get it. There were originally rumors that it was going to drop in March, and then obviously with the global pandemic, Apple was smart enough to push off the announcement. So what they did was they launched it virtually, basically. And this is a phone that looks and feels a lot like the iPhone 8, believe it or not. It has a 4.7-inch display, so it's going to be smaller than what you find on the 11, 11 Pro, and 11 Pro Max. And I know a lot of people have been looking for a phone along those lines. And it doesn't have Face ID. It has Touch ID, so you get that fingerprint sensor back. Another thing that a lot of people have wanted. But this phone starting at $399 is a big deal because it allows Apple, believe it or not, to really start pumping on all cylinders in India. That's its next big market that it's looking to conquer. China, obviously, they do well there. They have a lot of competition from established names there from the local market. India is going to be a chance for them to expand. And so far, they've done well. They saw 20% year-over-year growth prior to that. The issue in the previous year, but the issue is the phones that they sell currently are too expensive. So this $399 model will do incredibly well for them going forward in India. They're going to open their first brick and mortar store there next year, and they launched their online store there this year. So it's really everything going towards India at this point.
Well, we'll see how many of these phones they can sell, though, when India is shut down.
Right. Yeah. And that's going to be the issue, right? You're going to have the ability to purchase these phones online. There are resellers there in India that will be able to sell it online. Globally, Apple stores are closed. The physical brick and mortar stores are closed, but you can order online. The only place the stores are open, believe it or not, is Greater China. So it's going to be an issue for them. But I think if they can get the phones out the door, it should be all right.
Dan, where are they going to make it and how are they going to ship it worldwide? The global economy shut down.
Yeah, they're still going to be making them out of China. These are some of the phones based on the iPhone 8, obviously. So they still have factories built out to be able to produce these. They were still selling them in certain areas. So I think that's going to be kind of a minimal issue. Really, the amount of people that are able to purchase it, 16 million in the US are out of work. I'm sure the last thing they're thinking of right now is purchasing a new smartphone, regardless of how inexpensive it is compared to the $1,000 starting price on the iPhone 11 or 11 Pro. I think this is a time for Apple to, while it is difficult for a lot of people, it is the right time for them to launch a device of this type. And I think they recognize that, look, we're going into recession. We might as well get this phone out before it gets any deeper.
Thank you, Dan. Well, those shares today, by the way, are down by about 1.5%. We'll be right back with Stacey Abrams. You're watching Yahoo Finance Live. I'm Julie Hyman. Thank you for joining us. Well, as we watch the coronavirus make its way across the United States and the globe, we also, of course, in the background have a lot going on in the world of politics, with just yesterday, President Barack Obama endorsing Joe Biden for president. We're joined now by a woman whose name has been talked about as a potential vice presidential pick. That is Stacey Abrams. She is Southern Economic Advancement Project founder and executive director. She was a gubernatorial candidate in Georgia as well as a state representative there. Stacey, thank you so much for joining us.
Thank you for having me.
So there's an interview with you just out today in Elle magazine where you say, I would be happy to be the vice presidential pick, which is perhaps refreshing that you were frank about it when asked by the interviewer. As you know, you've been on a lot of lists here. First of all, I'm curious how important you think the vice presidential pick for Joe Biden is this cycle around, because as we know, he's 77, he's had some health issues. So do you think it's more important now, and why do you think you're the right person?
Well, first, I think that the health of the president is always important. And I think that Joe Biden is hale and hearty and ready to do this job. And when he is elected, will be capable of doing this job for the duration of his term. And I think that is why we as a party have rallied around him, because we believe he is capable of doing this job. And I think the vice presidential pick always matters. But I think there are two parts to it. There's winning the election, and then there's actually serving as lieutenant. I've been in a very awkward position of being asked this question since March of 2019. And one of my beliefs is that if you're asked a question, you answer it. And so I've tried to be very honest and transparent, and sometimes that's a bit off-putting. But as an African-American woman, as a woman of color, and as a person of color, I find it very problematic to reject the notion of opportunity to play into the sort of traditionalist notion of demurral, because I believe in diversity of leadership. And one has to be willing to say you're willing to serve. And I think that my mix of private sector, public sector, and nonprofit leadership prepares me to be able and capable of serving in that role if I am so honored.
Tracy, hi, Rick Newman here on the other side of the internet. You've heard the criticism that you may not be ready yet for this office because you haven't yet held a federal or a national job. What's your answer to that?
That is the wrong metric to use to determine who would be effective in this role. First and foremost, leadership and management experience does not simply come from being in federal office. That's why we have elected folks who have not been in federal office. But more importantly, what we need in this moment is someone who can help rally the communities that we need to have engaged, who can help run an effective government. And I have done that. I've been an effective leader at every level of government. I may not have been in the federal level as an elected official, but I've developed an 18-state network that has worked with local, state, and federal leaders to build the strongest voter protection apparatus this country has seen. And I believe that those are transferable skills. But more than anything, I know that I possess the intellectual capacity and the intellectual curiosity to be an effective leader. I work well across the aisle, and I work well with all of our folks in our communities. And so I believe I would be a strong leader and would be more than capable of doing this job.
Stacey, it's Adam Shapiro, and thank you for giving us permission to address you by your first name. You are quite accomplished when I look at your bio, and you did study public policy at the University of Texas, and never before has public policy been so urgently needed in the United States. So help us understand how you will connect with people who don't know you from Georgia in the middle of the country, because now more than ever, we need that leadership on public policy.
Absolutely. I think there are three things. One is that my work has not been solely limited to Georgia. And I think it's important to understand that in Georgia, we have a part-time legislature, which means that I've had to make a living and build community, build companies while I was serving in the legislature. I was extraordinarily successful as Democratic leader, but I was also a very effective small business owner, and I was a very effective nonprofit leader. Since I did not become governor, I've traveled this country. I've been to more than 25 states, working with leaders in every one of those states. And we turn out hundreds, if not thousands of people to come and participate. But to your point about actually thinking about the administration of government, I was a bureaucrat before I ran for office. I worked in government. I had to think about how do you take the laws passed by well-intentioned legislators and turn it into the active work of running a government. I worked with one of the most fantastic mayors in the country, but more than that, I've spent my adult life learning and practicing this work. And so I come at it from someone who's had the experience of working not only in government, but understanding how government works with others. I've come at it as someone who has intentionally developed a foreign policy background that is, I would say, fairly strong for someone who has not been in the Senate or in foreign service. But most of all, I bring to it the ability to work across the aisle and to work across communities. And that, I think, are the three things we need heading into this next administration.
Stacey, what is your faith in the political process at this point? Because you have your own experience in Georgia and a contested election there. You have what we just saw happen in Wisconsin. And then, of course, we have the election in the fall. And there have been a lot of questions about how that election is going to be conducted. So are you concerned at all?
Well, I believe in the trust but verify approach to politics, which is that we have a democratic system that is capable of withstanding the travails of a pandemic. But we have to have the willingness to acknowledge our flaws and the work that we have to put in to fix those mistakes. One of the reasons in my 2018 campaign, I acknowledged the legal legitimacy of my opponent's victory, but still challenged the system, is that we have to be willing to do both. We can have an election that is fair and that is accurate, but we have to do the work to make it so. That's why I believe the next CARES package has to include funding for our states to move to more vote by mail, not because we can replace in-person voting, but because our responsibility is to make it as safe and accessible as possible. That means getting as many people out of line as we can so that those who need to be in line can do so safely. And that can only happen if our federal government invests in our states today so they can plan for, prepare for, and execute safe and effective elections in November.
Stacey, there are some Democrats who are very worried that the Trump administration and perhaps some Republican governors or Republican state officials allied with Trump could actually cheat in the November elections. Is that a realistic concern? And if it is, how would that happen? What would it look like if Republicans would try to, whether it would be try to deny Democratic votes or pump up Republican votes? I mean, what are the real vulnerabilities here?
Voter suppression has three effects, or has three pieces. First, it's can you register and stay on the rolls? And so we have seen attempts unfortunately in recent years, by Republicans to limit who has access to actually getting registered and staying on the rolls. And it's why we also have seen an aggressive, we've seen more aggressive voter purges across the battleground states. And so we have to make certain that people can get on the rolls and stay on the rolls, especially during a time when getting back on the rolls is almost impossible because people can't get to our county clerk's offices, and not every state has online registration. The second is, can you have access to a ballot? That's why voting by mail is so critical, because we need to make certain as many people as possible can access their ballots without putting their lives at risk, which is what we saw happen in Wisconsin last week. And then the third is making sure those ballots get counted. We know that there are certain states that have higher levels of rejection rates for absentee ballots for people of color and for communities that are considered undesirable. And so the best way to ensure a fair and accurate election is to ensure that as many eligible voters can participate as possible, that we remove as many barriers as we can and remain safe and secure, and that we acknowledge that voter fraud is almost non-existent in this country. Almost every example of voter fraud is by and large attributable either to confusion or to mistakes. And so we should not be focused on the false worry of voter fraud, which in fact, President Trump had to dispel when he disbanded his voter fraud commission. The issue is voter access, and that is something we can do together. I don't think people are going to, by and large, cheat, but I do think using voter suppression is a way to silence the voices and to steal the election from those who should be able to participate. And if we as a nation say that we want as many eligible voters as possible to participate, then we will have a safe and secure election.
Stacey, I want to pivot a bit and talk about what's happening there in the South right now. Because again, you are the founder and executive director of the Southern Economic Advancement Project. There has been a lot of talk about how the South is more vulnerable in some ways to this coronavirus pandemic, both health-wise and economically. What are you seeing, and what actions are being taken on the ground to try to address some of that?
The CARES package that came out a few weeks ago was an important start to responding to COVID-19. But what we have to understand is that in the South, we have the most vulnerable and the least resilient populations. We tend to have lower levels of public benefits. Even though we have more people who rely on them, the amount they receive from those public benefits tend to be less than in other regions of the country. We have a lower rate of people who have access to paid sick leave. And because by and large, we have service-based economies, these tend to be lower paid workers who are the most easily removed from their jobs or have their jobs disrupted. And so the challenge we are facing is that we have all of these constraints and we do not have the security of a public health system that can withstand it. Part of the challenge in the South is that half of the states that have refused to expand Medicaid are southern states. That means that not only are you at greater risk of exposure, you have less opportunity to be tested and to be treated. We have seen more rural hospitals shut down, and that cuts across race. But we also know there are racial implications to the systemic inequities that exist in our cities and in our communities in our states in the South. The solution is three things. One, we need to increase and dramatically reinvest in those public benefits. For example, unemployment insurance is very low paid in the South. And so while the $600 that have been added is important, we have a lot of folks who simply can't qualify because of how the rules have changed for access to unemployment benefits. Number two, we have the healthcare crisis of not having enough doctors and enough hospital beds. And I live in a state where the fourth highest rate of coronavirus, the fourth highest coronavirus rate is in Albany, Georgia. And that's the fourth highest in the world. That is endemic, and that is absolutely demonstrative of why we need a stronger public health system and why we need southern states to expand Medicaid now. And lastly, we need to recognize that for millions of Americans, especially those in the South, they will not receive the guaranteed $1,200 stimulus check because they're unbanked and because they're outside of some of the economic systems that we're relying on. There are a lot of them who do not have to file taxes because they make so little money. That means they will not automatically receive the resources they need when they are the most vulnerable at this moment.
Stacey, I'm curious, could you bring up the Medicaid expansion in Georgia? And the governor there proposed in November a kind of half-hearted expansion with conditions. You had to be fully employed or you had to be in school. And what strikes me in this crisis is if someone has coronavirus, whether they're employed or in school, doesn't matter. They're still they can get the rest of us sick. So has the governor there listened to these pleas about you really should expand Medicaid to this kind of system, or is it still in traction?
Unfortunately, there's been no movement, and it is unfathomable to me why that would be so. This is not a partisan issue. Republican governors, Mike Pence expanded Medicaid. The state of Kentucky expanded Medicaid. So this is not a partisan issue. This is an issue of morality. And unfortunately, the current governor of Georgia does not believe that access to healthcare should belong to those who are in need. And what he is also ignoring is the likelihood of transmission, because people who may be asymptomatic and have to go to the poultry processing plant to work, or who are in service, essential service working jobs, because Georgia's number one industry is agriculture. We have a lot of essential farm workers who cannot get access to the healthcare they need and cannot prevent themselves from spreading the disease. Expansion of Medicaid could solve problems and save lives. And it's also a gateway to economic recovery, because in the states that have expanded Medicaid, they've seen their cost of healthcare go down. They've seen the numbers of jobs expand. And most importantly, new jobs come to places where healthcare is possible. And so I do not understand the recalcitrance of the current governor, but I can tell you that one of the best solutions for the 7 states in the South and for the 14 states in the nation who want to survive and thrive after this crisis is over is expansion of Medicaid.
Stacey, I wonder if before you go, you could just give our audience some idea where you stand on the Democratic spectrum. Do you support Bernie Sanders style Medicare for all and eliminating private insurance, or do you lean more toward Medicare for more, but keep private insurance in place?
Well, I live in a state where we're trying to get Medicaid for some, so that's where I begin my political beliefs. But here's where I am. I'm a pragmatic progressive. I grew up in and live in the South, and I understand the necessity of having the broadest vision possible for what we should do, but understanding the necessity of getting to where we can get these things done. I support private insurance. I think that we have to make certain that people have the options that they need, and that those options have to be reflected by the realities of where they live. I live in the South, and there are simply some ideas that are unfathomable because they cannot be put in place because of the structural inequities and just the structural differences of where we live. One of the reasons I am so excited about Joe Biden is that he has always believed in moving forward, but he understands that there are moments where we have to pause to let people catch up. You can move so far ahead that no one can see you, which means they can't follow. And so my belief is that I want to see us make progress from where we are, but we have to understand that we have 50 states in very different places. That's why I focus so heavily on fair fight, making sure that everyone has the right to vote and therefore say the future they want to see, that we have fair count, which is working to make sure that the census is in place and that hard to count communities are being reached across the country, because we have to be able to access the $1.5 trillion that gets allocated, but also the political power that will be redistributed in 2021, and why I founded SEEP, because I know that in the South, if we can solve the economic crises that we face in the South, if we can build the type of equity possible, then we can do that for America. And so I'm a Southern progressive, meaning I know where I start, but I know where we should end up.
Stacey Abrams, thank you so much for your time for us today. We really appreciate it. As Stacey mentioned, she founded SEEP, the Southern Economic Advancement Project. She is joining us from Georgia, I believe. And be well, Stacey. Thank you so much. Again,
thank you all. Take care.
You too. We'll be right back.
watching Yahoo Finance live, and I'm watching markets go down today. The S&P 500 right now off by 2.3%, a combination of economic data that shows really the acceleration in declines that we have seen for the U.S. economy, as well as some disappointing earnings. Inez Ferre has got some details on today's action for us. Inez, good to see you.
Nice to see you, Julie. And let's just take a look at what's happening right now with oil, because oil is under pressure. There's concerns, of course, of demand for the collapse in demand of oil. And the International Energy Agency, the IEA, came in with a forecast of a decline in demand in April of 29 million barrels a day. Those are levels that haven't been seen in 25 years. Despite that output cut that was just announced a couple of days ago, the IEA says that production cut is a solid start, but that's not enough to really offset the demand in oil. And you can see that Brent is down more than 5% today. And just to show you over, well, let's just do a year to date to see year to date, it's down more than 50%. So crude has really been under pressure, of course, over the concerns on demand because of coronavirus. And then just taking a look at one of the tickers that is moving today, I just want to show you what's happening with Best Buy. Best Buy under pressure. This is after the company announced that it's furloughing some 51,000 employees. Its stores are closed except for curbside pickup, and the company saw a 30% decline in sales in the last month since stores have been closed. Still, though, it has 70% of sales. This is despite having gone basically online overnight. Its CEO, Corey Berry, she said that she and other board members will be taking a 50% salary cut, and anyone that is reporting also to her will be taking a salary cut as well. Year to date, the stock is down 25%. Today, it's down more than 5%. Julie?
Thank you, Inez. Appreciate it. Wanted to bring you the latest numbers from New York because we are getting some headlines from Governor Cuomo's daily briefing here. He said that the death count overnight, 752, down from 778 the prior day. So we're looking at perhaps a little bit of stabilization in that number. So he continues to talk about that perhaps flattening the curve is starting to have an effect. He did, however, just say it's over when we have a vaccine. All right, I want to talk about where we are seeing some medical workers being housed as we see some creative solutions for that issue, and also what's happening in the travel industry right now. For all of that, we're joined by John Gray. He is the CEO of RV Share. John, it's nice to have you here with us. So RV Share is a company that, much like an Airbnb or some of the other sharing economy companies, lets other people use your stuff when you are not using it. So what's happening right now where we're in this current stasis in the economy?
So yeah, usually right now we'd be leading into a busy season, booking out a bunch of trips to national parks, to music festivals, to things like that. But instead, those trips have basically gone by the wayside. Nobody is really planning trips in the short term. We're still seeing some come in for later in the summer, a bit later than we'd usually see. And most of our business has now switched to providing relief bookings. And when I say that, I mean, a doctor is going to the hospital all day working and then wants to come home, but doesn't want to, cross-contaminate with their family. So they'll stay in an RV out in their driveway. We're seeing the same thing with utility companies where they're putting, where they're isolating workers out near their facilities such that they don't cross-contaminate with the rest of the population. And then we're seeing also like medical use cases where people are booking an RV to take an immunocompromised person to an appointment that might be far away from their home, so they don't have to use types of mass transit to get there. So that's the sort of bookings we're seeing right now.
John, it's interesting because there used to be the old adage, if you looked at what's happening in Elkhart, Indiana, where they make so many of the RVs, you'd get a sense of what's about to happen in the economy. The RVs that you're sending out, do they have to go through any kind of special cleaning or, disinfection process?
So we've basically, so our owners provide RVs for travelers. We connect the two of them, right? So we have sent guidelines to our owners from the CDC on how they need to be cleaned. And then what we're also seeing is when people pick up the RVs, they're cleaning them again themselves, right? To make sure that they're as clean as possible. we're also pursuing right now some partnerships with professional cleaning companies that will help do that going forward. But I mean, that's where they are today, is we're providing recommendations and getting them as clean as we possibly can.
Hey, John, Rick Newman. RV travel sounds like something that might bounce back earlier than other types of travel because you're self-isolated in a way if you're just driving across the country. Are you anticipating that? And might that happen by this summer, or do you think this summer is a wash for RV travel?
So we're hopeful that that happens by this summer. I mean, I'm not a public health expert. I don't know when, when we'll be able to travel again safely. But when parks are back open and things like that, this is a wonderful way of getting outside without having to be around a bunch of people. As you said, kind of self-isolating with your family or the group that you're traveling with. And we do think it provides a great option for that. So yeah, when we're back to traveling, we think we will bounce back quickly. We're also, a U.S. business that's focused on domestic travel. My expectation is that domestic travel will bounce back far more quickly than will international travel.
John, Julie again. So aside from the work that you're doing right now with RVs for MDs, I imagine there's not much going on. So how do you survive until that upswing hopefully comes? Have you had to furlough folks? Are you trying to get some of that PPP money from the government? What are you doing?
So, as with most businesses in America, you're right. We're trying to survive right now. We have furloughed some staff. We have, we are looking into government programs and trying to get funding that way. And, there's some things like the payroll tax deferrals that are applicable to us. And those are all wonderful. But, ultimately, we need bookings to come back to be a viable business, just like most people do. So what we're doing with our staff right now, though, is we are spending the time building the best product we can, doing as many of these relief style bookings as we can, and hoping to come out of this with a much better process for booking RVs, and a much better product to view them and see them. We plan to emerge from this as a great business. We were changing the way people travel up until a month ago. We're a bit interrupted on that right now, but we plan to continue doing that going forward.
Well, John Gray, all the best to you. John is the CEO of RV Share. He joins us from Austin, Texas. Well, coming up next, as we watch what's going on in the markets today, we're going to talk about Tesla and an analyst recommendation change. We'll be right back. You're watching Yahoo Finance. I'm Julie Hyman. We're seeing market sell off today, but one stock in particular has been getting a bit of a lift. That is Tesla. The shares right now up about 2%. And that's after Goldman Sachs reinitiated coverage of the stock with a buy rating. Rick Newman, what's behind this recommendation? Tesla has been sort of all over the map.
It has been all over the map, and it's been all over the markets. But let's start by saying, right before the crisis in the first couple of months of the year, Tesla really did seem to be stabilizing as an operation. Seems to have worked out the manufacturing kinks, more predictability in its orders and its finances. And Goldman is one of several firms saying, look, we think Tesla is really well positioned for the future because they've got this lead in electric vehicles. It's the only thing they do. And one thing that's probably going to happen as all the other automakers, the big ones, face real financial stress is they're probably going to cut R&D into things that are secondary to what they do. And that is going to be electric vehicles. They're probably going to be cutting R&D. And Goldman's also pointing out that Tesla really does have the lead in over-the-air updates. Those are the software updates they can beam directly to the car, which actually can change the functionality of the car. Tesla really has an advantage there. It looks as if Tesla does. We know Tesla has first mover advantage in the market for electric vehicles. And Goldman, like other analysts, think that is going to give Tesla an even bigger lead than it may have had just a few months ago.
And they talked about also having the compound annual growth rate well over 20% for the next 5 years. I'm curious, all these discussions, Rick, about how the world's going to change after this with people working at home. There's some other things happening now. The air is cleaner in India, in China, in New York City. Are people going to go back to cars the way we did prior to this crisis? Or are we going to learn, hey, clean air is something we really enjoy in Tesla. Here's a product you can have and it looks cool.
I think we're going right back to cars, depending on cars, the way we always have, because that's exactly what happened after the 2008 meltdown. One other factor here we should talk about is oil and gas prices. So if your interest in buying an electric vehicle was to save money on gasoline, that motivation is evaporating simply because oil prices are so low, and most analysts are saying they're going to stay so low. So there's part of the market that wants to move over to an EV because it seems like the right thing to do. They like the fact that it doesn't pollute, and the performance characteristics of EVs are pretty good. But if you're doing it because you're trying to save money on gas, that is not going to be a factor for the foreseeable future. That's one thing working against Tesla. And, we saw after gas prices hit $4 in 2008, that was a big shock in the industry. But look what happened. Gas prices came down, and we're driving bigger SUVs than ever. And that's what consumers want. They've just stopped caring about fuel efficiency for the most part once gas got cheap again. Sorry, Adam.
Yeah, I think that long-termism and looking at the pollution levels might be expecting too much of people. I don't know, Rick. I think you're probably right. All right. Well, again, those Tesla shares are rising by 2% today, well below the price target of that Goldman Sachs analyst, which is $864. They're trading in the neighborhood of $735 or so today. Rick just mentioned what's going on with oil prices. And as we take you out, just want to mention what's going on with oil. It is down about 1% right now, trading below $20 a barrel. A couple of things happened today that contributed to that drop. First of all, the International Energy Agency came out with a new demand forecast for this year, saying demand's going to fall 9.3 million barrels a day. So essentially wiping out a lot of the demand that rose over the last decade. In addition to that, we got the weekly crude inventories number here in the US, and we saw a build of 19.2 million barrels, a lot of oil sitting around because people are not driving. All of that helping contribute to a risk-off tone today. In addition to that economic data that we got this morning, retail sales falling by 8.7%, industrial production falling, empire manufacturing activity falling. And right now, the S&P 500 is falling by 2.3%. Keep it right here on Yahoo Finance.
Welcome into live market coverage here on Yahoo Finance in the 1 p.m. hour. I'm Zack Guzman, and right now we have stocks in the red. The S&P off by about 2.3%, as well as the Dow and the NASDAQ in the red as well by a lower margin for the time being. Right now on a sector-by-sector basis, energy is leading the way lower. We're seeing energy off more than 6.5% as crude dips back below $20 a barrel, again on concerns that the supply glut continues to be more of an issue as demand falls off a cliff in the wake of the coronavirus crisis here in the U.S. and around the globe. And today we got nasty economic numbers out on the retail front, also caused by the same slowdown and lockdown as more Americans stay home and do not go out to shop. Just incredible numbers when you look at them. Overall, retail sales for the month of March down 8.7% month over month. That was the biggest decline in records dating back to 1992. And I want to dig into the details right off the top of the show, since this has been what sent the market down since the beginning of today's trading session. And for more on that, I want to get to Heidi Chung, who has more on those terrible numbers. Heidi?
Zack, nasty is absolutely right here. The U.S. consumer actually getting hammered as the coronavirus continues to rip through the U.S. economy. And we have to keep in mind here that consumption does account for 70% of the economy. So this is very, very crucial here. Let's take a look at the main numbers. Data from the U.S. Commerce Department this morning showing that headline retail sales, like you mentioned, plunged a record 8.7% in March, which was worse than the 8% decline that was expected by economists. Now, core retail sales, which excludes the volatile auto and gas components, fell 3.1%, which was a little better than the 5.2% decline that was estimated by economists. Now, these numbers compare to a retail sales drop of 0.4% in February, and core retail sales declined 0.2% in the month prior. Now, breaking down the consumer activity by category here, clothing stores saw the largest sales decline of 50.5%. Furniture store sales falling 26.8%. Spending at restaurants and bars plummeted 26.5%. Department stores saw sales dip 19.7%. Sporting goods stores plunged 23.3%. Auto and auto parts sales decreased 25.6%. And gas spending falling 17.2%. But a little bit of bright news here on the other side of things. Consumer spending at grocery stores rose a whopping 26.9%. Of course, that's because there are a lot of quarantine measures in cities and states across the country. And so people are flocking to grocery stores to stock up on essentials. And we also have online sales increasing by 3.1% month over month in March. Now, these numbers are bleak, Zack, but economists are predicting far worse when it comes to both April and May, and just for as long as this really sort of continues here. But for now, the numbers not looking so good. The March numbers, of course, capturing the final 2 weeks of the month when things really started to gain steam here in the U.S.
Yeah, I mean, we're also seeing individual stocks trading lower off this. As you noted, apparel stocks, some of the hardest hit in those numbers that you just highlighted. Macy's shares off more than 7%. We're also seeing Gap shares off by about 10%. I mean, it is nice to note the uptick in grocery store sales, but clearly that's not enough to offset what we're seeing here. And as you noted, worse than a lot of people had been projecting. When you look at that data that we just got, of course, all the data mostly it tends to lag a bit. These are the numbers for March, but March still had some weeks across the board where people were not in lockdown, still out shopping. So that could indicate April's going to be even worse when we get those numbers. But I mean, when you look at the overall growth, retail, Heidi, makes up a pretty significant portion of the economy. And we got the update from JP Morgan Chase saying that it continues to expect a 40% annualized decline in GDP in the second quarter based on what they're getting here in these March numbers, and points to an even weaker first quarter as well. So generally, not any reason to believe that April's going to be any better.
Right, Zack, and you bring up a great point. I've been going through a lot of these economist notes this morning, following the retail sales data released earlier. And like you mentioned, we have JP Morgan saying that second quarter annualized GDP is expected to decline by about 40%. But keep in mind, the March retail sales data captures up until obviously March, and that's the first quarter. So like you mentioned, that's why we're seeing this big estimate of decline in GDP growth for the second quarter. And we can't exactly put a number on what we're expecting right now for April when it comes to retail sales, but it's going to be bad. I think that here is consensus. And so, yeah, we will definitely continue to monitor how this is really starting to impact all aspects of the US economy.
Yeah, people are already expecting it to be bad going in when we were getting the March numbers, and from bad to worse, clearly the update there. It wasn't just retail sales numbers, though, that we got this morning. There were other bad updates as well. When you look at factory output measured in March, also dropping by 6.3% month over month. That was the largest decline since 1946. So it's been a while since you've seen numbers this bad. The expectation was 4.1%. So again, you can come into this expecting things going to be bad and then get numbers that are even worse. And we're seeing why the market's down overall. We also got the updates from a few more banks, and it seems to be that the theme continues here after we got those updates yesterday from Wells Fargo and JP Morgan Chase. The theme seems to be more of these large institutions setting aside money for what's to come when they think about how some of their loans could sour here. We got the update from Goldman Sachs, Bank of America, and Citigroup. And I want to get to Brian Chung, who has the details on those banks. Brian?
Yeah, Zach. Well, some ugly numbers from America's largest banks, as you mentioned, Bank of America, Citigroup, and also Goldman Sachs reporting before the bell this morning. The big story that all three banks saw at least a 45% year over year decline in their bottom line. They had earnings that were just really terrible, especially in the historical context of how well these banks were doing headed into the COVID-19 crisis. You had Bank of America with a 45% year-over-year decline in earnings to $4 billion. They actually had the most on the bottom line among the four largest banks. You had Citigroup with a 46% year-over-year decline to $2.5 billion, and Goldman Sachs with a 46% decline to $1.2 billion. Again, on the bottom line. The big story, as you mentioned, Zach, is really the loan loss provisions that these banks are building in to their net income statements. They have Bank of America with provisions up to $4.7 billion, Citigroup projecting provisions of up to $7 billion, and Goldman Sachs with expected credit losses through their loan loss provisions up to $937 million. Keep in mind that their figure is a lot smaller because they're not nearly as consumer-facing as Bank of America or Citigroup, but still that figure is a fourfold increase year over year for Goldman Sachs. The big story, though, for these three banks, and the reason why they were even profitable in the first place this quarter, was because of their fixed income revenue trading. So when you consider that with all the volatility that we saw in March, actually a lot of these banks saw opportunity to make some money based on some of these fixed income trades. You had Bank of America with a 13% year over year increase. KBW, the analysts there, saying that exceeded their expectations. Citigroup fixed income revenue up 39% year over year. And then Goldman Sachs at $3 billion. That was their best performance, get this, in 5 years. So that was the real silver lining for these big banks in being able to squeeze out a narrow profit this quarter.
Yeah, and we've seen, the impact on the share prices today not equal there. Goldman Sachs being hit the least, only off by about 0.5%. When you look at the 5% moves to the downside in Bank of America right now. When we look at all this, though, Brian, of course, we've been looking into kind of how these banks are being supported right now by efforts at the Fed. When we talk about, short-term liquidity problems and trying to get these banks to step in, we'll be talking about the way that JP Morgan Chase is planning to change their mortgage requirements and applications. We'll be chatting with Shark Tank's Barbara Corcoran about that later on in the show. But we have seen some rules kind of waived here when we talk about Wells Fargo and how their restrictions in trying to help participate in the PPP program out there. I mean, clearly the Fed's trying to do everything you can. What's the sense when we talk about these banks playing their part as well in trying to help address the short-term problems we've seen?
Yeah, well, I was dialed into the media calls and also the earnings calls that a lot of these big banks were having. Keep in mind that yesterday we did hear from JP Morgan Chase and Wells Fargo. And the overarching story from these big banks is that we're part of the solution. And whether or not you agree with that, it is a fact that a lot of the PPP programs and then the Main Street lending program, which the Federal Reserve hopes to have up soon, will be dispersing loans to those small businesses and throwing them a lifeline during this really trying time. But it's only going to do that through these financial intermediaries. Keep in mind, it's not the Federal Reserve. It's not the government that's directly underwriting these loans to the bagel shop on the corner, the local restaurant, the local children's clothing store, right? The problem is that these banks are really the ones that are ultimately leveraging the relationships that they already have to underwrite those loans. So the banks are saying, look, we're the ones that are really going to have to step in here. Now, the problem is that because it's private industry, it depends on how much faith you have in those institutions to actually do that. But the banks, for their part, are saying what's important to kind of distinctively point out here is that we have a better capital position than we did in 2007, 2008, 2009, and that we're not in a position where we don't have the capital to be able to do this. So the question really is, how do they do it? How quickly can they get the money into those Main Street businesses' hands? And will that actually ultimately help us when the recovery does come?
All right, there you go. Brian Chung breaking down the latest in terms of America's banking sector reacting to all this. And as he points out, there are a lot of efforts underway right now for some of the bigger institutions. But what about the servers that are being left behind at restaurants across the country? We'll chat with a man who is helping out on that front. You may know him as the father figure in ABC's Modern Family. The Emmy Award-winning actor Ty Burrell will join us next to explain why he's putting $100,000 of his own money into an effort to help servers left behind. More on that story in our interview with him right after this. Leaving a lot of question marks right now as restaurants continue to get hit amidst the coronavirus lockdown across the country. And some people are stepping up to do their part to address those servers and the economic impacts as well. One of those men being Ty Burrell, the Emmy Award-winning actor from Modern Family. And he joins us right now to discuss a new initiative that he's spearheading along with others in Salt Lake City to make some of the restaurant workers that have been impacted by all this made whole. And Ty, thanks so much for taking the time to chat with us. Where did this kind of come from for you, and why do you feel like it's so important to try and help out here?
Well, first of all, thanks for having me. It started because my wife and I were actually servers when we were young. When we were, that was like 110 years ago. But when we were both young actors, and I was kind of a famously bad server, but for whatever reason, that's kind of the job for young actors. And you get a firsthand sense for, number one, how hard the job is, but also how challenging unemployment is in that world. They're mostly part-time employees also, so there's very few benefits in that world. So when things go away, they really go away. Also, we're small business owners in Salt Lake City. We own a couple of bars there, and you grow close with your employees, and also you're reminded that not just Salt Lake City, but every city, that community, especially in smaller cities, is very tight. And there's always a sense in a smaller city like that a rising tide sort of lifts all boats. And so we teamed up with Mayor Mendenhall and the Downtown Alliance to create something called Tip Your Server. And our hope is it's not a fix. There's about 15,000 displaced workers right now in that industry. So we're trying our best to create a stopgap to get them from where they are right now to unemployment, which is notoriously slow, and then to stimulus money, which, that's I don't know how quickly and efficiently that will get out, but we're trying. The mayor's done a very good job of trying to cut red tape and get the money out as quickly as possible. So we've been sending out $500 checks, and I think we're into our third round now. But we still have a long way to go if we're going to try to get these checks to everybody. And so we're hopeful that we can kind of just keep fundraising. I will add, Salt Lake's in an unusual situation because although the whole country's been dealing with COVID, Salt Lake has been hit with a series of earthquakes as of a few weeks ago. In that 3 weeks when that first one happened, there have been 600 aftershocks, as up to yesterday, and by aftershock I mean 4.3. So several of these restaurants are actually put out of commission for takeout as well. So they are in an unusual position. So that's why we're kind of reaching out nationally.
Yeah, and I mean, just when we talk about efforts being made too, I do like that you not only put up $100,000 of your money into this initiative, which is trying to get about $2,000 in grants to the employees. We're talking about servers at restaurants, but also the initiatives from your partners, as you mentioned, they're also trying to add into the match program, so you can try and get donations to kind of build on the momentum here through the Tip Your Server program. But it is interesting, Ty. I mean, when we look at it, you're clued into all of this too. It's not just restaurants, and obviously, as you said, not just the Salt Lake City area dealing with all this too. A lot of people noting the slowdown in Hollywood right now in terms of production, and maybe not just the impact to the stars, but everybody else attached to production as well. When you think about all the work that goes into a series like yours, what's your take on the way that those workers and the industry overall is getting impacted as well when we talk about kind of the shutdown, even though people continue to watch all these shows and trying to produce them?
Yeah. Well, it's created a pretty unique situation. I will say that, first of all, it's never the people at the top, obviously, that are really hurting in terms of income. There's a lot of workaday actors out there that, you may not necessarily recognize, and may get 2 or 3 jobs a year that really sustain them and keep their health benefits going, and things like that. I will say that one of the differences between this and the food and beverage industry is that our world, as long as you've worked enough, is unionized, and there is some help there, but it's creating an unusual situation in production going forward. There's a lot of shows being picked up that may have been on the fence, or we're not necessarily getting ratings that would have brought them back. So in that sense, there's some unusual decisions being made, shows being brought back. And animation is one of the few things that can be produced in this environment. So animation, I think we may see a little bit of a surge in that realm about things that can be made in this particular environment until we are, until we have a vaccine, and we're able to go back and be in contact with each other. But I think no matter what, there's always a percentage of the population, even amongst the people who are, in the unions, that are really suffering right now.
No, and I mean, we talk about the impacts of all this. You can talk about the economic impacts, and clearly there's a lot of good that's going to be coming from your initiative. But across the board, we've seen everybody kind of sheltering in place, and that's kind of the one constant through all of this too. And as people might know you as Phil Dunphy from your role in Modern Family, I mean, you are still a father and a husband in real life as well. But as you try and navigate staying at home, what have you been doing? What's it been like to stay sane as you're just on lockdown mode?
Well, honestly, I've been fundraising for the first time, I've never really been in a position to fundraise, and it's kept me, it's given me purpose. And then when I'm not, it's, I'm basically my kid's weird gym teacher, with the ill-fitting shorts and quarantine odors. So, I mean, I think we're in a position where we're doing our absolute best just not to complain, because I think whatever may be challenging for us in terms of homeschooling the kids and maybe the Groundhog Day of everything, and also dealing with safety, making sure that we're safe and everything, our level of stress is nowhere near the level of stress of so many people on the front lines and our healthcare providers in general. And so we have check-ins every day at the end of the day, even if the wheels have come off in our house, to just basically make sure that we're all keeping our perspective.
It's well said, and we love highlighting efforts like yours on this show to talk about what people are doing to try and help those people who might be feeling more pain through all this. But Ty Burrell, thank you so much for joining us. Appreciate it, man.
Thank you. Please go to downtownslc.org/tip-your-server. I really appreciate you letting me chat about it.
Of course, anytime. All right, stay safe out there.
Exactly.
We're going to take a break.
Thanks.
Yeah, coming up after this, we're going to be discussing the cybersecurity concerns that continue to grow here as more bad actors try and take advantage of the stresses on certain work-from-home situations of a lot of companies out there. The Senior VP at Dell Technologies and Chief Security Officer for that company will join us on that right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman, and right now we still have stocks in the red in the afternoon trade. The S&P off by about 2%. Overall, energy continues to be the largest drag as crude prices continue to face pressure, although they are now back above $20. We'll see what happens later on in the show. And despite all of the bad action right now in the market, cybersecurity stocks continue to buck the trend. We're seeing Okta shares in the green as well as CrowdStrike shares in the green as well. We've been highlighting the way that cybersecurity has become an issue in the coronavirus crisis as top agencies around the world continue to warn that cyber criminals are stepping up their games to attack companies as more employees shift to a work-from-home basis. And for more on that, I want to bring on John Simone. He is Dell Technologies Senior Vice President and Chief Security Officer who joins us on the Hangout right now. And John, when we look at this, again, it's something that I always say. I mean, you don't want to see these bad actors increase their attacks on companies, but it does seem like that's been the case if you listen to top agencies. So what are you seeing out there right now? And what are you expecting companies to do to try and prevent it?
Yeah, so thank you for having me, Zach. What we're seeing, perhaps not surprising, is that criminals have stepped up in the wake of all the fear and uncertainty that this pandemic is creating, and seeking to take advantage, defraud users worldwide, and to monetize their crimes in different ways. I think that what we're seeing for the most part is really long-term proven methods for defrauding users, but capitalizing on the new themes of the pandemic, whether it be fake cures, whether it be news about sick family members and how to take care of them. We are seeing a spike in reports of fraud, phishing attacks, and other cybercrimes.
And when we talk about companies trying to, I guess, bolster their efforts to defend against these, there is a question of if you're already kind of in times of uncertainty, whether or not you want to step those efforts up becomes a question of whether or not you actually have the funds to do so. So what are you kind of seeing the way companies might be getting creative with trying to combat these new threats and the way that some might not be protected at all?
Sure. Well, I think first and foremost, companies can see a lot of benefit just from taking some basic steps in terms of training their employees on what these new risks look like. So what we're seeing is a dramatic transformation virtually overnight in terms of the workforce globally moving to a work from home posture. And with this, new risks are introduced, but a lot of those risks can be sufficiently mitigated by simple practices put in place by team members and employees, looking at things like, is your home internet set up securely? Is your device encrypted? Are you using the corporate VPN? A lot of these can capitalize on existing solutions just simply by training team members. At the same time, I think we've seen new technology challenges that have been introduced with this mass mobility move, really an acceleration of existing trend. I mean, even in Dell's case, highly mobile workforce, we've been working from home in some form or fashion for over a decade. But again, in a very short time period, seeing 4x the amount of users working from home on our VPN, over 90% of our 165,000 employees globally now supporting our customers, continuing to keep the business running, but from their homes or from another public remote setting. With this, we're needing to reach out and train these users on new ways of doing video conferencing, connecting into the corporate network, accessing their information, ensuring we continue to do it in a secure manner.
Yeah, I mean, that's a good point. I mean, obviously the trend of work from home didn't just come out overnight because of a health crisis. We've seen that trend kind of happening, though it is getting accelerated here. I'm curious to know, based on you watching these trends over time, if the cyber attack kind of theme here has been a similar story, if you've seen that kind of increasing over time as the shift to work from home has been underway, or was it necessarily that now is truly just a time for people to step in here and say, look, there's a lot of vulnerabilities on systems that aren't prepped for this. And so overnight you saw an uptick, or was this a trend that a lot of people should have seen coming as well?
Well, I think the focus on security we've seen increasing over time with our customer base, and really it's a microcosm and really underpins the overall trends we're seeing with digital transformation as businesses across all industries are seeking to perform business in new ways with higher degrees of data, higher leverage of technology. And with that, foundationally comes the need to ensure that you're doing these new practices in a secure manner. So security is often the first conversation we have with customers as a foundational underpinning to give them the confidence and the trust that they can place their digital transformation bets. I think what we see really that's unique in this pandemic is just the dramatic change, the level of agility that businesses are having to demonstrate to make quick decisions regarding ensuring that the security measures, in many cases that they'd already started to put in place, are appropriately accelerated as the workforce accelerates to this mass mobility movement.
All right, there you go. John Simony, Dell Technologies SVP and Chief Security Officer on the latest there. John, thanks so much for taking the time.
Thank you.
All right, well, coming up after the break, the PPP program, the $350 billion set aside for small businesses out there, approaching the $300 billion landmark of getting that money into the hands, how quickly that's been moving along and what it means for the small businesses attached to it. We'll chat with Shark Tank's Barbara Corcoran yet again on what this means for some of those businesses trying to stay afloat. She'll join us right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman. Right now, we're still seeing stocks trade lower in the afternoon. The S&P off by about 2.25% right now. Continue to track that throughout the afternoon and into the close. But right now, we're focusing on the way that the PPP program, the so-called Paycheck Protection Program, the $350 billion set aside to help small businesses, is being doled out right now. The latest numbers, $296 billion of that $350 billion has been handed out to small businesses as of about noon Eastern time today. But the Wall Street Journal reporting that that could potentially be exhausted. The total $350 billion could be exhausted as soon as today, perhaps issuing a little bit more of credence to Secretary Mnuchin's call to boost funding for the program. For more on this, I want to bring on our friend and Shark Tank host, Barbara Corcoran, who joins us again via the Google Hangout here. And Barbara, when we looked at it, I mean, you talked to us a couple weeks ago about this program and the way that you were worried that half of your Shark Tank businesses might not make it through. So what are you seeing kind of in the way that this money is helping small businesses? Have you seen it actually get handed out? And what's your take on the way that the program's been laid out here?
Well, I'm going to be worrying a little bit more about my businesses that I believe will make it through, because I've surveyed my companies. 17 of them on day one applied for that loan. Only one has heard they're getting money this week. No one else has gotten any money, nor have they heard what kind of money is forthcoming. So when I'm hearing about all this money being doled out, I'm wondering who's getting it. I only have one who's getting it later in the week. I think maybe it's been committed and they're rounding out that word, but I'm going to believe it when that money gets into people's hands.
I mean, I think that's the big issue here too, though, right? Because you're talking about companies that are strapped for cash in the short term. And so, I mean, there are problems that they need to deal with now. So waiting a couple weeks for a check to potentially come down the line might not be good enough. So how does that kind of tie into all this as well?
Well, Zach, you've got that exactly straight. All of these business people actually kept their people on payroll with anticipation that they were going to get reimbursed with this great SBA loan. So think about it. They borrowed money on their own. They strapped themselves to their business and they didn't let anybody go. And now they're being told, oh yeah, we're getting the money. And now today again, oh, we're going to run out. They haven't heard anything. It's a pretty scary time, even for my most successful businesses who really put the pedal to the metal and went at risk. And I sure hope they see that money that supposedly is coming through. I just don't know who's getting it.
Yeah, I mean, that's kind of the problem here too. You're right in that small businesses were trying to keep employees on the payroll because that's more effective when you think about it, rather than going to the unemployment line and having to deal with that process as well. If you can kind of keep all this, it also ensures a quicker recovery. So a lot of people are agreed on that front. But do you think that there's a sense of maybe being misled here if we're thinking about the government maybe not potentially having enough money to backstop that in the way that they tried to say this would be going out there? I mean, $350 billion sounds like a lot of money, but we've been hearing calls for much more than that. And now potentially the money not being there for a lot of these businesses across the country.
Well, you know, it's tough. Will we get more money from the government? I suppose so, because it seems like we're just printing money like it's meaningless. But I think everybody was well intended with the stimulus package, and they made a lot of promises that they intended to keep. I just think the execution of the whole program is pretty horrendous. Even the unemployment insurance, the idea that they didn't expect that they would have a surge of people applying. Most people who are living hand to mouth right now, the people that were let go, aren't getting their checks for 3 weeks, 6 weeks, some as late as 8 weeks predicted in some of the states. I mean, that's overpromising and under-delivering. In a way, it's more mean than not promising in the first place.
No, it's a good point, especially as people are trying to brace for all of this and hoping for attempts to make them whole coming through. And we talked about that too, as stimulus checks start to get passed out here in the U.S. And you think about, having a business go under is one thing. Certainly, nobody ever wants to see that. But when we talk about Americans themselves, families caught in all this too, there's a lot of problems out there when we think about trying to meet mortgage payments, rent payments, a lot of issues. And of course, we are getting those stimulus checks, potentially in some instances, as much as about $1,700 being given out to maybe single parents with a child. But when you look at that money, I mean, it doesn't sound significant here, but what kind of advice are you giving to people who might be getting that stimulus check? Because of course, no one's going to get rich overnight off that, but wealth does kind of get built here by being smart with even small windfalls. So what are you telling people to do if they are to receive a stimulus check here, and how they should think about it?
Well, the people in the worst position financially really don't have a choice. What they're going to use their $1,700 or $1,200 for is to put food on the table. Single moms who are supporting 3 kids. What do you think she's going to do? Oh, I wonder what I'll do with my stimulus check? No, she's going to feed her kids. If you're in a position where you aren't that concerned about your finances, and too many people truly are, then I think the most important thing to do is pay off your credit card. Especially some of these credit card rates are outrageous. There's no chance that people can get ahead. So paying your credit card in order of the highest interest first is a smart thing to do. But you know, it's not going to do a lot. That's the irony. It's short term. It's a little bit of money. I don't care who you are. And so it's almost like a Christmas present or a present from the government so we all get to vote properly in November. Who the heck knows? But let me tell you something. It's not what it was all cracked up to be by any means.
I mean, certainly a $1,200 check wouldn't necessarily be a lot in the wake of losing your job, or whether or not that's going to be enough here, maybe even on top of unemployment insurance through all that too. But as we talk about the way that the government's been responding to all this, it was interesting because it's not just small businesses and also personal stimulus checks that we're talking about. But President Trump was talking about trying to reopen the economy. He's been talking about that for the last few days here, but he's also focusing in on sports leagues as well. Obviously, a lot of sports fans, myself included, waiting for kind of the update there. It's interesting, though, because he tapped one of your Shark Tank co-hosts in Mark Cuban, along with about 7 other league commissioners out there and team owners, to talk about plans to reopen sports for Americans as we all kind of work from home and try and wait the storm out here. What do you think about what Mark Cuban might be able to bring to that discussion and trying to plan for the reopening of sports?
What Mark's great traits are, he's a straight shooter. He tells it like it is. He doesn't mince words at all. If he thinks there's any risk whatsoever to his fans or his players, he will be an advocate for not opening. He doesn't ever put his wallet first. He's the kind of guy that always does the right thing first. So I think if our president is smart enough to actually listen to him, and I question that as to really who he listens to for more than a minute, he would give him excellent advice. But we don't have a gentleman there in the White House who really listens to people for more than the day. So we'll see where that lands.
Well, I mean, we always invite you on days where we need answers, and because that's, you know, we love listening to you. So, I mean, if you were to give advice on what should people be watching here as we continue to watch rising unemployment claims. I mean, we've looked at kind of the hit to the economy. We'll talk about real estate after the break. We're going to take a quick break, but we'll get into that in a sec. But what have you been watching in terms of, I guess, where the recovery goes from here in trying to time all this out? Because as you noted, a lot of Americans right now are kind of in this limbo mode of uncertainty of, okay, I might have gotten a stimulus check, but what's going to happen to my job? And kind of when is this all going to be over?
Well, you know, I think there's some credence in focusing on when it does get over, because none of us have any control as to how long it's going to last. But there's great credence in thinking about what's going to happen and what can I take control of once the whole thing is passed. And I think the smartest people out there are thinking about what they're going to do for their future job, and the landscape they're going to find when this whole thing is over is going to be fiercely competitive. Because when I speak with business owners around the country, my peers, many of them have waylaid people, but they're not planning on hiring everybody back. They've used it as an excuse to kind of get rid of their dead wood. So once people come back into this marketplace and business gets revitalized, I think everybody should be spending some time right now on sharpening their resume, figuring out what other skills they could build up so that they compete in the future market of tomorrow, whether it be 2 months or 4 months from now. It's going to be a competitive hiring market, and everybody ought to focus on what they could actually change about themselves to compete in that market. I think that's good use of this limited time we have. It's a special time, and it's smart thinking if you think, forget about what I can't control. What can I control? I can control myself. And what could I do better for myself so that I get ready for the good times when they happen?
Yeah, no, it's a good point. And one of those good times, as we talked about last time, could potentially be what happens down the road in the real estate market. But there are some short-term questions, including a record drop in terms of home builder confidence. I want to get your thoughts on the other side of the quick break we're going to take. Stay tuned. Much more with Barbara Corcoran right after this.
Thank you. I thought you were going to
Welcome back to live coverage here on Yahoo Finance. We're continuing our discussion with Shark Tank host Barbara Corcoran. And right now we're going to get into real estate in a little bit, but I just want to get one more thing out there in regards to President Trump's plans for reopening the economy. He did announce that he would be meeting and kind of gauging the interests and ideas here from a few business leaders, as he calls them, across the board in terms of a great American economic revival, the plans here. And Barbara, just want to get your thoughts on kind of this political list he's established on the leaders that he'll be discussing plans with. Your take on that?
Well, picture the list. It's not a little list. It's 200 people, predominantly billionaires or at least millionaires. He's going to bring all these fat cats together and get their advice and their opinions on what he should do with the economy. It's going the wrong way. Imagine just even organizing something like that. It's basically the club that he always wanted to be a member of, the real billionaires club that he couldn't get in, and now he gets to run the show. Doesn't make any sense. What's needed now in a time of crisis, and is always needed in a time of crisis, is true leadership. Some guy making the shot, making the call as what has to be done. You don't turn around and ask 200 people and collect all these opinions, and it's really a vanity group. I just can't believe he would even waste the time doing it.
No, it's a good point when we talk about the way that the money is going to be distributed, because we keep talking about $2.2 trillion in terms of stimulus and where that's going, and the billions being applied to certain industries here, restaurants included, when we saw restaurant CEOs meeting with the president before this was all announced, and then the $350 billion that's likely to run out today when we think about the money going to small businesses as well. So there's a clear lobbying impact when we're thinking about how much this check is and the way that it's distributed. I mean, I guess that's politics. I guess that's the way things go, but I mean, it's not necessarily what you would want to see in terms of recovery and helping out Main Street through all of this.
You know what's the worst part about it is pits people against other people. It's like the big money grab. Who's going to get the money? What do I got to do? Oh, how do I fit in with everybody else? No, it's the wrong way to go. It should be very clear. It should be very even-handed, and it should be very obvious where the money is, really where the money is. Again, I'm going to believe that money I keep reading about the minute I see somebody get the money. I'm not seeing anybody get the money. And remember, Zack, I'm in a good position with a lot of entrepreneurs who have all applied for the money and nobody has it in hand. Pretty upsetting. I'm getting pretty annoyed about the whole thing. Wish I could do something about it, honestly. But I'm not giving them my money. No way.
No, it's surprising to hear. Like we said last time, I mean, with the platform of some of the businesses that you've invested in through the Shark Tank platform, you would have expected a different story there. But I guess, it's not the case. But when we talk about real estate, though, it's another one of those issues when we think back to the financial crisis and the way that clearly there was this impact of everyone was going to be hurt by this if you didn't address the problem. So banks, in the way they were caught in the middle of that crisis, were really the ones that the money kind of went towards to fix all this. Potentially, we're seeing a similar kind of crisis playing out here. When you look at the new updates we've been getting, you can look at the way that mortgage applications are getting more stringent, or the way that home builder sentiment continues to plummet. I'll start with the first point there, because JP Morgan Chase announced that it would be raising borrowing standards for most new home loans. That would take up a credit score of about 700 being the minimum on that front, requiring people to have about a 20% down payment for purchasing new homes out there. So when we're seeing that kind of take into effect, what's the impact on the overall real estate market when you have lenders getting a little bit more careful, considering that they might not know what's going to happen?
Well, the lenders are always the nervous Nellies in any marketplace. They're the first guys that fold. They're the most scared, the guys that get scared first. And in making the requirements more stringent, it's not good for the consumer. It's especially hurtful to the first-time home buyer. But you have to realize right now, not a lot is going on anyway. The markets are basically silenced. There's very few transactions happening, so you're not going to feel any effect of that. Once the market resumes, a lot of people are going to be knocked out of the lending environment, not be able to get the financing for the homes. So it's not welcome news, but it's a typical dance step that happens when there's trouble. The banks run for cover every time. You can count on it.
Yeah, and we're seeing the same thing out when we talk about that drop in transactions. The National Association of Realtors last month said that home sales could fall by about 10% in the short term compared to what we're used to seeing at this time last year. So I don't know if that necessarily would be all that impactful, as you're talking about maybe fewer sales going through, and what the impact might be for housing prices. If you think about people potentially saying it's now a good time to buy a home, you still have interest rates at historic lows, but if more and more people aren't able to kind of compete to purchase your home, what that could mean here. So what's your take on those two things? And then also, if I can throw one more detail in here, we saw confidence among home builders plummet by the largest amount ever, stretching back 30 years when you look at the data to when they began tracking the data. So if you put all these things together, maybe less inventory out there on the market, what would be your advice to people potentially thinking about getting into real estate now?
You're talking about people buying a home. That's what you mean, right?
Yeah, I mean, well, right now we're seeing home sales drop. Off the short term.
Well, first of all, home sales have dropped, but along with the home sales dropping, and no surprise, you can't show a house. A broker can't show a house in most states, with a few exceptions. Buyers can't shop unless they want to commit to a house online, which ain't going to happen. Okay, and all the sellers are scared. More than 50% of the listings in most markets have been pulled off the market. Okay, you might say that's all bad news. The good news in that I see is that sellers have pulled their houses off the market, so it's shrunk the supply. That's going to help us recover when we turn the corner. Okay, absolutely. But for those brave people who are out and willing to shop, or still have just put their plans on hold, which are the great majority of people out there because they have no choice. The reality is when they come to the market, everybody's going to be in the market at the same time. They're going to pay more for the home than they're going to pay now. So the smartest home buyers out there should really be staying involved, knowing their local market, watching all the sales data, and actually shopping online, because then they're in the position to actually recognize a sweetheart deal when they see it. And if they pounce on it, they're going to get the deal of a lifetime. I can tell you that every real estate cycle that has gone up and down, the deals weren't made in the down cycles nor in the up cycles. They were always made in the times when there's greatest uncertainty, where everybody's guessing. And so if you're smart enough to attack the market in that way as an educated consumer and get out there and make a bid on a sweetheart deal, you're going to be the smartest guy that everybody's going to applaud you 6 months from now.
Yeah, and I guess it's also important to keep in mind that a house decision too, if you think about it, I face this too. It's not just one of those decisions where you can make it and expect to turn a house around in a year or two, unless you're a serious home flipper out there, that you're going to be walking away a rich man. I mean, it's a serious investment decision if you're looking at it that way. But also, I don't know if you've been keeping an eye on commercial properties as well when we think about real estate and that side, just because the real estate number we got today was just abysmal when you look at the 8.7% drop last month. overall, a lot of issues right now in terms of malls, everything else, storefronts across the board. Curious to get your take on the way that could be problematic too. Just when we think about mortgage people with mortgages not being able to pay back loans on their homes, the same thing potentially in the commercial space.
I'm more worried about the commercial real estate market than certainly the home market, because with the home market, people get married, divorced, have babies, and there's always a need for change. That's not true of the commercial market whatsoever. What we have witnessed only in the last 2 months is a bellwether change in the commercial market that's going to make that commercial market lose a ton of value, I believe. And here's why. The people who have been working at home have realized they're not so crazy about sitting in the traffic to go to work every day. It's going to change the desire to be in the office 9 to 5, Monday through Friday. And businesses are going to realize they have way too much space to utilize, and they're going to want to renegotiate their leases, and the landlords are going to have to deal with them. And what's going to happen is it's going to bring down the value of all commercial real estate overnight. I really don't believe we're ever going to go home to what we had before. It's totally changed. And the only other portion of the real estate market that I think is going to be hit even worse is, of course, the shopping centers. They were half dead. We came into this whole debacle with them on one leg. The other leg's going to be cut out. So I can't even envision what's going to happen to the shopping centers. I just can't imagine.
All right, dire projections there. Of course, it's been the theme that we've been getting all day, pretty much, when we talk about this playing out. But Barbara Corcoran, always love having you on to break down.
Well, end it with a happy question. Come on, you got to get.
I would. We got much more coming on the show, Barbara. We got to continue with that, or better yet, you're gonna have to come back so we can talk about that
good enough.
later on. Shark Tanks, Barbara Corcoran, thank you so much for joining us. Appreciate it. We'll talk to you soon. Stay well.
Thank you, Zach.
All right, coming up, we're going to be chatting with the entrepreneur behind one of the hottest growing poker apps out there right now, allowing people to play with their friends via video chat through quarantine. The founder and CEO of that company will join us right after this. Welcome back. We've been tracking ways that friends can stay in touch amidst the coronavirus lockdown across the globe. And one new app that lets friends play video poker and chat at the same time through a video function, as well, has seen an 8-time surge in downloads since the lockdown began. And I want to bring on the founder and CEO of that company. And the app is named Poker Face. Ben Shimon, the CEO of that company, joins us now on the Google Hangout. And when we look at this, what has been kind of the reason you even wanted to launch this? Because I know you guys have been around for a little bit, but now just the peak in interest and downloads as more people look to stay in contact. What was kind of the thesis behind the idea?
Hi, thank you for having me. So the idea has come from me and my partner. We've been socially distanced one from each other and from our old friends when we had Saturday night poker. So we started this company a year ago, and now with all the COVID-19, people start to understand that they need something else except just business meeting through a video chat, and we have the best thing to do that. Yeah, as you said, we saw much increase in user base, and that's it.
Yeah, no, the increase is 8.8 times the amount of downloads you said over the last couple of weeks when we looked at it. But it is interesting because it's free. I mean, you guys have been making money through the ability to buy coins, right? So talk to me about the business model and the idea that you're trying to grow this as a free app and what you've seen on that front.
Yeah, so the business thing is that you have your chips in the app. It's the virtual currency, and when you're out of currency, you actually buy more. We're trying to keep it free as possible because we want to put people together. This is the thing all about, to bring people together all the time, to hang out with your friends, with family, to meet new people.
Yeah, that's what I've loved about it too, though, because I've been playing it myself, and it's not as if I'm not necessarily a big poker guy, but it's not necessarily targeted at people like that too, right? I mean, the idea was just essentially to have a game going on in the background to kind of help foster communication when you're chatting with people, not necessarily become a poker star.
Yeah, it's not about poker players. It's about the hobby. People that like to play poker as a hobby with their friends, just to hang out with their friends and family. We're not targeted professional poker players. We target the people that, like you and I, that can just hang out one with each other every day or every few days and talking about stuff. And the poker is just the excuse what to do, and not just to do, business meeting or something not comfortable with one with each other.
Yeah, no, for sure. In my experience over the last couple of weeks, some of those video calls can be a bit awkward if you got nothing else to do. So it's exciting to have maybe poker there in the background. But Ben Shimon, I want to thank you for joining us to break that down. Poker Face.
Thank you very much.
Yeah, thanks so much. Take care. Coming up on Yahoo Finance, we're going to have much more live market coverage here as, again, stocks are off by about 2.3%. The big movers, continuing coverage here on Yahoo Finance right after this.
Welcome back to live market coverage here on Yahoo Finance. I'm Seana Smith. We have a sell-off underway on Wall Street. A couple of things are going on that has investors' attention. So we got a slew of weak economic data out this morning, and we also had pretty weak bank earnings. So that, of course, has investors questioning the extent of the coronavirus impact on the economy so far. As it stands at this point, the Dow and the S&P both off just over 2%. The Nasdaq also posting pretty significant losses at this point, off just around 1.5%. Now, some of that weak economic data that I mentioned there just a few moments ago, retail sales in March declining by 8.7%. That's a new record decline. We also had manufacturing in the New York area slumping by its biggest margin ever, hitting a historic low. Home builder confidence. We've been talking about the potential impact that coronavirus could have on real estate here over the next couple of months. Home builder confidence seeing its biggest monthly dive ever. So that, of course, has investors' attention as well. And then I mentioned earnings. So we're getting into earnings season at this point. We had another number of banks reporting results ahead of the report ahead of the bell this morning, and really giving us an early look at the damage from the coronavirus. So we had Citi, Bank of America, and Goldman all reporting results before the bell, and they all posted a more than 40% decline in earnings. Because of that, financials is one of the worst performing sectors so far today. We're also seeing pretty significant losses in energy as well. So for more on this, I want to bring in Jordan Stewart, a portfolio manager at Federated Hermes. And Jordan, I just went through a lot of the economic data that we saw this morning. So let's start with that. Because of the market's reaction today with the Dow and the S&P off over 2%, is this worse than what investors maybe had feared at the beginning of the week?
Yeah, thanks for having me on the show. This is, I think these are all things that we've known and the market's priced in during the sell-off. I think what's important is investors start to look forward. Look at some of the opportunities that are out there, companies that are growing through this. We know the old economy is slowing. Your traditional CapEx spending, we know that's been slowing actually for 18 months. This has only accelerated that. What I think is important here is take a step back and look at areas that are seeing significant growth. We're on the internet chatting, e-commerce, grocery spending, food, internet traffic is up at significant levels. This is the new economy that's accelerated space. This is the end of the last cycle has ended. We're entering the new one. Now, how long this lasts and how bad it will get, no one really knows. But I think this is that opportunity to start to find those glimmers of growth that I think investors can start to focus on. And that's where I think those type of businesses are going to get out of this a little bit faster.
Yeah, Jordan, it's interesting you're saying that we don't know, obviously, if it has gotten as worse as it will get. But from a market perspective, we haven't really retested the lows that we saw back on March 23rd. Do you think that we could see a significant sell-off and we could retest those lows anytime soon?
You know, it's tough to tell, but I would say it's this recession or recession that might come about is going to be very different from 2008. Think about what companies had to do in 08. When you see a downturn, companies pull from their revolver. They depend on their balance sheet to kind of get through this downturn. In 08, that was blocked. The banks were all in trouble. They couldn't lend out the money that they had. The Fed stepped in, allowed the liquidity to happen. So I think that I think the market and the markets have stabilized. I don't know. I think this is going to take a lot longer than people expect to recover, to get those sales back, to get people out spending again, businesses back and humming. But I think that scenario was starting to price in a depression, not a recession. And I think we've seen probably have seen the worst, but we'll wait and see.
Jordan, I want to talk about earnings real quickly. So we got just a couple of the big banks reporting over the last couple of days. When we take a look at their results, what exactly that could mean for the rest of the companies, not only in the financial sector, but really across the board, set to report over the next couple of weeks. What does that tell us about what we could be or what we should be expecting at this point?
Yeah, look, again, very similar to 08. However, banks are much better capitalized. They're going to take this on the chin. Their earnings are going to take a hit. They're going to have some loan write-downs. They're going to have some defaults to deal with. But banks are better capitalized. As long as the E's taking a hit, not their balance sheet, like we saw in 08, I think banks are going to be okay through this. But again, they're very cyclical, depending on rates. They're taking it on the 2-10-year spread, the 10-year spread going lower, and their loan book's taking a hit. In the meantime, I think it's important for investors to pivot to the new economies out there, the software, the biotechs out there that are going to, I think, get through this and be stronger and have probably a better earnings season than people are expecting. So again, I think this is going to be very dispersed economic impact, and some companies are going to get out of this a lot faster than others.
Jordan, you say you like software, you like biotech. So is it fair to say that you're buyers of equities today?
I think certain equities. I think you don't want to buy everything, and you don't want to buy companies that are still have yet to see some of the pain. But as we said last time I was on the shows, late February, I said biotechs might save the day. Here they are, entering the year, usually a presidential punching bag as a sector, and now here they are coming up with vaccines and cures and antibodies to hopefully get people back in action and get the economy going again.
All right, Jordan Stewart, thanks so much for taking the time to join us this afternoon.
Thanks, Sean.
Let's turn to the latest on the coronavirus outbreak. So confirmed cases around the world now topping 2 million. Here in the U.S., we've been talking about the severity of the outbreak here in the United States. That number now topping over 600,000 confirmed cases. But even though amid this tragedy, there are some more signs of optimism in some of the nation's hardest hit cities. Now here for more on this, I want to bring in Dr. Harlan Krumholz, director of Yale New Haven Hospital Center for Outcomes Research and Evaluation. We're also joined by Yahoo Finance's Sabeel Marcellus. And Dr. Krumholz, lots to talk with you about just in regards to where we are in fighting this virus. But as it stands now, the progress that we have made over the last couple of weeks, do you think it's fair to say that we've turned a corner at this point?
Well, I think we can be proud of some of the progress that's been made, the way that the American people have come together to follow the guidance, the way in which the social distancing has spread throughout the nation, and that people have come on board with it. What we're seeing now, and I think what most experts believe is the fruits of that, that we have been able to flatten the curve, that we've slowed down, but realize that this progress has come at a great cost, and with a strategy that's not sustainable. So we've done this by separating. We've done this by slowing the spread, by less interaction, and I think that it's placing us in a position now to try to determine what are our next steps, because this was a temporizing, measure. It was a way to try to manage a situation that was becoming unmanageable, especially in certain places like New York, where we feared that we would be overwhelmed and that the hospitals would be unable to keep up. So now we're thinking hard about what's the next step? How do we move forward? So, I think everyone's happy to see this, but no one's congratulating themselves, and no one feels comforted by this any more than just to say that we've bought ourselves some time, that we've been able to manage some of the short-term risk, but the long-term risk still hovers over us. And on this show, you talk a lot about financial risk, and as a physician and healthcare professional, we worry about health risks, and that still hovers over us. And so we're trying to determine how can we safely, move forward and change the status quo and get people back, but do it so in a safe way.
So a lot of the conversation, Dr. Krumholz, about returning people to work has been about having some kind of nationwide testing system that we can trust. Now, what I found interesting was that you were saying that testing negative for the coronavirus does not mean that you don't have it. So can you explain that to us and what that actually implies?
Yeah, so I wrote a piece in the New York Times where I was trying to convey to folks that we need to be able to know how to properly interpret the test results, and especially the early test results. Best that we could tell, both information from China, Europe, and the United States, was that in too many cases, that the test was coming back negative when the person likely was infected. Now, let me just say, that's not to undermine confidence in the test. Test comes back positive and people have symptoms. Most likely that's telling us the truth. But what we found were there were a lot of asymptomatic people without symptoms walking around who were feeling fine, who actually were infected by the virus. And so in surveillance or among people who were sick and had classic symptoms, even x-ray findings, were testing negative. And so, it looked like maybe one in 3, 1 in 4 people who were testing negative might in fact have been infected. And the problem is that we really were having trouble putting our arms around exactly what were those numbers. So what I was trying to do was just to tell people that, for people with classic symptoms and in the midst of a pandemic, being told that your test is negative doesn't necessarily mean that you don't have the virus. It just means that the test came back negative, and that we need to know that there's some level of uncertainty. Now these tests are progressing. Technology is getting better. you have to know one of the problems is that the current test requires you to stick a swab way up into the back of the nose. I don't know if you've seen this, but like, this is really uncomfortable and not that easy to obtain. It's not just about taking a swab from the nose. It's going way in the back. And some of our thought was that, many people who were doing this weren't as skilled in obtaining these samples. And so that if they weren't getting a good sampling, then that might have been the reason that the tests weren't showing up positive. So, the new tests, we're talking about saliva tests now, we're talking about, finger prick tests and others. Those may also help us to improve the information that we're getting from them and may help us get better. But yeah, the current tests that we have going to the way back of the nose, way back of the throat, if they're negative, it doesn't always mean that the person doesn't have the virus.
Dr. Krumholtz, I want to go off of just our access to testing at this point, because that has been at the crux of this issue now for several weeks. And it was interesting. I was reading in Politico this morning. There was a study that they referenced. It was from the American Clinical Laboratory Association. And the members of that association include Quest, they include LabCorp. They actually reported that the number of coronavirus tests analyzed each day by commercial labs in the US plunged by more than 30% in the past week. From your understanding of what's going on, where do we stand in our ability to get some tests? And are there still glitches in the US testing system at this point?
So we're pushing as hard as possible. And one of the problems was from the very beginning, we didn't have enough tests. I mean, it was really remarkable. Even when you're reporting the number of confirmed people in the country who have been infected by the virus is likely a gross underestimate. It just depends on who's had access. And, most places around the country, including my own place, still have constraints on that. We still don't have enough. It's not a matter of being able to test everyone that we want to be able to test, let alone get out into the communities and test people without symptoms as well. So we can have a sense of what is the prevalence. How many people in our communities without symptoms at all are infected? Give us some sense of what the spread is and how fast that's changing over time. So, many of us are pushing really hard to say, we need this information. We need to make wise choices ahead. We need to be able to understand what's the extent of the virus today. And also that information tells us something about risk, because without the denominator, without knowing the full number of people infected, it's hard to understand risk because you can't tell what the real rates are. So, all of us have been pushing hard. The companies that produce these tests have been pushing hard. And what I think we're seeing is within the next 4 weeks, we'll see a remarkable increase in the availability of these tests. Still may not be as many as we'd like, but I hope we get to a point where any American who wants to be tested can be tested. Any physician who has a patient who they want to be tested will be easily able to get them tested. And so a combination on the clinical side and the hospitals and clinics and on the public health side, we're going to need this information to make smart choices. And I am seeing, plans and projections that we're going to have finally the number of tests that we need. The question is going to be, as they go quickly through the FDA, validating them, making sure that they're trustworthy. I've already talked about false negative rates to make sure that we know their performance is good. But I'm confident, actually, that we will soon have enough tests.
So I know that you're a cardiologist, and White House trade advisor Peter Navarro has said that the shutdown could be deadlier than the virus itself. And he said that medical experts are tone deaf to this. So as a medical expert yourself, is there a risk when it comes to the shutdown to people's health from an economic standpoint? Impact?
Yeah, and I'm not sure why he says that. I think most of my colleagues and most folks that I've talked to around the country, we're all very sensitive to the fact that the virus can be deadly both for its direct and indirect effects. I mean, the direct effects are, what does the virus actually do if you get infected? What kind of risk are you at? But we also know that in a period of social distancing, people are afraid to come to the hospital, where we're no longer, as doctors, being able to see, patients in ways that we have traditionally done. And, and patients maybe not getting access to their meds, being afraid even to going out to pharmacies. I mean, there's all sorts of secondary effects here that can be at play that put people at risk because they have trouble managing their diabetes or their heart disease or their heart failure or a whole range of conditions that they require them to have easy access to meds and easy access to the healthcare system. And we're doing our best. Telemedicine's taken off. We're trying to make sure people get their meds. But he's not wrong. This is something we've got to be very sensitive to. And as we look at what's going on, we need to be able to measure and monitor, where's harm occurring? Or what can we do to mitigate that harm? And how can we move quickly to address issues that are standing in the way between people and their health? But yeah, I think that I don't know anyone who's not aware that it's not just the direct effects of the virus and the devastating effects that it can have on people and the risk that it puts them at, but that there are plenty of other people. And I wrote about this in the New York Times, where I said heart attacks are going down in the country, and one of our fears is that people are staying home, that they're having chest pain and staying home, or they're having severe acute emergencies and delaying, and as a result, putting themselves at greater risk, and that's likely also contributing to an indirect rise in the rate of deaths, in addition to what's happening directly from the virus. So we need to reassure people. If you have an emergency, while I'm on, let me just say, people, if you have an emergency, hospitals can care for you safely. Look, if you can stay home, that's great. If you can manage it through telehealth, that's great. But we are making sure people know, don't stay home because you're afraid if you've got crushing chest pain, if all of a sudden you're short of breath, if you're having trouble speaking, symptoms of a stroke, if your belly is acutely, painful. These are things that, modern healthcare can help you with, and the hospitals are equipped to take care of people in emergencies. So, this is preventable harm, and we do not want that secondary death toll to occur because people were afraid during this period when actually hospitals can care for people safely.
Dr. Krumholtz, going off of that, just making sure that we are able to tackle this disease, that we do it in the most efficient way possible. I need to bring up the fact that President Trump cutting funding for WHO. If you're doing this in the middle of a pandemic, what's the impact of fighting this virus, not just on a national scale, but on a global scale?
Yeah, I would just express that this is a time when all across nations we need to hold hands and work together. This is a time where knowledge should travel easily across borders, and we need to be able to solve this crisis by putting every single person across the world, together in this and learning from every different experience, and especially those that come before us and those who are going to come after us. We need to be able to contribute as the world community. There may be beefs that people have with organizations like WHO, but at this moment, it's time for us to pull together, to support each other, and bring the beefs, talk about them when you want, but we're in the midst of a battle right now. And in this battle means that we need to all pull together, and we need to, work together for common good. So I feel strongly that this is a time that put aside, any sort of disagreements and come together and work together, because this is a worldwide threat, and a threat anywhere is a threat here, and a threat here is a threat elsewhere. And we can learn together, and groups like the World Health Organization we need at this moment to help draw those connections. And I hope that maybe he can send a message that he was disappointed, but I hope that the United States will continue to be supportive of organizations that are connecting across the globe at this moment, like the World Health Organization, in order that we can channel important information together and feel as one as a world community in fighting this virus.
Yeah, I certainly agree with that, especially with worldwide confirmed cases topping 2 million. Needs to be addressed very quickly. Dr. Krumholtz, thanks so much for taking the time. I know you're extremely busy, so thanks for taking the time to join us this afternoon.
Oh, it's a pleasure. Thank you so much for allowing me.
Well, coming up here on Yahoo Finance, we talked about the sell-off that is underway with all three major indices firmly in the red at this point. The Dow, S&P, and NASDAQ off well over 1%. S&P off almost 2% so far this afternoon. Coronavirus delivering a major blow to U.S. retail sales in March. That's one of the big things that investors are keeping an eye on this afternoon. We're going to talk more about the decline that we saw in March, what that could mean for the rest of the spring and also into the second half of the year. We'll have more on that after the break. Welcome back to Yahoo Finance. Like we were talking about earlier, a sell-off is underway on the street, and that is, of course, has a lot to do with some of the economic data that we got out this morning. Retail sales was one of the weakest parts that we did see really for the U.S. economy over the last several months when we talk about the fallout here, the economic fallout from the coronavirus crisis. So let's dig into that report. When we take a look at the numbers, retail sales dropping 8.7% in the month of March alone. That was the worst drop on record. And for more on this, I want to bring in Mary Epner of Mary Epner Retail Analysis, a principal there. Mary, thanks so much for joining us this afternoon. When we take a look at this report, some of the numbers are staggering. Sales in clothing stores off over 50%. We also saw significant declines in furniture stores, in restaurants and bars, just to name a few. Let's just start with, how bad is this report from your perspective?
Well, first of all, in starting this, I'd like to talk about how I look at the business, whether it's now or whether it was 2 years ago. I look at what's the need to have, what's the nice to have, and what's the want to have. And the economy is comprised of the three at any time, whether it be apparel, gas, furniture, whatever. Right now, we have eliminated two categories, the nice to have and the want to have, because incomes are down. There's a lot of uncertainty. People don't know what's happening. And all they're focused on is want to have, or need to have rather, food, pharmacy, and dare I say, Netflix and other home entertainment. That's what they're focused on. And they're just working on getting a solid point of view from one voice in the government to tell them how this is going to go, because they're uncertain. And so in order to move forward, we need for certain things to happen.
Yeah, Mary, talking about the consumer losing confidence, they don't know what to expect here going forward. How concerning is that really for the overall economy?
It's very concerning because you have people from all parts of the country. Here we are in New York City. We're experiencing one level of, trauma, and there's something different out in Iowa or Missouri, something like that. And they get their information from different sources, and therefore that's what forms how they feel about it and their confidence in going forward. Also, are they working or are they not? If they don't have a paycheck coming in, most of the country lives paycheck to paycheck. Those are the facts. So if that's not coming through and they haven't gotten that stimulus check yet, so if they don't have it wired to them, then they have to wait for this check to be signed in order to use it. And chances are a lot of them are going to hold on to part of it or spend it on necessities. So it's very concerning.
So what does this mean for retailers just in terms of how long some of this weakness here from the consumer could last?
It could last a long time. And I don't want to be a downer here, but here's the reality. Let's talk about the biggest sector. And first of all, for a bright spot, we've got Walmart, we have Costco, we have Target, we have Dollar General, all doing well. And I believe that they will continue to do well because they have affordable, necessary items. They have groceries, and people are shopping there. They also have a nice buy online, pick up in store strategy, which helps. They do deliveries, they send it out, and so on. So that part, I believe, will be protected. The other part is really significant. And let's think of department stores for one, which we've heard a lot about today. Let's take stores that have mostly brick and mortar locations versus digital. And so let's take a Macy's, for example. They have hundreds of stores. Kohl's has hundreds of stores, and they have nothing going on in those stores. And their online business cannot offset the decreases. Meanwhile, the other thing I want to mention is all of these stores are accumulating inventory. They are packed to the gills, and they don't have a way to liquidate it because you can't take 600 stores worth of merchandise and sell it online. What is that going to mean? They have to liquidate it somehow through a jobber, through donations to charity or what have you. But this breaks down the whole chain going into the most important season of the year, the fall season. So just in those small examples, which are big retailers, it's very concerning. We've got smaller startups and established startups, and they could be stretched too. A lot of them don't have tremendous cash flow. And so they're at risk. Even established brands, as we've heard today, are going to go into bankruptcy. So there are a lot of concerns here that I see for these tried and true stores that you may not like or may not be the most appealing to talk about, but they employ a lot of people. There are malls with anchors of these stores. If these Macy's stores close, these JCPenney stores close, it impacts the ability of the other stores in the mall to exist. So it's just an idea of what we face going ahead.
Yeah, Mary, I wanted to follow up on the established brands that you were saying that are most at risk of going into bankruptcy. I know you just named Macy's and JCPenney's. Are those the retailers that you were thinking about when you made that comment?
So when I said bankruptcy, I'm thinking of JCPenney, and that's been, living on fumes for a long time. That's no secret. So that's one that I'm concerned about. With Macy's, what I'm concerned about is they have hundreds of stores and a lot of inventory, and they've had financial issues. Now, to say I'm not ready to say they'll go into bankruptcy, but I know that they have tremendous pressure on them because they need to sell a lot of merchandise. The other thing is they've had to, think about with Macy's, all the brands that they have to cancel incoming merchandise. So it disrupts not only Macy's, but all of the major brands with whom they do business. So I'd be concerned about their cash flow and how they move to the next level in the next 3 to 6 months.
All right, Mary Epner of Mary Epner Retail Analysis Principal there. Thanks so much for joining us this afternoon.
Thank you so much.
Well, big story that we are watching today is bank earnings. Financials pretty solidly in the red today. The XLF off over 4%. Now, this comes on the heels of disappointing results from Citi, from Bank of America, and also from Goldman Sachs. We're going to dig through those reports right after this break. Welcome back to Yahoo Finance Live. We are focusing on financials today. It's one of the worst performing sectors in the markets this afternoon. And this comes on the heels of some of the big banks reporting earnings before the bell. So let's go through some of those numbers for you. First, we had Citi. Its first quarter profit tumbling 46% as it sets aside more money for loan losses. And we're seeing that really echo throughout some of the big bank reports that we are getting. Bank of America posting a 45% decline in its first quarter profit, and Goldman Sachs, their profit falling just around 49% in the first quarter. So for more on this, I want to bring in Marty Mosby, a director of bank and equity strategies at Vining Sparks. And Marty, let me just start with a big picture, your reaction to the bank earnings that we've gotten so far. What do you think of the numbers?
Well, first, we knew this was going to be a rough quarter because of what happened in the economic disruption and how that creates this need to increase your credit provisionings. So credit costs go up in the anticipation of what's about to happen over the next couple of quarters. So the first thing to realize is the earnings are showing a significant drop like you've been reporting, but most of that's on the expectation and funding what losses that they imagine are going to happen. Now, losses hadn't happened yet. Net charge-offs haven't gone up, so we didn't see anything like that. So it's not the actual realization of losses, it's just putting into loan loss provisioning as they're anticipating those losses coming through.
Marty, why do you think Goldman Sachs is the reaction to their earnings have been much better as compared to Bank of America and Citi? Because Bank of America's stock is off just around 5% right now, Citi down over 3.5%, but Goldman is actually holding on to gains this afternoon.
Yeah, so Goldman actually has a business model and profile that benefited from all the activity in the capital markets areas. So as you saw equity trading volumes and fixed income trading volumes spike with the volatility in the marketplace, Goldman benefited from that. So the revenues were strong, and they don't have as much of a lending profile like the universal banks like JP Morgan or Wells Fargo or Citigroup. So they didn't have as much to offset the benefit that they got in capital markets with what they experienced in the losses on the lending side. So the balance worked out in their favor, and this is when those periods of time when they do outperform.
Marty, the big question when it comes to a lot of these big banks is to whether or not buybacks are going to continue through the end of the year. How likely do you think that is?
So two things. One, buybacks, the big banks have already pulled those back, right? So they've already stopped the buybacks. The dividends is really where everybody's most focused now. So will we go through like we did in 2008, where our dividend yields go back down to zero? What people are misinterpreting, and that's where you really have to pivot on these earnings. It's not about how much earnings you have. It is, are you exceeding your dividend? And every one of these banks, except Wells Fargo, has been able to exceed their dividend with the earnings that they produced in this particular quarter, with the massive increases in the provisioning for future losses. So we still see the sustainability of dividends for the meanwhile, as long as this shutdown in the economy doesn't last longer than going into the summer.
And Marty, from your perspective, when we're trying to just figure out what banks are best positioned at this point, I know you were saying some of the strength there that we're seeing from Goldman, but what banks do you think are best positioned to weather the deteriorating economic outlook that we are getting at this point?
So first off, you look at these banks, they trade in a macro sense when you go through these types of pressures. So it's really the idea of right now, let's focus on in total, is it the right time yet to be in banks, or do we need to wait longer? What we've basically seen is as we've gone through these types of compressions, the banks really react much later when the recovery starts to happen than the rest of the market. The 2008, 2010 has a bias towards the anxiousness of banks and what happens to their earnings and capital because of what happened in the Great Recession. They've changed their balance sheets over the last decade. Like we just said, they're still paying for their dividends and should sustain dividends this time. But what you're looking for is really, when do you want to think about getting back into banks? And what we've said is that there's still some patience to be had here, even though we're at levels where the spring is ready to kind of move back once we come out from under this economic disruption. But the timing is still not right. We still have to go through some quarters here, and in the second quarter being released in July. So it usually takes about a year for the banks to recover. So at this point, it's time to be patient. And if you really want to just get in there because you want to get early, you really want to look at the very high quality banks that typically investors go to first.
And Marty, I know in addition to the big banks, you also take a look at the regional banks too. What are you going to be looking for specifically in some of the reports that we have not gotten yet?
So there's really three things that banks need to accomplish in this period of time. The first is they have to make sure that their employees are taken care of and that they stay healthy as best as possible. So what we're watching and listening for is how are each of these management teams working with their employees. The second thing is that these banks are much stronger than they were a decade ago. So instead of being the sector of the economy that's sitting there needing help from the government, this is a sector that needs to lean in to basically change the perception and show what the last 10 years of building liquidity and capital helps the banks be able to do, actually help the economy bridge through this pressure versus creating additional pressure. And then lastly, what we're looking at is what we talked about earlier, is you got to defend your capital. So are your tangible book value levels continuing to stay stable, which we've seen so far? And then are you being able to earn through your dividend? So those two things are really how you defend your capital right now. It's much more about capital levels than it is about the raw number of earnings that you got.
All right, Marty Mosby of Vining Capital, or Vining Sparks, excuse me. Thanks so much for joining me this afternoon.
Thanks for having me.
Coming up here on Yahoo Finance, Apple actually unveiling a new, cheaper iPhone model. We've got the details on what you could expect from this phone, and we'll have that right after the break. Welcome back to Yahoo Finance Live. We're watching airline stocks today. It looks like the sector has some certainty over the next couple of months. The Treasury Department reaching an agreement with major U.S. carriers on a $25 billion rescue package. We have Emily McCormick joining us now with more on this. And Emily, I know you're looking into this story. Does this confirm that the U.S. carriers will at least survive, I guess, the next couple of months?
Well, this is something that we're getting a bit of a mixed picture on after the Treasury Department made its announcement yesterday. So to reiterate, this is an agreement right now that's in principle to provide relief to airlines, including American, Delta, United, JetBlue, Southwest, and Alaska, each of which applied for portions of that $25 billion payroll grant from the government. This is the largest ever government aid package to airlines. And at a high level, a couple of the things that this assumes is it requires that these carriers refrain from major staffing or pay cuts through at least September. They also can't buy back shares or pay dividends through September 2021 and must agree to limits on executive pay until late March 2022. Now, some airlines have issued their own press releases detailing the amount of support that they're going to be receiving. We had American Airlines saying it's going to get $5.8 billion in support. Delta said they were going to be receiving $5.4 billion, and Southwest said it's receiving about $3.2 billion. Now, the surprise here, or rather what was not necessarily expected at the beginning of these negotiations, was the fact that these funds are being structured as a combination of payroll grants as well as loans. So it's not completely a no strings attached type situation for these airlines. Just to break down one deal in particular, Delta's overall $5.4 billion package comprises $3.8 billion in grants and $1.6 billion under a 10-year unsecured loan. The carrier also also has to provide the government with warrants to acquire about 1% of the company's stock at $24.39 a share over 5 years. So there is an element of dilution here to this package, and that's one of the reasons that we've been seeing the stock prices fluctuate after this deal was announced. And
yeah, that's interesting.
Yeah.
So it sounds like, because I was reading a note from JP Morgan that was out this morning, but their I guess takeaway from this was the fact that it was disappointing relative to the initial expectations of the airline. So it sounds like that's what you're saying as well. Just it wasn't live up to some of the hopes that a lot of the major carriers had at this point.
Definitely. And I think Jamie Baker with JP Morgan really captured analyst sentiment overall with this deal. I mean, analysts really were lukewarm on this announcement and really highlighted that the Treasury Department took a harder line approach than initially had been expected. And to pull a quote from that note from JP Morgan, Baker said, quote, "We're impressed and concerned with the government's hardline approach. What was once thought to be free, formulaic, and easy turned out to be drawn out, somewhat expensive and intense. Considering what turned out to be an arduous grant process, this level of sophistication and hardline approach suggests, at least to us, that a difficult path for loan applications may lay ahead." And we already know, because American Airlines just filed another SEC filing talking about seeking another extension of loans for multi-billion dollars from the government, that this could be something that is more that they'll have to make more concessions in order to receive. So that's something that remains to be seen as this continues to play out.
All right. Thanks so much, Emily. I want to turn to the tech sector now. It's interesting. We got a big announcement from Apple earlier this afternoon, the company unveiling a new, cheaper iPhone model today. It's the first time the tech giant has launched an iPhone without one of its big events. You remember that there's normally a lot of hype before they roll out a brand new product. Dan Halley, of course, is with us. And Dan, I know you're looking into the details of this new phone. What can our viewers expect to see?
Yeah, it starts at $399, so that's a heck of a starting price for a new iPhone. The big thing here is it's not going to look like the iPhone 11, 11 Pro, 11 Pro Max. It's going to look a lot like the older iPhone 8, and that's done purposely. It helps cut down cost, but it also allows them to put in things like the current generation processor, the A13 Bionic, that's actually found in the new iPhone. So you're getting the guts of the new iPhones with the body of an older one. Also coming back is Touch ID. That means you also won't get the Face ID scanner that a lot of people have come to like. The screen is going to be 4.7 inches though, and I think that's important because there's a market out there for people who don't necessarily want giant screen smartphones like the 6.1 inch iPhone 11 or 5.8 inch iPhone 11 Pro, and then there's the iPhone 11 Pro Max, which is 6.5 inches. So I think this is going to be an interesting offering for Apple. The original SE did pretty well for them, and as they go into newer markets, particularly India, where their devices are still too expensive for a lot of the population, a $399 iPhone would go a long way there.
It is interesting that Apple's rolling this out right now because Apple stores are closed, so people won't be able to go into the store and try it before buying it. How significantly do you expect this to weigh on demand potentially in the short term?
I don't think it's really going to weigh on demand at all very much for them. You'll be able to look at it on the website. And I think people really know what they're going to get when you say that it looks like the iPhone 8. I think what the issue might be is whether or not they can get this to people fast enough. We have the new iPhone coming out later this year. Presumably people may be holding out until then to upgrade. So this would really be for people who are just looking for a basic smartphone, something that Apple really hasn't been able to offer at the price points they have. But at $399, this is really a sweet spot for them. It's going to compete directly with lower cost Android phones. And I think the fact that you can say it's an iPhone means a lot more than some people might say if they pick up an older Samsung phone or something along those lines.
Hey, Dan, I want to stay within the tech space, I guess, and talk about Facebook. So it's interesting. We've been talking about the number of scams that have been coming out right now in the midst of the coronavirus crisis. Well, there's thousands of Instagram accounts that are promoting face masks that could actually be fraudulent or pose some sort of safety risk. You're digging into this story. What are the details here?
Yeah, this is something that has kind of been plaguing Facebook and Instagram, really. for a while now, and they've said that they're cutting down or trying to kill off the amount of people that are on their platforms promoting these phony masks or phony treatments for things like COVID. I was on there the other day. I found a couple of books that said that they can teach you how to beat COVID-19. Someone was hawking a painter's suit. It's basically just a white covering that you use when you're painting so your clothes don't get ruined as a way to fight COVID-19. And then a couple of different masks that were on there. Now, Facebook and Instagram say they don't want people monetizing masks on their platform at all, aside from those homemade ones that you might see that are made of bandanas or somebody sewed. Those are okay, but they had their algorithms going to try to take them off the platform entirely if they're legitimate masks that will be used or could be used by people like medical workers. And they're still running into roadblocks where you have these kinds of issues, such as this painter's suit that I had found or a book that I had found. And some people are still on there selling masks saying that it'll stop the virus. So they're trying to cut back, but obviously it's not near 100%.
Yeah, well, it's an important story and also very important for our viewers to know just the number of scams out there at this time. Dan Halley, thanks so much for bringing that story to us. Checking in on the markets now with just over an hour left in the trading day. We have the Dow off just around 1.5%, S&P off nearly 2%, and the NASDAQ also posting significant losses, down just around 0.9%. We'll be right back. Welcome back to Yahoo Finance. It's now time for our ETF report brought to you by Invesco. So earlier this month, the Fed announced that it was expanding its bond buying and would now include companies recently downgraded into junk territory, as well as junk bond ETFs. So we want to talk a little bit more about this. And we have Ben Johnson, Director of Global ETF Research at Morningstar. And Ben, let's just talk about what the Fed is doing and what this could mean for junk bonds. Because when we think about junk bonds, we think about what is traditionally a riskier asset, but now there seems to be some more support, or now there is support for them in the market. So how are investors responding to this, and how much demand do you expect there to be for junk bond ETFs amongst investors?
Well, what we've seen to date is that the Fed has indicated that it might at some point in the future purchase either investment grade corporate bond ETFs or junk bond ETFs. But what it has done to date in regard to both of those is absolutely nothing. So as of April 9, it is yet to actually make any of those purchases. Meanwhile, investors have all been positioning themselves to effectively front run the Fed. So if you look at flows into LQD, which is the iShares investment grade corporate bond ETF, since the Fed made its first announcement on March 23rd, those have amounted to nearly $10 billion. That fund's gone from trading at a pretty steep discount to its net asset value to now trading at a premium to its net asset value. And what you've seen subsequently following the Fed's announcement that it would expand this program to include junk bonds and junk bond ETFs is that there's been $1 billion that's flowed into LQD's high yield sibling, HYG. So again, evidence of investors trying to position themselves to get out in front of the Fed, which for its own part has done nothing, has not purchased a single share of any of these funds.
Yeah, it's interesting what we're seeing play out right now in junk bond ETFs. But Ben, I want to take a step back and just talk about the ETF sector really at large. When we talk about the number of launches in the ETF sector, there really hasn't been too many over the last several weeks. The numbers there has slowed significantly. What kind of impact is that having on the ETF market? And I guess how long do you expect it to be until we see those numbers return to a more normalized level?
Generally speaking, even if you look back to before this whole crisis, what we had seen was a gradual slowing in the terms of net new ETF launches. We've actually seen record numbers in recent years of ETF closures, and that's really just a sign of the natural maturation of the space. That said, we have seen some new funds come to market in recent weeks. Most notably, American Century has just launched their first actively managed non-transparent ETFs. This is a fund type that's been over a decade in the making. And looking back, this could mark really a sea change in the way that asset management strategies are packaged and distributed to investors, or it could mark a concept that ultimately fizzles out. But certainly noteworthy, especially given the volatility that we've seen in the broader market and many of the concerns that the SEC had with this format that caused it to push back for the better part of a decade and make the providers of these funds jump through a lot of hoops and do a lot of gymnastics to finally get these products out on the market.
Yeah. And it certainly is interesting to see what's playing out in that sector right now. Ben Johnson of Morningstar, thanks so much for joining me today.
Thanks for having me.
Coming up here on Yahoo Finance, a new demand from the Treasury Department could potentially delay your stimulus checks. We'll have more on that right after the break. Welcome back. With millions of Americans waiting for their stimulus checks, the Treasury Department has ordered President Trump's name to be printed on each check, and it's a move that could potentially delay the delivery of these checks. We have Sabeel Marcellus joining us once again. And Sabeel, you're looking into this story. What do we know at this point?
So, Shauna, here's the deal. Many Americans have already started receiving their stimulus payments directly into their bank accounts. What we're finding out now is that the Treasury Department has ordered that the IRS print President Trump's name on the paper checks that are going to be mailed out early next week to about 70 million Americans. Now, the concern is that getting President Trump's name printed on those paper checks is going to delay them even further. Now, we reached out to the Treasury Department to find out, is this going to cause a delay? And they said absolutely not. Here is their statement that they sent us. Quote, economic impact payment checks are scheduled to go out on time and exactly as planned. There is absolutely no delay whatsoever. In fact, we expect the first checks to be in the mail early next week, which is well in advance of when the first checks went out in 2008 and well in advance of initial estimates. Now, this is the first time that a president's name is actually being put on an IRS disbursement, be that a regular tax return or even times when we've seen the government send out checks to taxpayers because the economy had taken a turn for a worse or was actually doing better. Now, President Trump is being blamed for politicizing this whole stimulus check disbursement process. And you have a couple senators and congressmen speaking out. Senator Gary Peters told Yahoo Money that this is outrageous. He said that we already knew these checks were delayed. Now this. You've got Senator Ron Wyden. He's the top Democrat on the Finance Committee, who said that Trump is delaying cash payments to millions of Americans to, quote, feed his ego. And lastly, Sean, I just want to mention Congressman Tim Ryan, who said, are you freaking kidding me? And he said that the average person where he grew up in Ohio would be appalled by something so obnoxious as trying to get your name on your check for your own political gain.
Yeah, certainly. There is a lot of outrage after this story broke overnight. Sabeel Marcellus, thanks so much for bringing that to us. We have just a few minutes before the top of the hour with just around an hour left in the trading day. Dow, S&P, and NASDAQ all firmly in the red. We'll be right back.
All right, good afternoon, everybody. Welcome to Yahoo Finance Live. Miles London here in New York. Let's take a look at the market right now because we've got a bit of a comeback on our hands here. If we look at what's happening, especially with the NASDAQ, once again, tech stocks really doing a lot of the work here. The NASDAQ is off about 0.7%. The Dow off about 1.3%. The S&P 500 is the laggard today. Benchmark index off some 1.6%. But after a pretty sloppy open and a messy first couple hours of trading, just a whole run of terrible economic data from retail sales, another New York Fed print, industrial production, home builder sentiment, all of these really falling off a cliff. And we've talked so much this week about the handoff between virus-related headlines and the economy. Certainly what the economy is telling you today is shocking. It was expected to some extent, but still shocking to see the actual numbers come through. But want to go to the FANG names because we have talked ad nauseum about how these leaders, these tech giants, Facebook, Apple, Amazon, Microsoft, Netflix, Google, they were going to be the tell here on what the market really looked like from a top-down perspective. And they continue to do so much of the legwork, more than their share of this work, their work to keep the market afloat here. We see Amazon shares up 2% again today, another record high for that stock. Netflix shares up 5% back at a 52-week high, $434 per share. Alphabet shares, they are closing in on $1,300 per share here. So we continue to see these big cap tech names repair themselves in this market. I want to bring in my co-host now, Jen Rogers, for a little bit more. Jen, on just what stands out to you today, because I think that yesterday we had Jim Bianco on, and we're going back through all the discussion of bear market rally, what happens next, so on and so forth. But this market, I think, against all consensus, continues to look fairly healthy.
I mean, certainly looking healthier right now than it did just 2 hours ago. To your point, Miles, look, we've had ugly data today. The retail sales number is terrible. The home builders number is bad, but we knew these were all going to be bad. And this is like the push and pull that investors are going to be dealing with for a long time. Sure, we know bad numbers are coming. Then when they come, what do we do with them? Outside of the economic numbers, I think today there's also a lot of focus on what we've heard from retailers, in particular, Best Buy, with what they are doing in terms of the furloughs. The labor picture is, we have not even seen what is below the surface here. The numbers that we've gotten so far really do seem like the tip of the iceberg. And remember, most of the iceberg is under the water.
Yes, that was 107 years ago this month. Is that right?
Oh, geez, did I just make a Titanic reference?
That's how I saw it, but I believe it was April 11th or 12th. So
really? I had no idea it was this month.
I was actually wondering, is this like a subconscious, your kids are learning about it in school, so the reference came through, but we'll leave that offline. But I want to bring in Jared here for, Jared, a little bit more just on what jumps out to you in this market, because so many of the themes that we've hit on it's funny how everything happened all at once in this market. If you go back to late February and early March, it seemed like every day there was some new shocking story to pull out of this market. And it's funny how I now feel like, this feels like a tired conversation, because it's like day 6 where we're looking at the same themes in this market. But it does feel like a lot of what we've been keying off of, volatility coming down, tech leading the way, continues to be the driving force here.
Yeah, I think somebody else said it best. We got a decade's worth of Fed headlines in about 1 or 2 weeks, and that just applies to everything. It's writ large. None of us can remember what happens from one day to the next, for the most part, if we can even remember what day it is. We're all just a little discombobulated. But let's take a look at the price action in the S&P 500 today. Yeah, we started out down, went down to what day traders would call the support 3. It's a floor trader pivot. And the only reason I bring these things up is because the market is trading somewhat normally. Yesterday, we had this uptrend in place. Today, we gapped down. Here's that support level was respected. It was support on a few different ways. And, even though the market might be down by a lot, and we're still seeing 2 to 3% moves as the norm, we're still kind of climbing back into this semblance of normalcy. Now, with respect to the NASDAQ, I just want to point out a year-to-date chart and get that up. something interesting happening here. So yesterday, it managed to close above its 50 and 200-day moving averages. I didn't draw those in precisely, but they're right around there. And it might fall into a death cross today, or tomorrow, which would generate a lot of headlines. But that never happens this fast. And that just goes to show you how compressed all this information, these headlines are coming into this situation where we are right now. And where are we right now? We're climbing into resistance zones. And there are a lot of people with reasons to sell into resistance here. And so the market is going to have to find a catalyst to get through these areas. And right now, with earnings season upon us, with so much of the good news in terms of the US and New York not recovery, but the worst kind of getting past that out of the way, we gotta rally on better headlines here. And I'm not sure exactly where those are going to come from. And then you got the Fed, which is a huge tailwind, $2 trillion since March. So that's really what the market has going for it, Miles.
Yeah, Jared, I think death cross headline is more exciting in like 2014 or 15 when the market hasn't really done much for a couple of years in this environment. They might get the technical analysts maybe get a little short shrift when you have the Fed and others acting the way they are right now. All right, let's switch gears and talk a little bit about what's happening in the real economy, on the Main Street economy. The payroll protection program, PPP, those loans just about running out. Dan Roberts joins us now for more on that. And so I guess, Dan, we knew that we would eventually see the end of the current appropriations amount, reached. But is there any surprise on the SBA side that we've gotten there this quickly?
So, yeah, I think some people would be surprised it's been only 13 days. Then again, on day one, we discussed how banks were immediately flooded and overwhelmed with the number of applications. So I think you could have seen this coming, especially with the kind of changing guidelines. A lot of businesses I've spoken to, and I've spent the last week talking to small business owners who've applied for this program, a lot of them thought, oh man, I better get in on day one or day two because I don't want to miss out. The irony being that some of the people I've spoken to who got approved wish they maybe had waited a little bit longer, but it's probably too hard to try to game the system. There's that 8-week rule that once you get the funds, you have to apply them within 8 weeks. And some of the business owners who've received the loans are saying, well, geez, 8 weeks, I'd rather be able to wait and use it in, July or August when I'll actually be able to hire back my workers. Now I'm going to waste it on payroll for people that I'm not using because our business is shut down. Now, all that being said, as I mentioned, 13 days, we are just about to run out here. I believe it was Larry Kudlow earlier in the week predicted that the initial $349 billion pool would run out Thursday, but it looks more like it's probably going to run out tonight, today being Wednesday. The latest update just 45 minutes ago from the SBA was that $301 billion has been approved, and that's about 86 or 87% of that $349 billion. Now, of course, as I've been careful in the last few days to caveat, that's not the same as the amount that has been sent out. And by all accounts, the actual money that has been sent out the door, deposited in people's accounts, is very, very little, a slim, maybe 2% of the amount of loans that have been approved. Yesterday, I did a story talking to 4 small business owners who have actually received the money in their accounts. But in those cases, it was all small community banks. The trend I'm seeing is that the big guys, Chase, B of A, Wells Fargo, in the end, I'm sure they will have approved more money, but they are being very sluggish to send that money out the door. And confusingly, just one last note here, yesterday on the Chase call, Jamie Dimon said that Chase has sent $9.3 billion of PPP money out the door. I don't see how that's possible because I have yet to hear from anyone who has received their money from Chase. And I'm seeing new theories now that maybe that was a little bit confused and he was actually talking about the stimulus money, not the PPP money. I find it hard to believe that Chase has actually deposited $9 billion worth of PPP loan money into people's accounts. So suffice to say, the two big takeaways right now, the money's about to run out and we need to see if they can put more money in this program. And people who've had their loans approved have not yet actually received the money.
Yeah, so several waves here coming, I think, on the small business front. Let's switch gears a little bit and talk about a bigger business that is under pretty acute stress right now. That, of course, is JCPenney. Last night, Reuters reporting the company is exploring filing for bankruptcy protection. Now, this is not the first time that we've heard stories about JCPenney potentially looking at a bankruptcy filing, Jen. And I guess it brings up a growing theme here in the conversation around where American business is at. Obviously brick and mortar retail under a lot of trouble. Also, that going bankrupt doesn't mean you go out of business. I think there's been quite a bit of confusion on this front. But with JCPenney coming out in an 8K saying that they didn't make one of their bond payments, clearly they're looking at ways to lengthen, I suppose, their financial timeline here.
That's right. They had a bond payment or a debt payment due today. In June, they have a $105 million bond repayment. JCPenney has been in trouble before coronavirus, and they've been in turnaround mode. The issue is when you are walking on a tightrope, you do not want a big gust of wind to come along. And that's exactly what's happened here to JCPenney. So there go all of your turnaround plans. How do you make this work? And as you said, bankruptcy does not necessarily mean that all of your 850 stores that are temporarily closed right now are going to shutter for good. It gives you protection from creditors. It would make the turnaround a different style than what they are doing now. You only have to look at the trading on JCP to see just what the street is thinking in terms of placing bets on this company, and look at how their bonds are trading to know that people are pretty skeptical of what's going to happen here.
You know, Jen and Miles, I would just jump in here on JCP and mention, we've been talking about a lot of businesses and companies slammed by coronavirus, and certainly coronavirus has exacerbated the situation, not helped JCP. But JCPenney, a company that was headed for this situation before coronavirus reared its head. And we've heard from Walmart and Target about how, you know, even during this time, our e-commerce business is actually doing quite well and thriving. Not the case for JCPenney, a company that, you know, it didn't have a great plan before coronavirus, doesn't have a great plan now, and hard to feel all that surprised that this business is hurting now.
And not, I would imagine, the last company that we're going to see similar actions out of. You know, Best Buy furloughing 51,000 employees. Company is in a much, much stronger position, but obviously everybody's feeling the pinch at this point in time. All right, coming up on the other side of this break, we're going to talk to Rich Greenfield about Lightshed's latest note out on shares of Disney, initiating coverage of the stock with a neutral rating and going through some pretty stunning drops in revenue that is coming, that is likely coming to the company over the next year to 18 months. We'll talk to Rich about all that coming up on the other side of this break. All right, welcome back to Yahoo Finance Live. Miles London here in New York. Time now for our call of the day. Today we're talking about Lightshed's latest on shares of Disney, initiating coverage with a neutral rating. We're joined now by analyst Rich Greenfield. So Rich, when I went through this report, a number of things stood out, but as you're looking at the comps for Disney, we're doing 2019 to 2021. So I guess the question is, how do you even look at what the results might be for 2020, and how severe of a drop is Disney looking at across its business lines?
I mean, it's going to be pretty brutal for Disney. There's no doubt about it that when you think about just how bad 2020 is, I mean, think about it. this is not just a normal recession economic impact. We're not just talking about advertising being under pressure. Yes, TV advertising is definitely in full collapse right now. You're seeing auto companies pull back. You're seeing big telecom companies like Verizon pull back. I mean, across the board, you're seeing cutbacks. I mean, insurance companies are still spending a lot, and you're seeing some pharmaceuticals come in. But Disney is uniquely exposed to this because it's not just a recession. They can't make movies, let alone release movies. Their theme parks are closed. Their cruise ships are closed. And the problem is, when will it be okay to do these things? Like, you can open the parks on October 1st, which is the beginning of their fiscal year. But just because you open the parks, does that mean consumers are comfortable? I mean, 15% or more of Disney's attendance at Walt Disney World in Florida is overseas attendance. They come, they stay longer, and they spend more. The locals who drive to Disney, they're not the ones eating at the restaurants and buying merch. They're buying annual passes. I mean, they're the lowest revenue profit guests that Disney has. They help fill the parks, but they're not what's making Disney money. Will international travel, I mean, how many airlines have cut routes? How fast does that come back? When will it be okay to fly from Europe into the US and go to Walt Disney World? I mean, these are big questions when you think about the impact on Disney's earnings. It's why we think that, this is a company where earnings are really going to be dramatically below what investors are expecting. We're thinking the number is going to be in the low twos, both in 2000 and both in 2020 and in 2021. We are dramatically below what consensus expectations are. And, I think probably one of the most under thought about pieces of this, I mean, everyone sort of knows theme parks are taking it pretty hard right now. But Disney is not like the other movie studios. So yes, Paramount may not put out the new Top Gun. I know for Top Gun fans like you all were, Dan, that you're probably distraught by that. But Disney Paramount not putting out Top Gun is bad for Paramount. But think about what happens with Disney. If you don't put out Mulan or you don't put out Black Widow, then you don't sell consumer products and merchandise and licensing. You don't have a new ride that you can build for Walt Disney World. You don't have new content for Disney Plus. The kind of the flywheel of the movie studio is uniquely important to Disney, more so than every company. It's what made Disney such a great investment over the last 5 years as the studio was humming, but it actually works against you when you aren't coming out with movies, and we just don't know when that's going to be possible again.
Rich, your note does a great job of really explaining and showing how the flywheel has worked for Disney, but what the destruction of the downstream revenue is going to be. There's also been a management change at Disney, but as the New York Times reported this week, Bob Iger, or you can just refer to him apparently as Bob, not Bob C., is back. He's taken charge again. Does that give you some comfort? Do you think that having Bob Iger back really taking the reins is going to be able to make a difference?
Well, first of all, I find it a little odd that the Walt Disney Company has not actually publicly come out and said Bob Iger is now effectively CEO again. I mean, right now, we're all relying on an email that was sent from Bob Iger personally to the head of, or to a writer at the New York Times, Ben Smith, who I think the world of Ben. But I do think it's funny that Disney hasn't come out and said, no, Bob Chapek actually is in charge and he is our CEO and making decisions. We're relying on an email commentary in a story in the New York Times for who's in charge of Disney right now, which I just think from a disclosure standpoint, corporate governance standpoint, is literally mind-boggling right now, Jennifer. So, but put that to aside. I think whoever is running Disney, it doesn't really matter. The real question is, what are you going to do? They're in this really difficult position of you either release movies before the public is ready to go see movies. I mean, let's just say Mulan right now is dated for July 24th. I can't imagine letting my kids, let alone myself, go to the movies on July 24th. Even if there's social distancing, I think that is a hard thing to imagine. I can control who comes into my house. I'm not sure I want to be in a movie theater with lots of other people that I don't know. And so the question is, let's just say you come out, and I'm sure there's some people that will be comfortable in July going to a movie theater. But if you had a movie that was going to do $1 to $2 billion of box office globally, and it only does a couple $100 million, do you release that film, or do you wait until next summer, meaning wait an entire year till summer of 2021? That obviously destroys the whole pipeline that we were just talking about. But do you wait until you actually can do the revenues you thought and kind of stymie your whole business? These are the types of decisions. I don't know how Iger, Chapek, whichever Bob is in charge, I don't know how you make these decisions. This is a really difficult position for them to be in, especially when, I think what Wall Street hasn't focused enough on broadly, if you think about investors, is that leverage because of the Fox transaction and now the collapse of earnings. Disney could actually, during this fiscal year, Disney's leverage could hit 4 times, and they could end the year, it could be north of 3.5 times. And so that is way beyond Disney's historical comfort zone. And if 2021 is going to be a really bad year as well, it's not getting better anytime soon. And so how much of Disney's kind of future investments are they going to have to scale back from Disney Plus to Hulu International? How many things are going to get cut in order to kind of, I don't want to say stay alive because they're definitely staying alive, but in order to get back to a comfortable financial position, how much is Disney going to have to delay? And I think that's really the big fear we have is how much does their financial position really cause them to change their strategic direction? And they're going to have to make some very, very hard decisions. That's why if I'm an investor looking at the space, the last stock I want to step into for a recovery is Disney, because they're in a much worse position than every other media company right now. And the stock, when you look at it at 105 or whatever it is trading right this second, doesn't reflect that worse position than everybody else.
Hey, Rich, Dan Roberts here. Thanks for coming back on.
Thanks.
Let's end this way just briefly. I know we're talking about Disney, and obviously the one silver lining has been Disney Plus and the good numbers there. Netflix been doing well. Obviously, everyone is at home and they're watching streaming content. So you would think maybe a good time for Quibi to launch, which just launched. Of course, it's only on phones. They're going to have to get it on TVs fast. And then today, NBC Peacock to launch at first just to Comcast Xfinity subscribers. But there's negatives on both sides for these offerings, and it's hard to believe in Peacock's case that many people are going to add yet another unless they feel they've exhausted some of the other platforms. So just quickly, can you give us your thinking on kind of the prospects for success in the next few weeks or months for both Quibi and Peacock?
Well, let's step up to a higher level for a second. So Dan, maybe Dan and Jennifer, are you both cable satellite subscribers right now?
No.
Neither of you?
I have cable.
Okay. So you have cable.
I'm YouTube TV, Rich.
Okay, so you're a $50 a month. She's a more expensive subscriber, but you both have linear television at $50 to $100 a month before broadband charges, but you're paying $50 to $100 a month.
Yep.
I think what we're learning though is that you've gone from what was probably before Dan $100 service, you're now paying $50. Jennifer probably moves from that $80, $90, $100 service down to $50. If not, she realizes she's not a huge sports fan and she can actually live without the big bundle. And then she's cut her bill from 100 down to 0. And so I think the question is, as you think about all of these entertainment options, these are all you can choose, right? Like you can sign up for Showtime to watch Homeland, which just came out and I've loved this season, but then I can cancel the minute it's over. I don't need to be a Showtime subscriber for the full year. You don't need to be a Peacock. It is point and click. I can cancel Netflix with a click of a button. I don't think Netflix has too many subscribers who don't want the service. It's not like an ESPN that you were forced to take it as part of a big bundle, whether you wanted to pay that $9 effectively for ESPN or not. So I think the real answer is you're cutting your existing video bill pretty dramatically. Even if you're not a cord cutter, you're shaving like you are, and you're saving, $30, $40, $50 a month. You're going to redeploy that into other forms of entertainment, not just video, but let's just say in this case, will things like Peacock and Quibi and HBO Max, HBO Max is the easiest, right? It's the same price as the old HBO and you just get a lot more for it. Peacock, if you're a Comcast subscriber, you're getting for free. Quibi, if you're a T-Mobile subscriber, you're getting for free. If you're a Verizon Wireless customer, you're getting Disney Plus for free. I'm a T-Mobile subscriber, I get Netflix for free. The reality is the actual wallet that's kind of available is expanding pretty dramatically as people reduce their spending on the bundle. And on top of that, they recognize that just like the apps on your phone, if you don't want an app on your phone, what do? Sometimes you just leave it there and never go back to it, but it's pretty easy to delete an app. It's pretty easy to sign up and cancel things on your phone. It's not like getting on phone. Think about what you used to have to do. You'd call up Comcast or Charter Time Warner Cable back in the day, and you would be tortured for hours. There's that famous video clip on YouTube of that person spending 2 hours trying to cancel their Comcast service. Canceling your Showtime or canceling your whether it's Quibi or whether it's Peacock, it's literally the click of a button. And so I think the honest answer is people are going to have a lot more of these subscriptions than people are currently expecting, because you're going to manage in and out. And plus, you're redeploying spending from what you were spending on your big video bundle, especially if you're not a sports fan, and you're going to subscribe to a lot of these things. I mean, look, there'll be ones that are core services like Netflix, but I actually think you're going to try a lot of these things, and the ones with good programming will capture subscribers.
All right, we'll have to leave it there. Rich Greenfield with Lightshed. Next time we'll do sports rights fees and how the next re-up cycle is going to be. We'll get into that at a later date. Rich, thanks for joining today. We'll talk to you soon.
You guys are great. Thank you.
All right, coming up on the other side of this break, we are going to talk to Bethany Frankel about her Be Strong initiative and what she's doing to help hospitals and medical workers fight the COVID-19 pandemic. We're back with that right after this. All right, good afternoon. Welcome back to Yahoo Finance Live. Miles London here in New York. Taking a very quick look at the market right now. Coming back a little bit, we still have all majors off more than 1%, losing a little bit of steam as we head towards the bell. We'll have more on that coming up in just a bit. Right now, I want to turn to Bethany Frankel, entrepreneur and philanthropist, joining us now to talk about her Be Strong campaign and how, Bethany, how you're trying to help, frontline workers really in this time. And I guess I would just start with what you're doing and how you personally have found yourself, trying to make a difference. We're all trying to do what we can. It's a confusing time, and what you've done so far and how you see this program evolving.
Well, I was able to determine the mask shortage pretty early. We got into masks and hazmat suits. Prior to that, I was worried about people who I didn't realize would be in lockdown, people who just wouldn't be able to have hand sanitizer and wipes and personal PPE. So we created these Corona kits, 20,000 Corona kits, to be distributed with immunity tablets and hydration boosters and vitamin C. And so that was how it started. And then we moved on to the PPE and the masks. You have to pivot a lot when you're doing relief work. And we have to date distributed approximately $18 million in protective equipment for frontline workers, doctors, nurses, police officers, firefighters. And we have worked with over 15 states, now getting close to 20 states, with all of the states hit by the tornadoes, because we're pivoting again into doing tornado and corona relief in those southern states. So you kind of have to be nimble. It's a jungle out there with the protective equipment because the price gouging, the hoarding, the corruption, the counterfeit is out of control. It really is nothing like I've ever seen in my life. And you have to go into warehouses nationwide and inspect and vet. And it's just, you have to have a strong stomach. You have to be sort of a business person, understand contracts and how to negotiate and how to really vet things properly with a real doctor. And it's been a little bit gnarly. And that's why a lot of state governments are working with us, because they can't cut through the nonsense. It's really, time is so much more critical than even money now. So you just want to get people the protective equipment that they need while they're trying to save our lives.
So luckily you have that business background and a strong stomach here to deal with it. We keep hearing from doctors to be prepared for a second wave. So if this is going to be something that goes on for a long time, now that you've gotten some exposure to how the supply chain is working for PPE, what do you think we need to do to fix it so that the second time around, if, God forbid that's what happens, we don't have this mess?
Well, every time I do a relief effort, it's different than the one before. Puerto Rico, there was no way to get all of the aid to Puerto Rico, so we were amassing it from all the nation's churches and high schools, and then we were getting it there on 53 planes in and taking patients out and on barges. The Bahamas was a whole different story. They didn't even have any water, much less not good water, and they had no electricity at all. So that was even worse than Puerto Rico. We were in Guatemala where you needed masks because it was a volcano eruption. And I can tell you 50 different stories. The one thing I will say in defense of anyone trying to deal with this is that a natural disaster or some unexpected force majeure, there's no way to know what you would possibly need. I mean, if aliens landed on the reserve next to my house in a spaceship, I'm not sure that I would have what I would need to deal with it. So in fairness to people scrambling and even governments scrambling, you have to be so organized, and you have to be the type of person to run and gun, not blame. You can't be bureaucratic. You can't cut through you have to cut through all the red tape. You can't have 15 signatures required to do something. You just have to sort of get going. And I'm an organized person. I have that mentality. So I would say in the future, people will be stockpiling masks and there will be some ventilators and storage. But in another situation, it's generators and dialysis machines. I mean, I've seen a lot of different things through fires and hurricanes and earthquakes and tornadoes. So you have to just rely on people to just be organized. There is enough money, there's enough aid, there's enough food. There is just not enough organization. People are not prepared in an organized manner with the right task forces to deal with this. That's what I've seen. It's about a process that needs to be implemented the second you decide what a problem is and pivot to what the next problem is going to be.
Bethany, Dan Roberts here. Thanks for coming on. It's good to hear about your efforts during this time. While we have you and sticking with how coronavirus is going to impact the future, I just want to ask you, because of your origins in the TV and entertainment world, there's a lot of talk right now about how this time in America is going to change maybe all of entertainment. I mean, obviously, studios and networks aren't able to film new content right now, and we're talking about movies being delayed. And so there are a lot of theories about even once the coast is clear, so to speak, and businesses reopen, might this kind of change the Hollywood and the entertainment and television world forever in terms of more streaming at home? Maybe a lot more movies go direct to the home. I'm just curious, you'd be a good person to ask, obviously, with your background, what you think might happen in the entertainment world moving forward. And of course, just today, NBC Peacock launched for Comcast subscribers, and that has some Real Housewives content. I'd be curious your entertainment take right now.
Well, my entertainment take is I used to work in Beverly Hills as a hostess around the writer's strike. And I remember feeling like reality TV was sort of born out of that lack of scripted content. And then reality TV became an explosion. And it feels like more recently, scripted television has completely exploded. I mean, it was all about unscripted and reality, and then scripted television, can't even weed through all of the content. And I remember saying, how are we going to be able to consume all of this content? There's so much content. I need an assistant to just tell me what shows I should be watching. So I think now the unscripted shows that are run and gun types of shows that can just pick up and pick up a camera, do things at home. That's why cooking is so huge right now, because people can just start getting their ingredients together, pick up a camera and create content. So I think it's going to be a very interesting shift that will last for a long time based on everyone being home. I think people will work differently. I think people are realizing how many fewer employees they actually need, forgetting financially, forgetting that they might be in financial crisis. But I just mean I'm working by myself. I mean, I'm effectively working by myself. I have some people assisting me remotely, but you realize how much you can actually get done. And it affects real estate. People are going to say, do I need this 1 million square feet of office space when we're doing Zooms and it seems to be working out? People are selling clothing from home. People are entertaining. I haven't put a stitch of makeup on, in 6 weeks. And I'm sitting here with my black circles, communicating the message just the same. So a lot of things are going to be affected. And I think that it's so sad, and people can't eat and people can't pay their bills, and it will change everything. Real estate will change. But I do think it will be in many ways a level playing field. So a lot of people are scared, but people can find their way in now because it's a whole new world order. So people who really have no place in the playing field can get in, because we're basically at the starting gate with a bunch of horse races, and let's see who really can run in this environment, not in the Instagram filter, look how cute I look, in this great environment type of gross world we live in. It's going to be who works hard, back to basics, who works their ass off. That's who's going to be successful.
All right, a filter-free future. I love it. Bethany Frankel, thanks so much for joining us. Thanks for the work you're doing in the Be Strong campaign. Hopefully we can talk to you soon.
Thank you.
All right, coming up on the other side of this break, we're going to take a look at this market, and we will talk to Roger Parloff about Amazon's lawsuit over that $10 billion Jedi contract the Pentagon surprisingly gave to Microsoft. We are back with that right after this. All right, welcome back to Yahoo Finance Live. Miles London here in New York. Taking a quick look at this market right across the board. The S&P, the biggest losses here. Benchmark index off some 2%. The NASDAQ still leading the way, but is now down in excess of 1%. We'll keep our eye on that with about 20 minutes to go in today's trading session. I want to switch gears here and talk a little bit about an under the radar but extremely significant story happening down in Washington, D.C., which is the Pentagon's awarding of a $10 billion contract to Microsoft over Amazon and the lawsuit that is resulting from that decision. We're joined now by Yahoo Finance contributor Roger Parloff for more on this story. And Roger, we have talked to you in the past about this kind of entire saga, which really began back in 2012, 2013. What's the latest? And you have a very, very good, very long story in Yahoo Finance published yesterday about the latest details here. Where do we stand in terms of this program and the legal fallout here?
Well, right now, the lawsuit, the Pentagon is trying to get a stay, trying to freeze the lawsuit for 4 months because they want to have a time to try to correct what the judge found to be a very serious error in their reasoning, the type of error that could have caused the Pentagon to disqualify Microsoft altogether. That's the way the judge saw it. So they want to correct that error. And Amazon is opposing that. They say that Microsoft just wants a do-over, and that's where we stand. We'll get an answer to that probably in it could be days, just a few days. It's fully briefed.
And so, Roger, I guess to back up then and talk about the background of this story, I mean, essentially, we have Amazon alleging that the Pentagon followed the influence of the president and his family, because they don't like Jeff Bezos, they don't like the Washington Post, to award probably the most significant contract in the DoD's history to its competitor, which, as you note in the story, didn't even seem prepared to respond to the news, right? Microsoft took a whole day to issue a press release saying they had gotten the JEDI contract, which is not what you expect from a company getting probably the largest government IT award of all time.
That's right. It stunned a lot of people, and it's really the most. It's a totally unique situation for a government procurement contract. It's the most remarkable thing because there's never been a situation where a president of the United States was publicly and scathingly attacking one of the bidders throughout the procurement. So there's this serious question about were the source selection personnel at the Pentagon intimidated, either consciously or even unconsciously. And they've never tackled something like that. Never had a suit like that.
Roger, Dan Roberts here. Thanks for coming on. Let me just quickly ask too, for Amazon in this lawsuit, obviously Amazon is hoping to get a different decision. And obviously Amazon wants the contract financially and for business reasons. But also, don't you think there's something here that really is just about reputation for Amazon, reputation risk? You know, Amazon not wanting it to look like Microsoft Azure is hoarding in on its territory so much. So it's not just, to me, about the actual outcome here, but about Amazon kind of proving a point. Is that fair to say?
I think that's very fair. I think it's. I think that whoever won this, I mean, it's a huge feather in your cap. It's an enormous achievement for Microsoft. And like you say, it sort of means we finally caught up, because for a long time they were unquestionably behind. Everyone was unquestionably behind. And so, yeah, I think that's true. I think it's also, this is an extraordinary thing for a public company to bring this sort of suit, because it uses the I word, impeachment. It talks about, it makes parallels to what happened here and to what allegedly happened in the impeachment. And so I think that they're also sort of fed up with what's been going on for the past 3 years. They've quietly taken it, and then they just, when this result came down, that was the final straw. And it wasn't just Trump; it was also his son. That Donald Trump Jr. began to predict, in August, that Amazon was going to lose this. It was just, sort of crazy.
Yeah, I think it's interesting that Don Jr. would suddenly take an interest in procurement contracts. Roger, just quickly here, thinking about, you mentioned impeachment is part of this, but, so if that's the one political story for the last couple of years, obviously everyone in Washington right now is distracted with something else, which is the coronavirus, the pandemic, the economic fallout. How does that play, and in your conversations with folks down in D.C., How is that playing into this current battle wending its way through the legal system, if at all? Because I mean, this is a very significant, again, government contract being doled out among two of the biggest companies in the world, and yet it seems like it couldn't be further down the list of concerns given all that's going on right now.
Well, the case is not being postponed because a lot of it is submitted in writing anyway. They aren't doing a lot of. The last court hearing was, I think it was probably in January. It might have been in early February. This wasn't really on the radar, and they can. So it's going forward. It hasn't been halted by COVID yet.
All right, Roger Parloff, Yahoo Finance contributor. Thanks for joining the program. We'll talk to you soon.
Thank you. Bye-bye.
All right, coming up on the other side of this break, we're going to talk to friend of the program, Jason Ware, weighing in on today's economic data, the market action, what he likes here, and where we go from here. We are back with that conversation coming up right after this. All right, welcome back to Yahoo Finance Live. Miles London here in New York. We're joined now by Jason Ware. He's the CIO at Albion Management Group. So, Jason, let's start with a theme we've discussed with a number of guests in the last couple of days, which is this idea that we're seeing a handoff between the public health data, the public health emergency that we had late March, early April, and to the economic emergency that we're just unfolding, just starting to see unfold. Obviously, shocking numbers today on the economic side. Do you kind of get the sense that the market is going to key more off what we see from the economy in the weeks ahead and is taking the flattening of the curve as something that is in progress and likely to continue?
Hi, Miles. Great question and glad to be with you. And I think you sketched it out perfectly. You know, I think yesterday's rally and really the rally of the last 3 weeks has been based on optimism around a health emergency, which seems to be improving. Social distancing, stay-at-home orders, greater awareness is bending that curve. And it seems like the scientific community is really throwing all their resources at the health side of it. So there seems to potentially be light at the end of the tunnel. So what we get today is we get bad bank earnings, which a lot of those numbers look like typos. You know, looking at the retail data on the macro level, the manufacturing data, the housing sentiment survey, all of these things are inserting economic reality into what's been a fairly optimism-driven rally over the last 3 weeks. So I think as we look over the next few weeks, what's going to really matter for the market is, can we continue to do what we need to do on the health side to suppress the spread of the virus? And then on the economic side, are these rescue packages from the fiscal authority and then, of course, the Federal Reserve stimulus measures, are they going to dampen the downside a contraction in the economy. And I think if the data is less worse than feared, then that might be okay for the market. And I think if it's worse than feared, which by the way, the fears are really bad because we're seeing some really amazing data, not in a good way, then I think the market could struggle for a little while.
Jason, can I get you to expand on that a little bit more? Your thinking on how we're going to react to data. So today, just, retail sales and home builders and manufacturing, and we know it's going to be bad, right?
Yeah.
We knew that we were going to be bad, and then we're down. I just don't, how are you thinking this is going to roll out when you know it's ugly? Like, how much worse does it have to be than expectations? But what are expectations anyhow in an environment like this? We've never gone through this before. I don't think people know how to set their expectations.
Right, and that's a really important question. And I think the good news is that the Fed President James Bullard and a few other economists, well-respected economists, came out a couple of weeks ago and really put some ugly numbers out there. Unemployment going to 30% and GDP contracting by 30% on an annualized basis. And we've seen some initial jobless claims that again just are stunning. 16 million job losses over a short period of time, and that's probably underestimating the reality. So I think those things have set up some really sour expectations for investors and for the market at large. And the way we think about it going forward is, given that we don't really have any good consensus estimates. I mean, look at retail sales today. It was down like twice as much as estimates were expected. Same thing with the manufacturing data. It was 2x as bad as what we saw in 2008 and 2009 at the low. So I think generally speaking, it's not so much the absolutes of good and bad that are going to matter for stocks. It's whether things are improving or less bad than expected. And again, getting your hands around what that expectation is hard. And I think we'll probably learn about that in real time based on how financial markets react. But I think over the coming days and coming weeks, we'll start to adjust to what this new normal of a deep recession looks like over the short run. And the market's pretty smart about sniffing out how bad it might get and then setting the expectations on a relative basis to that. So it'll be interesting to see how it unfolds.
And, Jason, you talk about expectations and consensus, and we've written a lot here at Yahoo Finance about how basically every company has withdrawn guidance, and analysts are flying blind. They're making it up. But, we were just talking to one analyst who got a note out on Disney, and they're looking for, parks revenue down 47% in 2020. And they admit that's kind of a guess. I guess at a company level, is there any way that you're trying to game out what the financials could look like, even for a really, really strong business over the next 18 months? Or are you still like waiting on that front and just trying to get a macro picture before you start looking into single names? Is the process go top down, or are you actually going bottom up?
Yeah, we're approaching it from both directions. And the truth is that we're flying just as blind on the top down as most macroeconomists and strategists. And we're trying to get our hands on high frequency data as it comes in. I think the New York Fed has done a great job of releasing what they call their WE index, and it's a weekly economic index, which is even quicker and more reactive to real-time macro information than say LEI, which prior to WE was fairly quick. So we're trying to get a handle on their high frequency data to see where this economy is going to settle out. I think a lot of that depends on stimulus and how effective that is. And I hate even calling it stimulus. It's really an economic rescue. So that's the macro side. And then on the micro side, bottom up, we're looking at our companies and evaluating them in real time based on what we think their earnings and their sales can look like within that macro context. And the good news is that the companies that we own, and we've talked about this many times in the past, we've stuck with high quality for a number of years. And the businesses we own have more visible earnings and revenue streams than a lot of these other more cyclical businesses. Companies like Amazon, it's at an all-time high. It's a little bit easier to model what their earnings look like over the next 2 quarters than it is to model something like a Carnival Cruise Lines, which is probably a dead and buried business for a while. So the good news is that at our portfolio, we've had an easier time of trying to size up what we think earnings look like over the next couple of quarters than some of the other money managers that might not be overexposed to quality. Looking at it at the S&P 500 at large, I think a 25% drop in earnings this year is certainly a reasonable expectation at the baseline level. So we'll see again, just like everything else, what happens.
All right, Jason, we're a CIO at Albion Management Group. Great to talk to you, and we'll talk again soon.
Thank you, guys.
All right, coming up on the other side of this break, we're going to talk a little bit more about this market, watching things as we head towards the closing bell. Major averages down about 2% across the board. We'll be back with all that coming up right after this. All right, welcome back to Yahoo Finance Live. Miles Lynn here in New York. Got about 3 minutes to go in today's trading session. The S&P 500 leading the way lower, down some 2.3%. Quickly want to call out the banks right now. We got KBW Bank Index off some 6.5%. We'll talk a little bit more about what's happening in financials after the closing bell, but certainly a big story during today's trading session. Coming up, we're going to have a quick break, and then we will have the closing bell from the floor of the New York Stock Exchange coming up at the top of the hour. We're back in just 2 minutes.
Welcome back to Yahoo Finance. We've got just about a minute left in this trading session. Today has really been marked by a lot of bad economic data coming out. Looks like we are going to close down here, probably off the lows of the session. We had retail sales out this morning. We've heard from home builders. We've heard from manufacturers, and it will come as no surprise to any of you that the economic picture is bleak. In many cases, we're looking at record declines for a lot of the data sets that we're getting in. We've also had some earnings news coming out today from banks, financial names here. Actually, Bank of America, though, looking like it's going to be higher here. We also heard from Goldman Sachs. Sector-wise, all 11 sectors to the downside. Energy off some 4.8%. That's the biggest laggard. Materials, real estate also off 4%. And financials, as I mentioned, more data coming out on earnings from the banks. XLF here is off some 4.3%. That is the closing bell on Wall Street. The Dow is going to be off just about 1.8%. The S&P is off some 2%. The NASDAQ, with tech yet again, seeing names like Amazon hitting highs, Netflix doing well, tech doing some lifting for us here, and that's helping the NASDAQ off just about 1.4%. The Russell, the small caps, yet again, seeing damage in those names, off some 4%. And the VIX here, which we applauded just this week, Miles, for saying, look at the VIX, everybody. It's below 40. Now I report to you that it looks like we're going to settle just above 40 again. But overall, to quote Jared Blickery from the 3 p.m. hour, this is a somewhat, we're trading, quote, somewhat normally. Would you agree?
I would absolutely agree with that assessment. And I think that what is getting, and it's, I think the reason it's more normal for, let's say, from a sentiment standpoint, is if you look at the conversation around why the market is behaving the way it is, from investors, from strategists. You look at what was in Howard Marks's memo last night. You look at David Zervos's note last night. Everyone's the way that we are now starting to talk about things is pretty classic frustration, in the sense that investors believe we are in a crisis moment, and that the Fed hasn't dulled us into something like a more normal period, and yet the market is acting like things are more normalized. I mean, when you see the banks down 6%, you are not going to have stocks higher. At the same time, banks have stunk for years, and we continue to see, XLC is off less than 1% today. Healthcare names, XLV is off 0.5%. The FANG names that we went through earlier, they're all significantly outperforming the market. The strong stocks here continue to act well, even when there's a bunch of bad news. And so, yes, the VIX is elevated once again, as you'd expect when stocks are lower, but the moves themselves are more explicable. And the stock market's not going to go up in a straight line every day during the worst recession since World War II. I mean, that's not something that's going to happen. But the idea that we need to have more and more dislocations and confusing trading days and things that are unprecedented. I think there's a lot of people who are surprised at how quote unquote normal this kind of market is. And I think that is a source, at least this is my opinion. I think that's a source of the frustration, probably a healthy sign, honestly, for the market going forward.
It'd be nice if we could take some of our superlatives and put them to the side for a little while. Let's bring in Jared Blickery here to run through some of the numbers. Jared, I know you've also been looking at some resistance areas here and been looking at the possible death cross as well.
Yeah, that always gets headlines, although as Miles pointed out, probably not going to get as many headlines when the NASDAQ eventually does have this death cross, giving everything else that's on. But here we have the major resistance level in the NASDAQ, probably around, I would say, 85 to 8,700, kind of right in there. But you can extend it all the way up to 9,000. So in this band that we're looking at, you're going to find people really motivated to sell, and also people who are underwater, frankly, trying to cover their positions. And never underestimate the ability or the desire, especially among retail traders, to be made whole, even if it's only by a penny or a dollar on a trade. And so that's why these things, these support and resistance levels, and talk about anchored VWAP, tend to be self-fulfilling. The other thing, Miles was talking about the banks before, and how the KBW Regional Bank Index is down significantly today. We can see that in our canaries. Now, we got a lot of markets in here that I'm watching, and the one that's worst off today is in the bottom right. That's KRX index, and you can see year to date it's still off 42%. Bank earnings today not helping, because if the majors, the big guys, can't get it done, what about the regionals? And we know they're struggling just to get these loans out. But big picture, yeah, volatility is contracting. There's this virtuous cycle in the markets, right, that happens. And as uncertainty begins to slowly be removed and markets go up, you see liquidity return. And as you have more liquidity, volatility contracts. So we're seeing the VIX down. All this put together is beneficial, but it can turn on a dime, because if the markets do sell off again, we're going to see that liquidity vanish, and we're going to be seeing these 5, 6, 7, even 10% moves again.
Andy, sir, we'll jump on in here. I was thinking this morning when the retail sales number came out that you could just go back to any show that we did in the fourth quarter, and it was just all about the consumer and how great the consumer was, and how different the picture is when you look at those retail sales numbers or the JCPenney news or the Best Buy news. It's pretty ugly out there.
Yeah, I think we really haven't accentuated yet this afternoon the numbers that came out today, which were dismal. I mean, those retail sales numbers, the worst in 38 years, okay? I'm old enough to remember, and so are some of the other people on this show. But then factory output, okay, that goes back 74 years. And no, I don't remember that. The worst number in 74 years. I mean, this is really epic stuff. And if you take a step back a little bit and think about the market actions since the coronavirus lapped upon our shores, first of all, it was a disaster, and then the market tanked, and then we hit that March 23rd low point so far. And now we've recovered, And, I think you could make the case I have that, this is an overcorrection to the upside. And so now, what we're seeing is, whoa, actually, there is some real impact on the real economy. And, if you get a situation like a bouncing ball, which gets back to Jared's work and the VIX and all that, you go, woo, 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 like that. And so we're in one of those lesser, moves, but, trying to get back to normal. But this kind of stuff that we're getting out today is, a reality check. And that's for sure. I mean, this is real stuff.
If I could just butt in for a second, it's Rick Newman here in Yonkers. So we're talking about terrible numbers, and they only impacted about half of the month in March. At the beginning of the month, things looked more or less normal, which means April's numbers are going to be even worse than these dismal superlatives we're talking about here. We might have to go back. We might have to find a nonagenarian to remember how bad it was the last time we had numbers like this in the 1930s. It's going to get even worse.
Thank you, Rick
Yeah.
Newman.
My grandmother can be a guest on the show.
Even though you're wearing a bow tie, yeah, none of us have got 74 years. I like bow ties, by the way. It's not a hit.
You're all talking about it.
Orville Rickenbacker.
That's for sure. Let's head down to Washington, D.C., where we've got Jess Smith standing by to get an update on the very latest on the Pandemic Council. Who's in, who's actually in, who knew they were going to be in, who was this a surprise for? Jess, what's the latest here?
Well, President Trump has been on the phone with industry groups throughout the day today. He had 4 calls on his public schedule, and then he tweeted just a little bit ago that he had very productive calls with leaders of every sector of the economy who are all in on getting America back to work. Now, President Trump, as you mentioned, did announce the members of his council yesterday. There were nearly 200 names on the final list. Some of the big ones here: JP Morgan's Jamie Dimon, Amazon's Jeff Bezos, Apple's Tim Cook. Those were some of the names that were on the list, but there were nearly 200 others. We will be watching the president's briefing this afternoon to see if we hear any more about what he's hearing from these industry leaders as he speaks with them about reopening the economy all throughout the day. Another issue that is getting a lot of attention here in Washington is the president's decision to halt funding for the World Health Organization. He says he wants to put a hold on that funding until they can review the World Health Organization's handling of the coronavirus crisis. He has been very critical of the WHO, but Democrats are saying that he's trying to deflect blame from his own administration. House Speaker Nancy Pelosi put out a statement saying it was senseless, it was dangerous, and it is illegal. She says it will swiftly be challenged. We also talked to Senator Gary Peters this morning, a Democratic senator from Michigan, and here's what he had to say about this move.
It's kind of hard to understand why you would cut off funding to a World Health Organization that's trying to coordinate the response to a pandemic. We should be all working together. The global community needs to come together to be able to deal with this. And I would hope that we could all work together to make sure that that's happening.
We also talked to Congressman Tim Ryan of Ohio this morning on Yahoo Finance, and he had some very harsh words for the president. He said this decision was one of the most irresponsible in the history of the presidency. Jen?
Hey, Jess, it's Rick. If I could jump in. I have a question on behalf of a lot of people who I think are wondering this. What is the point of this new council President Trump has called together, or councils? What is it supposed to accomplish?
Yeah, the president says that it is supposed to be all about reopening the economy, hearing from business leaders about what they want to happen before you're able to kind of get business going again. But there are a lot of questions about what these people are actually doing and what their specific tasks are. So I think we're looking to learn more about that. But the president says he just wants to hear advice from these people about reopening the economy. That's why you've had nearly 200 people on this list. But yeah, the actual goal and the specific maybe measurables from this group they're pretty vague at this point.
Jess Smith in Washington, D.C. for us. And Andy Serberg, you were just making an interesting point of some people that maybe aren't on this list as well.
Yeah,
it's interesting.
Yeah, there's at least one prominent CEO who's not on the list, Jen, and that's Randall Stephenson, the CEO of AT&T. And, you know, I guess you'd have to say that maybe President Trump considers him an enemy. And of course, AT&T owns CNN, which the president has long warred against and tried to block the Time Warner AT&T merger. So I'm sure there's a backstory there. We don't know what it is at this point, but it's not just an accident or oversight that Randall Stephenson is not on that list.
Isn't Jeff Bezos on the list, though, another so-called Trump enemy?
And that's the point, though, Rick. Some people are on this list and have not, and Jess, correct me if I'm wrong if you're still there, but some people are on this list and were not asked to be on the list. That the president just put the list together without getting anyone's consent. I think there's something to that as well.
As Jess said, I think we'll have some more reporting as this evolves. And it certainly will. Coming up, we got a 2-minute break, and we're going to be talking about prescription medicines. For all of us, that has been changing how we get those, from drive-through pharmacies to in-home delivery. We're going to talk with the CEO of Single Care, Rick Bates, about the evolving landscape for prescription medicine. That's next. Welcome back to Yahoo Finance. Down day for the markets, but healthcare was off just about 0.5%, so not as far off as the rest of the market. And I want to bring in right now Rick Bates. He's the founder and CEO of Single Care. Single Care is a prescription saving service that millions of Americans use to save money on their prescriptions. And Rick, you partner with a lot of bigger companies that we get our prescriptions from. So CVS, Walmart, Walgreens. I remember at the very beginning of when people were thinking we might be needing to shelter in place, one of the first tips was to get about a 3-month supply of your medicine so that you would have that. Now that we're beyond that point, what are you seeing in pharmacies? I mean, are people hoarding the drugs they need? Are all the drugs there that people need? How has it been just the last few weeks?
Well, so you're absolutely right. In early to mid-March, there was an absolute ton of activity with people getting to the pharmacies and filling their prescriptions. There was a fair amount of fear and a lot of stockpiling, and we saw a significant increase in prescriptions filled. But then most recently, with shelter in place throughout the country, folks have really been foregoing acute care needs and more focused on chronic conditions. So there's been a little bit more of a stabilizing or moderation of volume of scripts filled. And I do think that people who are concerned about potential shortages, it's smart for them to be aware and to stockpile for an extra month or two. And then we've seen the average days supply of a prescription go up to that 90-day level. We've seen about a 20% increase in our 90-day scripts.
Rick, there's been a lot of talk recently about the concerns around patients who are not necessarily infected with COVID, but are not, for example, not going to the hospital because they're worried about catching it, or they're not going to the doctor because they're worried about leaving their homes. I'm wondering how that has led to a boost for your business. We've spoken to a lot of telehealth people who say they've gotten huge demand on the back of this. What specifically have you seen?
Yeah, so it's been terrific for telehealth, and telehealth does fill a great need, especially around acute care challenges. And then they drive quite a bit of acute care prescription volume. So certainly we have benefited from that for the cash paying customer. But at the same time, our business, because of shelter in place and people not going out and about as much, really what we've seen is this need to change our access points to more home delivery. And whether that's mail order, it's drop off, or it's curbside pickup. And with the survey work we've done of our members and then the actual performance that we've definitely seen an increase of about 35% of people who are at drive-through pharmacies, curbside pickup, and each of the largest retail pharmacies have just done an amazing job adapting their models so that they can be more flexible and meet the needs of the consumers. And there still are a fair number that are going in store, but I would say there's been a moderation of scripts filled over the last few weeks.
Hey, Rick, what about people who can't afford to pay for their medicine? And, that's a problem now, maybe even a bigger problem next month or months to come. And maybe there'll be an expensive medicine that you can take to help ward off coronavirus. Have you discussed that with your team?
Yes, we've spent quite a bit of time on the topic of affordability and also making sure that we're always publishing the most accurate, up-to-date cost of drugs with our retail pharmacy partners. And it is very concerning, especially, that our country's moving into a recession. We've got millions of Americans who will likely lose their health coverage. And the primary purpose of our business is to enable consumers access to the most affordable meds so that they can continue to stick to their drug regimen, stay healthy. And then we obviously work at a drug level. We do work closely with the pharmacies based on what needs may emerge. So, we've already begun talking about how we can partner around access to testing as that becomes more available. And also, eventually, we're going to need a vaccine strategy. And that could look something very similar to flu shots.
Rick, you mentioned the distribution of testing and things like that. Can you maybe give our viewers a sense of the kind of lift that we're talking about here when it comes to, test and trace and the number of, what's the logistical hurdle in getting not just a couple million, tens of millions, hundreds of millions of tests out the door, even if they are, simple, spit in a tube, it comes out in a few minutes. I mean, I think people aren't really comprehending how big of an ask that is logistically for folks coming through the door, whether it's your service, getting things to customers. Do you have any way maybe to kind of put some scale on that people can understand?
Well, I actually learned today that in order for us to get up to testing 10 million Americans every day, we would need a 70-fold increase in our testing capabilities. And that comes after we've decided which are the most reliable tests. I do think that the work that CVS and Walgreens have done to create testing sites and to stand them up as quickly as possible, has really been a tremendous effort. And while they're making great progress, we're a long ways away. I mean, my concern is that this is many months out from us, and that even then it will be imperfect. So we're going to have real challenges here executing against this. especially as it's essential for us to have accurate testing if we're really going to reopen the economy the way that we need to.
And Rick, do you have any concerns over the supply chain for people getting their drugs? Because pharmacists are really on the front lines here. You know, when I go to CVS and talk to my pharmacist, and if I'm sick, there are issues there. Do you have any concerns about the supply chain?
So I definitely have some concerns. First, I would absolutely agree. The pharmacists are on the front line, and they've just done a tremendous job and are working tirelessly, especially because they do have significant demand on oftentimes reduced hours. But in terms of potential shortages, I worry mostly about diabetics and folks with lupus and hydroxychloroquine needs, because a drug like hydroxychloroquine, which we saw a 200% increase of prescriptions filled in over in the month of March, it's not proven to be totally effective. And we have an existing population of people who are battling diseases who must continue to have access to that drug. And I know that the government's working hard on ensuring there's an adequate supply and that they're pushing the drugs to the hospitals directly as well for patients in need. But this gets back to the earlier point of, I think anybody who has a serious health condition needs to think ahead, stay aware of the drugs that they're on, and then make sure they have at least an additional 30-day supply on hand.
Rick Bates, founder and CEO of Single Care, thank you so much for taking time to walk us through so many of the issues that are being confronted in your industry. Coming up next, thank you. President Trump halting funding for the WHO over the coronavirus response. Up next, Rick Newman is going to break down the implications of that decision. Welcome back to Yahoo Finance. Down day in the market. What do you need right now to cheer you up? Rick Newman, right? Rick Newman, come in here. Help me out. You must have something good to help me with. You're talking about the president and WHO.
I cover Trump. There's nothing good.
A positive, feel-good story from you. What's going on here? I mean, we all saw the headlines. Where does this go next?
My guess is that this is not actually going to be a suspension of U.S. funding for the WHO. So Trump said this yesterday, and as with many things, Trump said it during the briefing, and now everybody has to figure out, does he really mean it? What's actually going on? And it appears that what this has now become is a 60-day suspension of U.S. Contributions to the World Health Organization. So instead of holding back on a full year's worth of funding, it's just a couple of months. And my guess is it could end up being even less than that. It's hard to find anybody other than Trump who actually thinks this is a good idea, and even members of his administration whose job it is now to explain what he's doing, they're even squirming. And even Republicans are criticizing President Trump for this. So this could be one of those things that Trump threw out there, nobody really supports, and doesn't last very long. But as we seem to know now, it's at least on the books now for about 2 months.
And Rick, really what it was actually, though, was a jumping off point to put the whole blame of this thing onto China.
Yep.
Right? It was just sort of blame the outsiders, blame the Chinese, and the WHO was complicit with the Chinese, or let the Chinese do their thing. And by the way, the president blocked travel to China, and did I say China? Yeah. Right? I mean, that's going to be, I think, the strategy going forward to the election.
Yeah, absolutely. I mean, look, Trump's daily coronavirus briefings are basically an exercise in scapegoating. I mean, basically every single day he tries to point the finger at somebody else other than him. And just to provide a little perspective here, the World Health Organization at the end of January said, look, we have a global health emergency here. They didn't use the word pandemic until March, but they did say it was a global health emergency at the end of January. So the WHO was calling attention to it at that point, and lots of countries were paying attention. And Trump, he dismissed it for another 6 weeks, and it wasn't until March 15th, 6 weeks after the WHO said it's a global emergency, that Trump declared a national emergency. So as with many things, Andy, what he says now does not square with what he said then.
Rick, as you noted, people have been coming out saying this is not the best decision. Bill Gates has been out on record saying that as well. Do you think that this could get reversed? Yes,
I do. I don't think Trump would ever announce it, but I think there are ways for him to wiggle out from this. So they say, the way the fine print after the Trump administration officials explained what's really going on here. Okay, well, we're going to conduct an investigation into what the WHO did, and we're going to suspend payments to the WHO until the investigation is complete. They could complete the investigation tomorrow. They could say, yeah, we checked it out. Everything's fine. We're just going to go back to the way it was. Meanwhile, it looks like some other countries might actually step up with some funding here if the United States actually stiffs the WHO. And there's been no news about this. But imagine if China just decided to step up and say, well, the Americans are abdicating their global leadership role. We'll step in. We'll make up the funding shortfall. Trump would have to contend with that.
Rick Newman, more to come, I'm sure. More to come on this show. We are going to be talking about what is happening with the global economy. So earlier in the week, we had the IMF coming out telling us that we are all facing the worst recession since the Great Depression. And straight ahead, we're going to talk to Atlantic Council Director Josh Lipsky about the economic impact of COVID-19 and what it means for emerging markets and the Chinese economy. That's next. Welcome back to Yahoo Finance. Time to check the charts with Jared Blickery. Jared.
Yeah, we're going to take a look at the S&P 500 here briefly, and let's see if we can get this up. Oh, it looks like my program is crashing here. So yeah, volatility is contracting. I do want to bring attention to the 10-year T-note yield. That's down about between 8 and 10 basis points today, approaching this critical support level of 0.6% or 60 basis points. We start dropping below that, it could get ugly again, or it could signal that things are about to get ugly or be concurrent with it. Oil in the teens once again, and that's just a disaster. The IEA, International Energy Agency, coming out today and saying that the demand destruction in April could be as high as 30 million barrels per day. We also got the latest figures from the Department of Energy reporting a 20 million barrel build over the last week. And that's why oil prices are down despite these historic production cuts that Saudi Arabia arranged with OPEC plus. And then you got gold hovering near 7-year highs. So there's still a lot of risk and uncertainty in the markets. And I don't think there's any clear path from here. And I'd be hesitant to believe anybody who just outright has conviction about the direction of this market right now.
Jared Blickery on the market. Moving on to the economy here, I think there's a lot of people that are lacking conviction in this space as well. And I want to bring in Josh Lipsky, Atlantic Council Programs and Policy Director, a former advisor at the IMF, and also to Christine Lagarde. So, Josh, we heard from the IMF earlier this week about just how bad they think this is all going to play out. We're looking at the worst recession since the Great Depression. Does that sound about right to you?
Well, thanks for having me today. Yes, that sounds about right. I think in some ways, given this steep drop-off and the sharp drop-off, you could say it's worse than the Great Depression. But the difference between this and the Great Depression is the policy response. The Great Depression only became the Great Depression when the world economies failed to act. Monetary policy failed to act, fiscal policy failed to act. And we're seeing something different now. We're actually seeing major fiscal stimulus, $8 trillion. We're seeing central banks step up, credit to the Fed and ECB and my former boss, Christine Lagarde. So we're seeing some things that should give us hope, but there's a long way to go, and it's going to be a very rough time in the months ahead.
Josh, I want to get your thoughts on China. Yesterday in the economic outlook from the IMF, they had a growth rate of 1.2%. for this year. And I sense some skepticism in your voice that you thought that maybe that number was too optimistic. Where do you think it's actually going to come?
So let's stipulate that forecasting in a crisis is a difficult enterprise, and credit to the IMF for trying to do it. The Fed has suspended their forecast. So when you look at China at 1.2%, the IMF is saying that Q1 in China is going to be -8. We're going to know if that's accurate tomorrow. The question for me is, how does China recover in Q2 and Q3 when the rest of the world is going through the depths of its recession? And so you have to look internally in China and say, is there enough internal demand to drive somewhat of a recovery? And I think of it as like a reverse check mark. Goes down steeply, it's going to come back up some. How much is it going to come back up? That's the question. If you look at real estate numbers in China right now, you'd say, yeah, there's some positive signs there. So you can see the hope that China can recover and regain growth. But whatever it is, 1.2 or 0, it's bad news. Going from 6% growth to 1.2 is still a huge economic shock in China. And when you think of 10% growth a few years ago, it's a massive, massive economic shock to the people there.
Josh, you talked about the stimulus that we've seen around the world, certainly the most significant here in the US with $2 trillion, over in Europe with the ECB as well. There's a lot of question marks on why China hasn't gone all in this time around when you compare it to what happened back in 2008. How do you read that? Does that show that China just doesn't have the kind of ammunition anymore because of the huge debt loads they've piled up over the last 10 years? Or are they still waiting, and is there more coming?
So if the first answer is yes, debt is a key part of it. China's debt situation is far steeper than it was in 2008. But the other question you have to look at is, what are they going to spend the money on? It's not just about building highways and high-speed rail. That's what they did in 2008, 2009. Those projects aren't shovel-ready right now. So it's a difference in China of thinking, what are we going to spend this stimulus on? And you see that process going on right now in China. Actually, their central bank yesterday took additional actions, which was a sign that maybe their Q1 GDP is going to be lower that analysts expect. So I think the taps are going to open in China, but I think they've been trying to figure out how exactly are we going to spend this money. It's a more difficult proposition than it was 12 years ago.
Hey, Josh, it's Rick Newman. I want to know where you think we're going to be 6 months from now. So that would be October of 2020. If kids are allowed to go out for Halloween, they're probably all going to be wearing coronavirus costumes. But will you think the majority of people who still have jobs will be back at work, or do you think we'll still be far from that?
So my 3-year-old daughter very much hopes that we're trick-or-treating on Halloween. I'm a little skeptical about it, to be honest. I think we'll try to resume some normalcy, both here in the US and around the world. There's going to be a real fear of a second wave until we get a vaccine. And so I don't see mass gatherings. I see still millions of unemployed here in the US. And the real fear factor here is a crisis in emerging markets, which have weaker health systems, and that reverberating back into the advanced economies. And I think that's a bit of the untold story right now.
Hey, Josh, so you just mentioned EM, and, I think that's a really excellent point. And the problem here is, when you had the Committee to Save the World and those guys, they had very much of a global perspective, whereas right now we have very much of a nationalistic perspective. Is that going to hinder the recovery? I mean, it's kind of a rhetorical question, I guess.
Yeah. No, it is going to hinder the recovery. I mean, there's a difference between action and rhetoric. And if you look at action right now, the G20 today just did massive debt relief for the lowest income countries. And that's welcome. And, credit to the IMF and the World Bank for getting that together, and their voluntary private creditors who are signing on as well. And massive stimulus, as we've talked about, and central banks have stepped up. But there's a different feeling than there was in 2009. The G20 was formed basically to combat the global financial crisis. And they stood in London in 2009, and they said, we are not going to let this become another Great Depression. And so to me, the feeling of unity is almost as important as the money. And so we have a lot of the money, but we don't have the unified action. And that gives confidence to markets, gives confidence to people. It lets people know that if this gets worse, and it can, there's going to be a backstop. And I think that's what we're lacking right now.
Josh, just to build on Andy's point there, it seems like there's a real pushing aside of sort of this multilateralism that we saw back in 2008. And you've already highlighted with the G7 and G20. I wonder what the assessment is on the other end, whether it's, we were just talking about the WHO and, how significant they are, or the US doesn't seem to think they're relevant in the conversation right now. But the broader conversation being, where does multilateralism go from here? Is it just more nationalism on the other side?
It can't be, because the emerging markets, just getting back to that point, they're not going to be able to weather what the IMF calls this perfect storm without multilateral support, without the IMF, without the World Bank, without nations coming together to help them. If you look at the debt situations in emerging markets, the lack of adequate health systems, this is a recipe for disaster. And no one country is going to be able to fix that on their own. But if it spirals out of control in the next few months, it can affect the whole world. So the only answer is international cooperation and multilateralism. And that's why I think this IMF meetings this week are actually some of the most important finance meetings we've had since Bretton Woods. It's a real test of the moment, because if you can't unite around coordinated fiscal stimulus, around helping emerging markets in this situation, when it's a crisis of no one's fault, then it's never going to happen. So it's an ultimate test for multilateralism this week at the IMF.
Wow, one of the most important meetings in decades. Josh Lipsky, Atlantic Council Programs and Policy Director. I really appreciate your time and getting a chance to talk with you.
Thanks so much.
Coming up, we're going to talk to No Filter author Sarah Frier about the rise of Instagram, including the very complex relationship between the company's founders and Facebook's Mark Zuckerberg. That's next. So we are all on it, Instagram, but do you know the real story behind the social media network that is part of the larger Facebook? There's a new book out. It's called No Filter, The Inside Story of Instagram by Sarah Friar. I want to bring her in right now. This is the never before told story of how Instagram became the defining app of our time. And you wrote this book before the time of COVID and coronavirus. And so it's like a fascinating moment for Instagram right now. Can you take us back, though, to the beginning of this relationship between Instagram and Facebook, and then when the founders left? What happened? Is this a wedding story or a divorce story?
Well, there's always a story that is told to the public, what we all understand to be true, and then when you actually dig in, you see that it's quite different. And so what we all imagined for the last few years was that Instagram was this happily independent part of Facebook, operating independently with a rosier looking brand. And even as Facebook was going through all of its crises, Facebook users were escaping to Instagram as a place where they had better feeling about the product. In reality, behind the scenes, there was a lot of tension between Instagram and Facebook. Instagram had a lot of sensibility around how it wanted its product to look. They cared a lot about culture and creativity and making sure that they supported their famous users. They were not into the Facebook way of growing at all costs, and all of the notifications, all of the constant tweaks to the product to try to engineer it in a way that would reach more users. And over time, as Instagram succeeded, there was more of an ego clash between CEO Mark Zuckerberg of Facebook and CEO Kevin Systrom of Instagram. As Instagram reached peak, accelerating popularity, Facebook was going through an existential crisis around its role in the world. Delete Facebook was trending. Zuckerberg was being called in front of Congress. And Zuckerberg asked to look into whether Instagram's popularity was cannibalizing Facebook's potential. So we actually started enacting some retaliatory measures against Instagram to make sure that they didn't overshadow Facebook's potential growth.
Hey, Sarah, so I was reading Nellie Bull's review of your book, and I love the way it started out. Just like, I don't want to read a review or read this book, and I don't want to even write a review of it. But then by the time I got into it, it was really compelling. And I kind of felt the same way, even about reading a review. It's like, do I really want to get into this? And then I realized there is so much history, narrative, story to it that it's pretty interesting. And, knowing Kevin Systrom a little bit, and, he's the preppy guy from the East Coast, and then how he fit into everything, and that he's been sort of, assigned this role, and probably to a degree accurately, of the good guy, and that Mark's kind of the bad guy. And now Kevin's off, and he's been pretty quiet. And I'd like you to address that, what he's doing, but also this whole notion of splitting Facebook up, of course. And is that even still possible? Because the more people have talked about that, the more Zuckerberg has tried to bring everything together, right?
Well, I think it's a lot easier for Kevin Systrom to be the good guy, considering that he did not, because Instagram was part of Facebook, he did not need to be held personally accountable for a lot of Instagram's problems. In fact, when Facebook's Mark Zuckerberg was testifying in front of Congress, Kevin Systrom was attending the Met Gala. He was getting his sommelier license, passing his test to be a wine expert. And so it was really a different world for him than it was for Facebook. He never had to testify in front of Congress, even though Russia used Instagram just as much to try to spread misinformation around the election. To your point about antitrust, I think one of the most interesting dynamics in the story for me is seeing how this restriction of resources for Instagram at the end of the story could actually be bad for Instagram's users. That because Instagram is not the top priority for Facebook, the same machine learning algorithms that apply on Facebook to try to solve Facebook's problems don't necessarily work for Instagram, and they're still in in reactionary mode. They're still playing whack-a-mole with some of their really big problems in more image-based communities, anonymous communities, hashtag-based communities. And so I do think that users lose out on that. Facebook is currently under antitrust investigation by the FTC, DOJ, and 47 state attorneys. Now, COVID has put everything on pause, but I think it's a really interesting time to think about how this platform has become critical infrastructure in our world. We're all using Instagram, we're all using Facebook more than ever right now. And I think that, you know, when we come out of this, it'll be interesting to see how they interpret the effect.
Sarah, you know, reading just excerpts of your book, it really made me think about how, as a user, the Instagram experience has evolved from when I signed up in 2010 to where it is today. And you kind of already talked about sort of the dynamic between the founders and Mark Zuckerberg. How much of the experience we have today is a vision of, you know, Kevin Systrom, or how much of it is all how Mark Zuckerberg envisioned it when Facebook acquired the platform?
Well, it adhered to Kevin Systrom's vision for a while, which is that Instagram, unlike Facebook, has this editorial voice. They really tried to promote users and accounts that they like better, which is nothing that Facebook and Twitter would ever do with their user base. The people who become popular in Instagram can actually have tremendous economic opportunity. And so in that way, it differs tremendously from Facebook. But if you look at Instagram today, you will notice more links back to Facebook, more prompts for you to also share on Facebook. And the reason for that is after the founders left, Facebook decided that it was time for Instagram to give back, that after all of those years of helping Instagram with their infrastructure, helping them with some of the backend engineering and the content side of things, that Instagram needed to direct its users back to Facebook and help make that a more central network.
Hey, Sarah, Miles here. When people write these books, as you know, there's the subtitle, which is not your subtitle, is often the rise and fall of X, or the rise of, you know, whatever, right? So I guess thinking about that frame, where do you see Instagram in its life cycle? And I guess does Instagram like even exist anymore? It's kind of been fully subsumed into the Facebook machine. Is it really an identity into itself, or is it just another appendage that, I don't know, Facebook seems to scoop up money through?
It's turning more and more into the latter. I think if you poll users right now, a majority of them still don't know that Facebook owns Instagram. But if you use the product, you'll see those things I mentioned redirecting people back to Facebook. And on the flip side, on Facebook, Facebook is no longer directing people back to Instagram like it used to. If you see an Instagram photo on Facebook, it won't tell you that it came from Instagram. And so I do think that the way the teams are being organized, it's more central. The way the problems are being solved is more central. And Facebook is really going to stop telling you how many people use Instagram. We haven't gotten an updated number since 2018. So the transparency is lacking, but the force of this product in our world and in Facebook's business has never been greater. I had to scoop earlier this year that Instagram's revenue was around 20 billion last year. Imagine that return on investment for your $1 billion purchase in 2012. More than a quarter of Facebook's revenue is Instagram, and it's continuing to grow. So it's a very interesting dynamic between the company within a company. But I do think that we're just going to have a lot less transparency around what Instagram's individual contribution is.
So as that revenue has grown, I think anybody that's on the service knows just the ad load has gotten so heavier for users. There's so many D2C brands now in your feed. It's changed. Is there any chance, I mean, you talk about how big it is, and we all know what's happening right now. We're at home, we're on it. Is the idea of Instagram becoming a MySpace, or somehow becoming so uncool, or delete Facebook? Is there any existential threat, you think, to Instagram, or is it just too big to fail right now?
I think there's a huge existential threat. The biggest threat to Instagram's future is fatigue around always performing, always curating that personal brand. And one of the things I chronicle in my book is how people really have taken to that follower number as a benchmark for relevance in society. And that's a lot of pressure, and whole brands have been created, as you said, off of Instagram influence. It's the way you market products right now. That has been disrupted with coronavirus. People aren't going to events. People aren't traveling. This whole experience economy that Instagram was really thriving on and really causing to become relevant in our world is flipped on its head. And so I think if we see an existential crisis for Instagram, it's really around what we're using it for. Right now, we're using it more for live video, for tutorials, for messaging with our friends, and much less for the traditional peacocking that we do on Instagram to tell people about ourselves and how amazing our lives are. It's really not a place for that right now because everyone's in crisis.
Sarah Fryer, the book is No Filter. Is it going to be a movie?
We'll see.
Is Jesse
Who would play
Eisenberg
Kevin? Wait, who would play Kevin, Sarah?
Yeah.
Oh my gosh, somebody very tall.
Yeah.
Oh, maybe the guy from Succession.
Oh.
He's doing the WeWork movie.
Adam Driver.
No, he's too famous. Adam Driver's too famous.
Oh, it has to be. Okay.
And is Jesse Eisenberg
John
too
Wick.
old now?
We need to get Jesse Eisenberg back for Zuckerberg.
Right?
That would be
Yeah,
good.
of course. Right. But maybe Keanu Reeves. I don't know. All right, we'll think about it.
That's a better one.
Yeah.
Keanu Reeves. Too old. All right, we're going to noodle on this in the break. Sarah Fryer, good luck. Excellent reporting. Really interesting to talk with you. A platform that we all use. The book is No Filter. Coming up, we're going to take one final look at how the market settled, plus what we're watching for the day ahead. Welcome back to Yahoo Finance. The day is done. We're teeing up another one tomorrow. What are we all looking at? Miles, real quick.
Claims in the morning. We got initial claims tomorrow morning. They're going to be terrible, but we are on the other side of the most shocking data for that number.
We've already had really bad data today, Andy Serwer. Can we take much more?
Yeah, one more. Raphael Bostic, Atlanta Fed president, saying we're going to see solvency problems in May.
Rick Newman, we haven't heard from you in a while.
Trump gives another press conference at 5:30 p.m. today. He's going to ignite some new controversy we'll all be talking about tomorrow. I have no idea what it's going to be, but we'll know soon.
That's it for Yahoo Finance.